close till I get up. Time is barely on our side.
That really nicely to go quiet. Good morning, everyone, and welcome. My name is Steve Torsa. I'm the founder and CEO of Wholesale Investor. Firstly, I'd like to say welcome to coming to our Venture and Capital Conference. Now, to start today, I just want to highlight, it's been really fascinating for all of us. If you think about our last 6 months, this is pretty much all we see on a daily basis. And what I love about the space that we're in is completely not that. Right? This entire space is driven by optimism. And it's also, and if you think about every single person in this room, effectively, when it's come to, as a company, we launched in the GFC. And so when it come time for going through COVID, I knew that our space was fine because of the nature and the DNA of the people that are actually inside of it. So for me, super excited to welcome everyone to the event and also to create this as an opportunity. Now, the spirit of the Venture and Capital Conference is really around engagement. And obviously, from the combination of the investors here to look at opportunities and also from the opportunities looking to meet with investors, what I always ask is this, is all of us have at least 5 to 10 people in our networks that could be relevant to the company that you may be speaking to. So whilst you're here today representing yourself, I always do ask that there may be someone in your network that could be relevant to one of the participating companies as well. So always keep that in mind for the actual sessions. And as far as this goes, as I said, this entire space is driven around creating opportunity. And this is always one of my favorite quotes, is that be fearful when others get greedy and greedy when others are fearful. To put simply, I think that pretty much describes the last 12 months quite well. And then you think about another billionaire, Ron Barron, where he highlighted this in his mind, this is a once-in-a-generation opportunity. It starts to transform the way in which you think about what comes next. And for me, as a company that launched we launched the week of October 4 to October 8, 2008. That's when we actually launched Wholesale Investor. And the spirit from our company is we just want to provide visibility and we want to provide access to opportunities, right? We want to make it basically and take a platform approach to actually doing that. And if you look about a lot of transformations actually happened during the GFC, right? Then fast forward to COVID, we also saw a lot of the companies that actually benefited from COVID and those transformations accelerated again. So all those different fear announcements, whether it be inflation, whether it be in session, whatever it may be, the one thing that I absolutely know about this space is that innovation accelerates during times of crisis. And that's why I think this next couple of years is such an incredible opportunity. And add to that the valuation arbitrage from an investor side, it also comes an incredible opportunity for investors to compound returns during this period as well. And as one of my favorite quotes of all times, and how could you not host an event in the UK and have Winston come up, is never let a good crisis go to waste. Now, I know this is a political statement, but effectively it really fits into this space as well. And I think we're seeing this happen right now. Whilst no one's clearly articulating and saying that's what they're doing, I really think that this is what's taking place in this area. So our focus as a company, right, our vision for Wholesale Investor is about creating opportunities for tomorrow. What I love about what we do is every email we send, every event we host, every video that we put out is really about trying to create an opportunity out of nothing. It's creating something new out of thin air. And what I love about this type of environment, one conversation today, you never know how those network of connections take place across a 3 to 5 year period. I said we could be hosting this 5 years from now, and the people that you've met at this conference have introduced you to other people and so on and so on. And I always love that chain of connection. So for me, everything we do is about empowering innovation, ambition, and capital. That summarizes us at our core via technology, platform, and partners. Today, we've got 25 exciting startups and emerging growth companies and funds that are presenting as part of the event. They all have tables inside the other section, the exhibition area. So this is where all the presentations will be. On the other side of the hall is where the exhibitions will be. That is also where lunch and morning tea and afternoon tea will be served as well. We have created plenty of time for networking as well, so don't think you're going to miss out on networking opportunities. I know typically our audiences love to have a good chat with each other, which is great. But also I want to make sure that the companies that are presenting also get their rightful opportunity to have a good audience to actually present to. The other part is that for us, I suppose when we sort of do our conversations, we want to answer these top 6 questions. And I can see you all squinting. I know it's written small. I'll do my best to summarize it. Effectively, and sort of where to from here. Secondly, obviously the desire for yield has also become important. Also, we've been asked about how to take an approach to venture investing right now if there is if there is a recession, and also with the continuing inflation as well. And then also really as I suppose things we look at this space is what is coming up over the next sort of 5 to 10 years. What are the mega trends that are becoming available for investors? And then obviously Web3 is still in people's mind and asking about, okay, that hype that took place in 2021, what comes next? And what I love about crypto, I said, when people doubt it the most is typically when high net worths start going in. And I find that most of the high net worths that we deal with are typically the ones that are investing during crypto winters and basically watching it ride up as it goes into the next bull run. And then just navigating that crypto winter approach. Obviously, we've done our best to basically line up the panel sessions, the speakers to align with what's happening in the markets right now, so it's as relevant as possible for you. And the most exciting part for me is that we've actually just today, you guys will experience our own conference software. For the last 6 months, we've been building this. It's our VMVP, our very minimal viable product version of the software. You would have received an email about it, but basically if you just go to app.crisp, CRISP.io, you'll see that basically it's got all the exhibitors in there. It's got which deals are trending during the actual event. You can actually favorite some of your companies so you can come back and look at them later. So we've just, basically the ideal from our side is that we got really frustrated with using other conferences because it wasn't perfectly integrated with what we needed. So we just built our own as true sort of the founding approach. And then obviously there's an agenda in there as well. So in there you've got the actual presentations, you've got the agenda, and inside the app itself. So make sure you go in there. And from the formalities perspective, now bathrooms are just around the side. The label for the door says WC. I can't remember what that's. Does anyone know what that stands for?
Closet. Water closet.
Water closet. Okay. Anyway, I was surprised by that. So WC is on the door for the bathrooms. They are gender neutral. And basically, as I said, to make it really, I'm sure you guys have all been to events before, help us navigate the day. What's really important is whenever you hear us ring the bell at the end of different networking sessions, please come back into the room. It just really helps us keep things on time and keeps things going to schedule. So on that note, use the conference software number 1, network with the CEOs. As I said, they may not be directly relevant to you or they may be relevant to other people in your network. Just please always keep that in mind. And as mentioned at the end, connect with your relevant network. You spend any time with us, you know that there's a nice energy that comes with the events that we put on. You meet some incredible people. And as I said, you come back 3 to 5 years being surprised about where the conversations from events like this end up leading to. So enjoy your venture capital experience. I'm going to introduce now our first presenter of the day, which is Mr. John Sharp. So I'm very, very excited to be, we've actually got a joint venture with John. Basically what I love about John is that for us, we think about how can we basically scale the process of capital raising and facilitate that. Everything John thinks about is how do you scale investing? And then how can you use technology and software and AI to actually do that? Every time he speaks, he blows me away. And I said it's been one of the for me, as far as from an ecosystem, one of the most amazing people I've had the chance to come across. So on that note, please welcome to the stage, Mr. John Sharp. Thanks, Dan.
Hi, everyone. It's a real pleasure to be here. And Steve, thank you very much for that terrific introduction. I thought it'd be interesting to take a look at what the Royal College of Surgeons stands for and to talk about that with relevance to what I'm going to talk about today. It's 222 years ago that they established this institution, and they did so for the very specific reason of drawing a line between who was allowed to do surgery and who wasn't allowed to do surgery. And previous to 1800, when this place was started, you could go to a barber and you could choose to, the barber could do the surgery for you, or you could go to a surgeon and maybe it was more expensive, but they're roughly equivalent. And so the Royal College of Surgeons was created so that you could basically choose to go with science and process and a more modern approach versus someone that's maybe going to be a little cheaper and not so scientific. And so I thought it might be an interesting thing to use that as an example to draw a line between previous ways of doing venture capital and new potential ways of doing venture capital. So what I'm going to talk about today is what we see are the three distinct phases of what venture capital is going through. And we're entering a new phase now, which is really going to be so much more different than the way venture capital has been done in the past that it may surprise you when you start considering some of the aspects of the new ways that we're all going to be investing, looking at companies, raising capital, and indeed some of the timeframes that are going to shift in that. Because if you go back 30 years ago, you maybe had 6 months to do a venture capital deal. You go back 50 years ago, maybe it was a year. All that is about to change quite radically with a lot of ramifications for not just the family offices and investors in the room, but also for the founders. And it could be a good idea to keep an eye on that. So first of all, let's start out and just look at some of the numbers around family offices. It's really fascinating. If you see here on the graph here, you can see the radically rising participation of family offices in the venture world. A lot of founders now go straight to family offices for capital. Why? Because family offices have at their core entrepreneurial DNA. Grandpa or great-grandpa or someone 17 generations ago created that family office based on entrepreneurial activity. And so you'll still find inside family offices, it's a good place to go and look for funding. And family offices are also sort of reawakening their understanding of this DNA as well. And they're now responsible for 20% plus of investment that's going on 20% of their allocations going to venture capital, and they're responsible for about 10% plus of the actual activity, and we don't see that slowing down. By the way, your average family office, a lot of people don't know much about family offices. UBS defines a family office as someone that's starting with about $30 million worth of combined assets. But we regularly meet family offices with $1, $2, $4 billion worth of assets. So when they're putting 20% of that capital to work, that's the equivalent of a pretty reasonable sized venture fund. So when a family office comes to see you today and says, look, you should talk to me about investment, you absolutely should talk to them about investment because they're a very, very viable alternative to venture funds. Now, this is great that the family offices are going and they're putting all this money out there, but there's a real problem that these guys are facing now, and that is that the family offices have basically learned from the VCs that they've been investing in. They've adopted those processes. They've gone forward. They think they understand the business. That's terrific. The problem is that everything is changing right now, and the larger VCs, there's a lot of capital out there from people like JP Morgan and Goldman, et cetera, and these guys are fundamentally changing the rules now. But before we talk about how they're changing the rules, let's just get sort of situated and look at the two phases of venture capital. So this picture here, take note of this picture. It's the first ever VC deal. It was a company called American Research Development Corp. Put a small amount of money into a company that later became Digital Equipment Corp in 1960. And 10 years later, they IPO'd this company for an IRR of, I think it was 101%. And everyone went, oh my God, yeah, what's venture capital? This sounds really exciting. I'd love to get an IRR of 100%. 2 years later, you had the founding of Sequoia. A few years after that, Kleiner Perkins, and boom, you start seeing all these guys popping up in the valley. And that defines pretty much the first 30 years as you have this Silicon Valley-centric approach to venture capital that we all know from history. The next phase, this is the golden age of venture capital. This is your 500 startups or your Startup Istanbul Elif demo day. This is a room packed full of people and energy and startups and people raising money, and it's brilliant. It's lots of fun to attend these events. You've got family offices, you've got angels, you've got VCs, you've got everyone co-investing together, sharing deals, syndicating. It's all very cooperative and it's very nice and everyone's getting along. Global returns are the same from Argentina to France to the US. Everything is synchronized. It's a wonderful time. So what could possibly go wrong? This is just going to continue, right? Actually, no. Things are about to change quite radically, and they already have. So when you have JP Morgan lending $5 billion to Tiger Global, who's then using AI and process automation developed by Bain Capital to parachute 10 people into Jakarta to do 5 deals in 5 days, wait, this is all very, very different than what we've seen before. It's different in terms of timeframes. Deals are being done much more quickly. There's a lot more use of AI and technology. There's a lot more domination by the big capital providers. What does this remind you of? It reminds me of the 90s. It reminds me of what happened when Solomon Smith Barney gave way to Goldman Sachs. The entire world changed in those 10 years in the 90s and was unrecognizable by the end of the 90s. Now, we see the same kind of things coming up in venture capital, and we think it's going to be a fundamentally different world. Oh, by the way, one thing I will... Oops, sorry. This massive seed to IPO strategies that are popping up, this is a really important point. It used to be, I'm a venture capital guy. I've got several funds that I manage. I would introduce myself previously as a seed stage investor. I'd say, hi, I'm a seed stage VC, and you'll hear that. We think that's going away. We think that what we see out there in the market now are people that are developing strategies that start at pre-seed and go all the way to IPO. Now, why does that make sense? It makes sense because if you don't get into the deal at seed, you're probably not going to get into the deal at Series A because things have become so competitive. So as a venture guy, you need to be developing a pre-seed or a seed stage strategy. Why is that really good for the founders in the room? It's really good for the founders because now you've got these really big players with lots of capital that are putting capital to work at pre-seed. If you don't do the seed to IPO strategy, you're basically not going to exist within 5 years is what we believe. There'll be a handful of like specialist guys in maybe a very specialized area of health tech or something that's doing a Series A strategy, and they will still introduce themselves that way. But for the most part, you're going to see a large rise in these seed to IPO mega portfolios. So we would characterize the move from venture 2.0 to venture 3.0 not as a subtle shift. Some people think, oh, yeah, it can't be that different, really. It'll just be a slow evolution, but that's not what we're seeing. What we're seeing is that things that were once very slow moving are now very quick. You can get a term sheet out to someone in an automated way using DocuSign in an hour. That didn't happen a few years ago. Everything that you saw that's happening now that's manual with the front office is now being automated. What used to be a very collegiate environment where we'd all share deals and we'd all share risk and it was all very nice, that's all changing now. It's becoming very, very competitive because there's too much capital chasing too few deals of quality. So it's going to become very, very competitive. It used to be, if you guys are familiar with the phrase TMZ, there's a very famous website we're all aware of called TMZ.com. The TMZ is an American phrase that stands for 30-mile zone, and it used to just refer to Hollywood. But the VCs, I think it's worth thinking about that they actually use that same kind of thinking or have until recently. If you're in Philadelphia, if you're a Philadelphia VC, you would not travel down to Florida to get a deal. If you're a New York VC, you'd invest around Silicon Alley. And this is the thinking until very recently. And now what's happening is everyone's going, oh, wait a minute, there's a world out there. And because of the competitive nature of what's going on, people are just as happy to get on a plane and go to Nairobi or get on a plane and go to Sydney or Singapore or anywhere else and do these deals, which again is great news for founders, but it's fundamentally a change from these people who didn't get on a plane at all to go and invest in something. So that's for local and global deal flow. AI-powered DD. So we're one of the companies that's invested millions of dollars in doing AI-powered diligence and deal analysis. Why did we do that? Because our index venture fund wants to invest in 1,000 companies. To invest in 1,000 companies at a ratio of 1%, which is really the quality threshold for most VCs, you need to look at 100,000 deals. You can only look at 100,000 deals if you're using AI, and the AI can be enormously helpful for that process. Most people, most VCs have small portfolios up until recently. Why do they have small portfolios? Because larger portfolios require a lot of resources and effort to manage. But if you automate that using process automation and robotics, you can do some really amazing things, and that helps you build larger portfolios which are better from a risk management standpoint. And anyone here familiar with modern portfolio theory knows that if you take that and you apply that to venture capital, you end up in a much better place. So impact and ESG used to be something that people go, yeah, it's really nice that you guys are doing that stuff, but now it's absolutely critical. There's no VC on the planet now that's going to invest in something bad. In fact, very few investors of any stripe are going to invest in bad stuff going forward. So now we're all looking, we're saying, is this truly impact? Is it greenwashing, or is it really going to make a difference? Is it real ESG? Stage Specific already covered this. Co-investment rights. If you're a family office, one of the reasons you used to invest in a fund is that you would say that you wanted co-investment rights, but what you're really after is the returns that the fund will give you. Now it's become quite true that people are after the co-investment rights, but now that's evolving, and a lot of family offices are saying, look, I don't just want the co-investment rights, I want the ability to take your pro rata from the fund and invest alongside you in that pro rata. So what does it mean? It means that the family offices are again taking a much more active role in coordinating, meeting with, working with the founders. In 2.0, as an LP, a limited partner in a VC, you would get an annual report. Everyone would get together and have tea or coffee once a year or twice a year, and you talk about the deals that you've been doing. Now, people want real time. They want to say, what's my NAV? What's going on right now today? Can I download a really pretty report? This is a pretty interesting fact. So in this hyper-competitive world where we are moving to using technology, what Gardner's saying is that by 2025, 75% of VCs are going to be using AI and process automation, some combination of those tools. Only roughly 20% are using anything like that at the moment. The big guys, Sequoia, EQT, they've developed some really interesting technology, but most of the rest of the funds in the world are sitting there saying, well, we don't really have anything. But they'll get there, and they'll go to people like us and like Steve and other people that are developing technology, and they'll say, we can use your technology to make our systems more competitive. For the family offices in the room, you are really going to need your own tool sets in this way, because the VCs already have the resources and the systems and the processes in place. So for them to add AI and automation, they come to someone like us, they do a licensing deal, and they can quickly get up to speed on that. But a lot of the family offices don't have a full front office, don't have a full back office. So for them, there's a two-edged sword here. They have to invest in both. You've got to invest in people, but you've also got to invest in the technology. The technology means you invest in less people, as we all know. So now I want to talk, just in a few minutes that I have remaining here, I want to talk about what we're doing in this area. VAS stands for Venture as a Service Technology Platform. So I'm going to show you some of the stuff behind the scenes of what we're doing. But first, I'm going to say a big thank you to the pandemic, because during the pandemic, we actually, we were a fund manager. We were doing stuff in technology that was cool and interesting. But when the pandemic hit, I got my dev team together and I said, look, this might go on for 6 or 8 months, so we should think about doubling down on our technology investment. As we all know, in Singapore, it lasted 2.5 years. We raised a bunch of money and we went out and we locked a fund manager, a lawyer, a data scientist, and a process automation guy in a room, actually a whole team of them, and we said, build stuff that could be useful. And that's how we ended up with the world's greatest investment management platform. We came second last year out of 476 fintechs in Switzerland at the Future of Finance competition run by UBS. There are 20 other venture tech companies in there. As one of the judges said, we had the only holistic end-to-end solution for family offices and investors. And I'd be happy for any of you to come and meet with me while we're here today. And we'd be very, very happy to set up a demo and show you how everything works. But let me give you a quick overview of it now. You'll recall that there's a lot of things that are changing between Venture 2.0 and Venture 3.0. So a lot of those changes are things that we started thinking about 5 years ago and building into this platform. So just as one example of this long list of things that are on the platform here, we're using blockchain to log all of the entries and all of the data on the platform. Why is that important? Because you as an LP, if you've made a $5 million investment and some guy goes into the database and changes that to a $500,000 investment, a couple of things. You won't know who made that change. you'll have to go back and figure out when the change was made. It's very, very messy and difficult when data gets corrupted or when there's someone copying from one screen to another, which is very, very common in the fund admin world. So what we decided to do is put everything on the blockchain and automate all of the data distribution internally within our organization. And that means that we end up with a very error-free solution that I can go back 3 years and I can look at every single transaction across 14,000 validating computers on Ethereum, and I can figure out exactly what's going on with all of our data. This is super important when you're managing large amounts of money. So why did we build this? We built this because we're investors. Our first fund was a $20 million fund. Our second fund is a $125 million fund. Our third, not our third fund, but one of our 9 funds that we do now is a carbon fund, Carbon Nation. And we just closed an anchor investor on that for $250 million, which we're super excited about. And our goal there is to go and find carbon-related or carbon capture projects around the world and invest. But in building up these things, it's great that you build up these other funds and you get more and more investment, but the perennial problem for investors is, how do I scale up and keep costs down? Because people are expensive, they're very, very hard to find in the context of a VC or a family office. So what we do is we automate everything. So what you can do on our platform, which is revolutionary, is you can create a venture fund in 5 minutes. What does that mean? It means you go onto Hatcher.com, you say, I want to create a fund, and you click a few buttons, and we plug in all the service providers. We fill out all the legals for you based on the customized information that you've provided. And at the end of 5 minutes, you have a venture fund. I was just in Luxembourg, by the way. We're doing it in Singapore right now, but Luxembourg is the next stop for those of you that like Luxembourg. The second thing that we're doing here is we're giving access to deal flow. We have 1 million companies in our database. You can, for $10,000 a year, sign up and get access to those 1 million companies, and we'll use AI to help you grow your portfolio. What does that mean? It means that if you're interested in looking at cancer treatments, for example, you can go in there and say, this is my area of interest as a family office or an investor, and the AI will work with you to figure out what should be in there. Automating the back office. Most people's back offices are pretty rough and ready. They're pretty manual. It's not the greatest look when you go and you spend time in someone's back office. What we've done is automate that process and put a lot of technology to work there, again, to reduce errors and to give you the ability to push a button and create a report. So this is our Fund Builder product. You can go in there. As I said, you can build a fund in 5 minutes. We think the Singapore fund structure is fantastic. If you're already using a Cayman structure, for example, and you send money from the UK to Cayman as part of that fund, UK will withhold 30% of that. If you send that same cash to a Singapore fund, they'll only withhold 10%. So Singapore has a really amazing fund structure that they've put together. Luxembourg is also killing it right now in the UK. In the EU, that's where we think is the future. We just set up a fund for a family office in Dubai. It's an $80 million fund. There's actually 3 funds in total. And what we're able to do is save them roughly $1 million on their annual costs of running this fund. Deal Scout. What is Deal Scout? Deal Scout is a 1 million company database. It's AI powered. You can set your mandate using natural language to say, I just want to look at deals that are in the pick an area. There's a competitive matrix that we create, again, using AI for each company that's in there. And there's no fees paid on founder intros for this Deal Scout functionality. This is what it looks like when you search for indoor farming opportunities in the United Arab Emirates. So what I've done here is I've put in natural language. I've said, this is what an indoor farming company looks like. I press search. It brings me up a range of companies here, and then I can use, and everyone here's got Netflix, right? I think you're all familiar with the more like this, less like this. So you can do the same thing here on our interface. You can say more like this, please, less like this, and it learns what your preferences are and trains. Back office. What can I do in the back office with our system? There's a lady I met in Monaco at a conference recently. She has 88 people in her family office that she has to create reports for and send them out to. She spends 3 weeks every quarter creating these reports. I showed our system. I said, look, if you just press this button here, it'll create, and you select a mailing list, it'll consolidate all of your holdings, create a beautiful looking report, and you can send that to your family members. It'll take you 5 minutes. And she really loved that. A lot of people do their own fund admin and do their own fund accounting. So we've created functionality that supports that. It sounds like a pretty boring area to focus on. We really love it because it's a $25 trillion AUM business, just fund admin. And it's a business that's really in the dark ages. If you walk into most fund admin offices, it's people and paper and phones ringing. And this can be vastly improved with technology, which is what we've done on the back end. Everything we do is in multiple currencies, multiple languages. And the pricing here, I'm not here to sell you guys today. I'm just here really to talk about what we see as the future of venture. But if you are interested in the pricing, the core software for Vast is free. So there's no real stress in getting on board the platform. If you want to access our deal funnel, it's $10,000 a year. If you want to set up a fund, it's 25 grand in the Caymans or Luxembourg or Singapore. Everything is standard, all-in pricing. There's no hidden costs. By the way, if you've ever set up a fund, and I've set up a few, you know that a lot of the months are spent negotiating with all the different groups to get them all in line and to get all the prices done. We consolidate all the pricing down to a 5-minute discussion. Pick this guy for this price, this guy for this price, and it just makes it a lot easier to set these things up. So that's basically it for us. The old model versus the new model is, the old model was trust us. We're not going to corrupt your data. Everything's going to be fine. The new model is just use the blockchain, use a trustless format. If anyone is unfamiliar with the blockchain, I think you're all probably pretty familiar with it by now. Blockchain has 2 functions, add and read. It doesn't have an update. It doesn't have a delete function. Anything that you add to the blockchain is there forever. Why is that good? And it references the previous transaction on the chain. Why is that good? Because the data is uncorruptible. It's not possible to create forgeries on the blockchain that are going to be verifiable. We use encryption throughout our network. Why is that important? Because data hacks happen all the time. So that's one of the things that we do. Everything we do here, as you can see, is really related to making sure that the systems are less corruptible, less error-prone, less in need of manual intervention. The last thing I'd say is that, for years we've been in the fund management and fund admin and venture world, we've been very used to all of our functionality being at a relatively low quality. It's been manual, it's been gut feel, there's been all this sort of stuff that really goes back maybe 100 years even. And it comes at a high price. All the people that work there are costly people and the functions are very costly. What we see as part of the Venture 3.0 paradigm is that that's going to change and you're going to be able to get high quality at a much lower price, which means you'll be able to do much more investing, much more monitoring of your investments and do it in a much more efficient way. Why is that great news for the founders in the room? It means that people can go from doing 5 investments in a year to doing 50 investments in a year. And with quantitative easing and all the rest of it that I won't go into here, there's a lot of cash out there. So the constraints really come down to resources, access to deals. These are the problems that we're trying to solve with Vast. And so that's why we think the future is vast, if you'll pardon the pun. Thank you very much for your time, everyone. I have 5 minutes if anyone would like to ask any questions on any subject at all. Remember that I am a venture guy and I am a technology developer as well. So if you're interested in either, please pop up your hand and I'll do my best.
So you have some success in sales of your products. How successful are you in the UK today, and also follow up in the US?
Yeah, so we've really focused on mostly our offices are in Singapore, Dubai, and Miami. 3 very nice, hot cities that we enjoy being in. Our real focus on sales so far has been out of Singapore because of the Singapore VCC is a fairly new entity. So we've focused on selling the fund structure there and then layering on all the technology around that to family offices, predominantly in Singapore. But we have now, I think, 11 funds on the system with 37 in the bridge that are coming on board. So it seems to be picking up at a reasonable pace. Most of those funds are out of Switzerland, Most of these clients are coming out of Switzerland, a couple out of Monaco, mostly out of Singapore and a couple out of Australia. As Steve mentioned earlier, we have a joint venture in Australia with a fund down there that's a $10 million Aussie fund looking to invest in startups out of Australia. So we're not really constrained. We're quite used to going around different parts of the world. The UK, this is actually the first time we're talking about this in the UK. There's a gentleman at the back there.
I have two questions. One, how do founders kind of match to your algorithm? It's more like Netflix, so it's like
Yeah.
we would be giving you presentations and we have no idea how to tag to your metadata. The second question is, do you have like a French-based kind of application portal where you kind of source all the deals and then distribute it to all the investors, or is it investor-to-investor application?
Yeah, so typically our platform is used by a lot of accelerators and angel groups around the world. We power one of the largest angel groups in Turkey, two of the largest angel groups in Southeast Asia, Australia. In the US, we power 7 of the largest accelerator groups over there. So we see a lot of deal inflow, and one of the big problems for investors is that their packet loss is quite enormous. They don't see a lot of the deals that are there unless they come to events like this and they meet you guys at these events. So we filter all those, or we bring all those deals in, and then we push them out to the people that are using our platform so that they can see what these deals are. To your second question, when founders are applying for funding, there's several people that have now developed pretty good ways of using natural language processing to understand what you do. And there's huge benefits for founders in that. A lot of founders will sometimes say, what sector are you working in? And rather than saying, well, we provide sophisticated software that can detect breast cancer, in partnership with radiology companies doing this, they'll go, software. Right? That's what the founder will choose, and they're not helping themselves that way, whereas our AI can dive in there and say, no, we know which of 2,700 subsectors to put this in, and then it can go directly to investors that have also, where we've done the same analysis on the investor and figured out that that's what they want to invest in. So what Steve's developing, what we're developing, are technologies that allow for a much better correlation or understanding between the founders and the investors. Because technologies are getting more and more towards deep tech, more and more towards specialized approaches to solving problems. So if you don't use AI, you can miss the subtleties of what the founders are trying to achieve sometimes. Does that answer your question? Yeah, thanks.
To what extent do you use blockchain? Is it purely for trust and...
Yeah, sorry, I can repeat the question. To what extent do we use blockchain?
Yes, is it just for trust and scalability, or does it go beyond that?
So we're not yet tokenizing anything. I have actually resisted talking about blockchain until quite recently, because when you talk about blockchain on Ethereum, people say, oh, he's a crypto guy. Right now in Singapore, that causes me enormous problems. They'll shut down all my bank accounts. So I need to be careful about being very exact with what we use blockchain for. We're using blockchain in the context of the original technology. Where the idea is that you use this ad read capability to constantly be updating the blockchain with what's going on in the system, so that there's no way that anything on the system can ever change relative to what was stated yesterday about a NAV or an investment or anything in that manner. But Ethereum's got a couple of things that are coming along quite soon. I won't go into the technical details that will really change our ability to leverage. Sorry?
I said, so you're going to love my talk later?
I'll be coming to see it then. Yeah, for anyone unfamiliar with blockchain versus crypto, they are two entirely different things for those of us that are working in the technology. And blockchain is just a wonderful, wonderful way of industrializing audits and organizing your data in such a way that it's non-corruptible. So I look forward to hearing your talk later on, because I imagine you'll be talking about much the same themes. Well, that's my 30 minutes. Thank you all for your very patient. Thank you for listening.
So we're just going to kick things off today with the first panel session. which is about investing in deep tech for the non-technical. The panel is going to be run by Maya and then be joined by Ulrich, Farid, Francesco, and Saeed. They'll do a quick intro to themselves and run through the content, and Maya will be taking you from here. But should be a good panel, and there's a few more to come today, but thank you.
Hello. Hi, everyone. Okay, can everybody hear me in the back? Good, thumbs up. Awesome, good morning, everybody. I hope that you are well awake to not miss this amazing panel about a very lightweight topic, first thing in the morning, deep tech. But don't worry, this is really about approaching deep tech for those of us who are quote unquote non-technical, which basically means those of us who do not have multiple PhDs, myself included. And so what we hope is to just kind of foster an insightful discussion regardless of technical depth, technical curiosity, and really just pick the brains of these amazing panelists up here. So just to dive right in, we're going to do sub 1 minute intros. I'll kick it off and then we'll go down the line, if that sounds good.
Great, I should have sat here, right, because I'm going to get...
Oh yeah, you're going to get grilled. Yeah, for sure.
Brilliant.
Bad
Hi,
spot.
good morning. My name's Saeed Ahmed. I'm the founder of Savortex. We're an Internet of Things big data technology company serving building services sector. And hopefully I'll get to explain a little bit more about what we do later.
Awesome. Hi everyone, I'm Ulrich, so the founder of Vauban.io. What we do is that we make it easy to launch your angel syndicate or your venture fund. Super excited to be here.
Hi everybody, good morning. My name is Farid. I am one of the core contributors at a new DAO called bravenewDAO.earth, and I'm also a venture partner at a $100 million deep tech fund, which is focused on AI investments in Asia called Intema.ai. Thanks for having me.
Hi everyone, I'm Francesco Bertigari. I'm the managing partner of Silicon Roundabout Ventures. By background, I'm a software engineer, and I'm now launching Silicon Roundabout Ventures to focus on pre-seed, early seed deep tech, UK, Europe, and also using Vauban for that. So, big shout out to the guy over there.
Thank you.
Awesome, thanks so much. And I'll also introduce myself briefly. I'm an early stage purpose-driven investor and advisor focused on health tech and wealth tech. So I'll be discovering alongside all of you today. So just to kick it off, I think some of us might just be wondering, what is deep tech? What counts as deep tech? How do you draw the line between deep tech and other forms of technology? So just to make sure we're grounded, but also acknowledging that there isn't really a universal definition of deep tech, we're just going to do another kind of quick round robin of how each of us on the panel would define deep tech for the purpose of this conversation. So let's actually spare you for a moment and start with Francesco at the bottom.
Oh, there we go. So that's a good question, because like AI, these type of things, it doesn't really mean anything. Somebody started using it and there we go. And it's probably an easy way for founders and funds to speak to either LPs or other funds. But realistically, I would say personally that deep tech is any technology that is based in the commercialization of a technology that is based on advanced engineering and or science that is proprietary and actually new. So, let's say, for example, Airbnb or any of those marketplaces or type of apps or Uber or whatever. Yes, there is innovation. There is innovation in any technology, but it's mostly off-the-shelf technology where it's the business innovation that drives it further. In deep tech, say, for example, my last investment is a semiconductor photonics company where they're actually developing a new chip based on photonics research. Most of the times it spins out from universities, but also it can be a purely traditional startup that is not related to a university, but then the startup itself is developing new technology. So that's at least on my take on it.
Thanks so much. Farid?
Yeah, so I think I have the one-liner is engineering and research-led commercial innovation. That's it. It's pretty straightforward.
Nice. Love it.
Yeah.
Ulrich?
For me, deep tech is when you don't understand it. Like, for example, for my parents, what I do, like, venture capital fund automation, etc., is very deep, right? Like, it's DeepTech, they don't understand anything. And, every time there is like a fund manager that say, oh, I invest in DeepTech, what I hear is like, I'm smarter than you. So, for me, it's important when you, a venture fund manager, approach an investor that you are, super precise about, in what DeepTech you invest. Because even if I believe, in this concept of, to be a polymath and expert in everything, there is no way, you can invest in space tech, semiconductor, biotech, healthcare, etc. So I think it's very important to define essentially what are your areas of specialty.
Thanks, guys. Yeah, just building on what everyone said, I think for me, deep tech is really businesses that are solving complex problems using advanced science, engineering, underpinned by, in my opinion, data, which then gives rise to AI, blockchain, Internet of Things, technologies, etc. And it's technology that really resolves a problem that takes time, lots of testing, deep engineering, casing point, solving simple problems which you'd think are simple. So, for example, the current pandemic that we've all experienced, viruses have been around for decades, but yet again, governments, businesses were caught off guard. We wasn't prepared. I think the current loss sits somewhere in the region of $1 trillion globally because of lost commercial activity. And if you've gone into buildings recently, you'll see that they're empty, they're 20-30% occupied, which means landlords and building owners are hemorrhaging cash, which then has a direct impact on the economy. So what Vortex did, simple problem, viruses have been around for decades, infections have been around for decades, yet simple societal behavioral change could have stopped all the losses. So what Vortex we've done, we've teamed up with Intel, I'm sure you've heard of Intel, and ARM, two very big connectivity businesses, and we've launched the first connected hygiene network for buildings so that building managers in real time can manage hygiene to stop the spread of viruses. And why is that important? It means that buildings can reopen, consumer, customer, staff confidence returns. 33% of people are not going to work because they're concerned if their colleagues have sanitized or not. So we're on the fringe of deep tech. I wouldn't say my parents are scared with what I'm doing, but we're on the fringe. This is a tough audience. I thought that was quite funny, by the way.
It's early.
So basically, we're on the fringe of deep tech. So we're dealing with simple problems. However, it's taken almost 6 years to design, test, and finally launch the solution. So that's hopefully that gives you a bit more of an insight to deep tech.
Thank you so much, Saeed. Let's just take a step back, and I'd love to hear a little bit more about where has deep tech been? What has the last decade or so looked like for deep tech? Maybe Francesco and Farid, you could give us an overview of that. As I know that we've got limited time, but just as concisely as you could, where have we been to get us to where we are today?
Good. So actually, because again, the fund is new, and to convince LPs, obviously we looked at a lot of data, and also to be sure of what we're doing, right? We're going to invest our own money as well, and it's a big challenge. And looking at that data, I would say one thing stood out to me, that it feels like there has been almost like a couple of waves in the venture ecosystem. What I mean by that is that if you look at the type of companies that were venture-backed and then exited and created wealth and value, at the very beginning of Silicon Valley, back in the 60s, 70s, it was all basically Silicon-based, right? The Silicon Valley. And then personal computing, and it was a lot about new hardware, new types of computation, and types of systems, which then propelled the internet. And then you go towards the dot-com bubble, and then you see that basically venture-backed businesses become shallower and shallower, the opposite of deep tech in a way, right? You could just create a dot-com type of business, which not even a business sometimes, it was just a domain, and people would get funded and go IPO, and then, of course, bubble and burst. And then that, in a way, started to ignite a new wave of innovation, and then you started to see, for example, GPUs, like NVIDIA was funded at that time, and the early businesses that went public felt the bubble, but were really building innovation, like the Amazons and Googles that were building infrastructure. Then again started to recreate this infrastructure, and then at the back of this cloud infrastructure, now we have a name for it, the cloud, then again all the B2B SaaS, etc. And then that again got shallower and shallower because it became very capital efficient. But then again now you're seeing that businesses are becoming less capital efficient even though they're digital, because it's so easy in a way. It's so easy and cheap to launch a digital business that it's easy to create copycats. And so businesses spend a lot more on customer acquisition, on marketing. Recently, I wouldn't say scandal, it's just the venture system. In Klarna, the cost of acquisition per user is just skyrocketing because effectively you've got so many competitors that come up. And it's so easy to create competition. And so I think that right now, the deep tech of today, it brings us to the point where to create a new wave of innovation, we need new architectures from the ground up. You need new hardware to create the next step in AI that is not just incremental. You need new infrastructure software that creates kind of the next version of what the cloud could be, from edge computing to all these type of things. And of course, for example, space is just an entire new vertical. Then now you start to see even downstream applications. But for that, you need satellites up into space. And so right now, I think it's very relevant to invest in technologies that create a new infrastructure for technology.
Thank you so much. Fareed?
Yeah, so I think what I'll just talk about briefly is that a while back I read this book, and I'd encourage all of you to read it. It's called The Startup Game. It's by a guy called William Draper III. He was actually the first guy ever to start a VC fund, and certainly the first also to create a VC fund for India. Very interesting. So I read his book, and in the book there was a little note that said, I think it was a note to his publicist or something. It said, "Here's my phone number, call me." So I picked up the phone and I called him. I'd bought the book secondhand. And I got through to him, and we started having a conversation about, I introduced myself, and started having a conversation about the history of venture capital. And he told me that he and his co-GP at the first fund, they used to drive around Silicon Valley looking for deals. They would drive around, they'd look at the sign up outside the building, they'd knock on their door and be like, "Are you looking for money?" And that's kind of how the business of venture capital used to happen back in the day. And you fast forward to now, and I think just look at the abundance of information, right? You've got people like our colleague here who was talking about AI, and you were talking about, so I think the amount of information available now is just incredible compared to before. And so you see a lot more market entrants. So the first thing I'd say is that the number of entrants in deep tech has exploded, right? And whereas back in the day it was mostly government funded, you heard that before as well. I mean, JPL has been around since the 40s, right? Like it's ancient. So a lot of the American institutions that were there, and I'm not American, by the way, just said I'm Canadian, close but no cigar. But a lot of that innovation was pioneered there because the government was willing to actually put their money where their mouth is. And now you see that coming back again. So you see that technology sovereignty and that race has become really key. What do you think the number one item on China's agenda is right now, on their strategic plan? It's quantum computing, right? That should tell you everything that you need to know about, where, and I don't know if any of you followed, but there was a fantastic post recently on LinkedIn, which is talking about how NATO just set up a $1 billion fund. So what does that mean? That means that I guess a lot of the organizations that are scale governmental organizations are once again starting to look back at deep tech innovation, and they're starting to fund it again, because we sort of went through this cycle, right, where they started it, they sparked it, and then they left it and they let the private market come in. That happened in Israel as well, that happened in the US, that happened in a lot of different places. But I don't think enough people give credit to the government, and again, I don't work for the government, but I actually really recognize the role that they play, both in tax incentives and in helping the most important single set of organizations in our space. Universities power deep tech innovation. So just look at the programs that are available today. If you want to check out some really cool ones, check out I was about to say CogX, sorry. No, check out Cognition X, right, by Riem. It's a group of, I think, 500
Yeah,
PhDs?
PhDs, yeah.
Unreal, right?
They do events, yeah, they're in here in London. If you're around, check them out.
They're so cool. And just the fact that you can walk into a room of 500 PhDs, first of all, the wattage in that room is just scary. But the fact that these guys are also producing businesses. Now, here's another thing that was missing back in the day, right? You'd have people be like, hey, listen, I'm this researcher. I did chemical engineering with a focus on biofuels. When I finished up at school, it was not sexy to start a biofuels business, okay? So there's a cultural piece here where in Israel, they've got that bang on because it is actually cool to be an entrepreneur. It's cool to start businesses, but it's also cool to be a research guy or girl who knows a little bit about turning it into a business. So I think these are the big things, in my opinion, that were not so prevalent before, but are changing now.
That's awesome. Thank you so much. And thank you for some of your personal storytelling as well.
Pleasure.
Just to help us kind of dimensionalize what we're talking about, Ulrich, can you speak to us a little bit about like what portion of venture capital money goes into deep tech? Like how big is deep tech today, to the best of your understanding?
Yeah, so right now in Europe, 20% of venture funding goes to deep tech, and deep tech, like it can be very wide, right? As you say, so I include blockchain, I include AI, semiconductor, and all that. So it represents roughly like 10, 15 billion, 20 billion. The Nordic countries actually, very far advanced, where like 30 or 35% of all their VC funding goes to deep tech, and that's why I'm so excited about it, because it's actually very similar to like American, funding. Like we are not, that we are not that far from them, and the other reason I'm so excited about deep tech is that because I'm fascinated by this concept. I'm sure a lot of you have heard about it, but it's the Kardashev scale of civilization. And essentially, it's a way to measure human progress of a civilization. So you have like 3 types, and type 1 is when you can harvest in a sustainable way the entire energy of your planet. Type 2 is when you can harvest the entire energy of your host star, and type 3, galaxy. And right now, planet Earth, we are at 50% of becoming a type 1, which is quite exciting. But to get to, like fully type 1 and type 2, it's not by funding, buy now, pay later technology, right? It's by, funding what you mentioned, right? Like quantum computing or these type of things that's really gonna, unlock new technologies.
Thank you so much. Saeed, what do you feel the most common misconceptions are about deep tech?
I was very excited to answer that last question. I was.
Answer that one too.
I'll very briefly touch on
it.
that. I just wanted to say that from an entrepreneur's perspective, it's great to be on a panel with the other side and to see, how enthused you are to invest in deep tech and, tech in between, etc. I think the last decade has been one of the most exciting decades for technological solutions, and the fact that great entrepreneurs like Richard Branson, Elon Musk, all these guys have really started this wave, and now you have a wave of entrepreneurs bringing solutions to the marketplace. So I think that's what's driving the whole deep tech economy. In terms of misconception, so as I've touched on at Savortex, we've developed this network of IoT, big data connected hygiene solutions. And it's taken us 5 years. We thought it would take a couple of years, So I think that's the biggest misconception, that, you're going to invest in an entrepreneur and we're just going to produce magic, where in fact, what we actually need these days is that commitment from investors to be understanding that the R&D stage takes a lot longer than you'd expect. However, one thing that I've realized is that solutions, deep tech or tech solutions that come to market that resolve complex problems, usually when they make it to market, cause societal change, and that's when you get the rewards and changing behavior, etc., which is what we're all striving for.
Thank you so much. So for those of us who are not investing in deep tech currently, what advice do you have for us in navigating the deep tech space and considering deep tech investments? Francesco, do you want to kick it off?
Good question. Right. So I would say, let's start with a metaphor. So if you're investing in public equity, let's say, right, and you're novice to it, what would you normally do? I mean, I would recommend, say, my grandma, if she ever studied, like I keep telling her to do, to start with, ETFs and funds, and start to alongside, if she wants to make any bets, to make some research and then take that opportunity. I would say it's the same in venture capital. For the first time in history, we've got platforms like Vauban, but also like syndicates like the European VC guys. I can't say the name, but there is a platform that you all know that is coming up as well. And in the US, there is also a bunch. So it's starting, it's still very early stage, but it's starting to be democratized. And so what I would say is that if you have capacity, try to get into some funds and go alongside. If you have expertise in a particular field, then focus on that field and try to repurpose. Join angel groups, like try to basically not go it alone, because it's not the same thing to back, again, an edge computing startup that it is to back a marketplace. And so if you are spreading and pray, then there is absolutely no difference to normal tech. Then in that case, you are indexing and you can invest in deep tech just as much as you can invest in bottles of water, right? But if you're not, then I would say try to mix your basket, right? Try to maybe invest in a couple of funds and then do some direct or join angel syndicates and work alongside others before taking your first steps.
Thanks so much. Fareed, anything you'd add?
Yeah, I mean, I think, again, there's a lot more, newer models today, right? So VC funds were a fantastic model. I come from a world where we believe in the future of investing coming through DAOs, and DAOs are decentralized autonomous organizations. And one I'd really encourage you to check out has just been set up. It raised about $13 million recently, and it's called Molecule. And Molecule is, they created a little DAO called Vita DAO, and what they're trying to do is they're trying to allow community capital to back research for longevity, fighting anything from metastatic cells to figuring out new ways to live longer, et cetera. But what's beautiful about this, that it's community capital. Guess who's in the community? We are. So you need to join a DAO to be a part of the community. Look them up, because I think 99% of the people that I talk to don't know what that is. It's not that hard to join. You kind of have to put yourself forward and saying, I have a great interest in this, or may have studied that, or I have a network in this, and I think I can add value to the community. That's what it's about. So I think that that's a massive innovation, right? And don't be distracted by the fact that there's crypto involved, because that's just a mechanism. Think of it as just a platform to deploy money. They're going to keep stuff in USDC, which is a stable coin, and then they give that as a dollar equivalent when you can invest. Okay, so but please look at DAOs as a way to get involved in communities of people that have specialist skills. And I really believe in the hive mind, right? Because when you sit together with 500 PhDs, something magic can happen, because just the sheer sort of computational energy of those people and their own networks are very powerful. And I agree with you. Start to experiment and start small. Look at all the crowdfunding sites that are available now. Like, you can learn so much with like $100 of investment. And I'm not going to tell you to go up to a particular platform and invest, but just go look at those deals, even if you don't invest, because you can learn so much from looking at their presentations, reaching out to the founders. I think the surprising thing for me is that most people do not reach out to the founders. I don't get it, because that's kind of how you learn about a business, right? So now I appreciate that the founder cannot take 100 emails, but trust me, they'll get back to some.
Thank you. Ulrich?
So similar to Francesco, I mean, I would advise to invest in funds instead of specific deals if you don't have the expertise. But let's say, to play like devil's advocate, let's say you really want to invest in a specific deal. And for example, my mom, she's really worried about climate, etc. And she was like, but you have a platform with all these deals, like just introduce me to some companies. I want to invest. I love how we take example of our grandma, mom. And so if you really want to invest in a specific deal and you don't have a lot of expertise, I mean, first thing, Google is amazing, right? I mean, you all know that, but you can learn absolutely everything online. Second thing, I would advise not to invest at like pre-seed or seed or like pre-revenue, essentially, because at pre-revenue, you really need to evaluate the technology, and if you're not an expert, it's going to be difficult to be sure about your investment. So wait for revenue, actual clients, etc. And if you have that, and if you understand slightly the market, it's okay, right? Like the only assumption you need to make is that it's not a Theranos, right, where they have lied on their big client contract. But yeah, I guess it's rare now.
But pre-seed seed funds would be an exception to that, in the sense that
yeah, I mean, as Francesco, I mean, when you invest on a deal-by-deal, basis, like yourself, alone in deep tech, it can be quite risky, right? If you really want to do it, maybe wait for Series A to get into this deal.
Totally. Thank you. Saeed?
Yeah, I mean, I back what the guys have said I think crowd funds are an exciting way to invest in technology if you don't have a team of experts on board, respective to whatever deal that you're assessing. So that's my viewpoint.
Awesome. And starting with you, what are some themes you're excited about in deep tech at the moment?
Great. So I think, and the question was supposed to be what am I concerned about as well, because I can see the questions here. So, I'm excited about the fact that, as I've touched on, this is a great opportunity. I think the last decade has been huge growth in terms of technological innovation, etc. So I'm really excited about that's continuing, and you can see a lot more solutions in the marketplace now. What I'm concerned about, which was the other side, and I think that's important, it slightly goes against what Ulrich said. As the founder that's gone through many stages with multiple businesses and now with Savortex, I think there needs to be a mind shift from venture capital and family funds to look at deep technology or technology that's on the fringe of deep technology and back the technology and the pilots and the case studies rather than revenue, and what change that technology can bring. Because I also feel that the venture capital model is pre-COVID probably very relevant, but during COVID, a lot of businesses went through some significant challenges, and I think we all went through personal challenges. So therefore, the businesses that have been resilient and innovated through that period need capital to realize, to resolve critical problems that then cause societal change. So I think venture capital looking at traditional revenue models, I think a lot of deals are not getting through, whereby those technologies could be the game changers and exactly the rewards that you're looking for, because going back to the old risk versus reward. So that would be my viewpoint.
No problem. I'm open-minded.
but absolutely, as
yeah.
Ulrich said, sorry, the technology's got to check out, the pilots are got to, the data's got to check out, the case studies have to be strong, etc.
Totally. And just in the last few minutes before we wrap up, I'm curious for thoughts, and especially Francesco and Farid, what do you see? What are your predictions for the future of deep tech in the next decade as investors? What are some things you anticipate coming? And I think similar to kind of what Saeed started to talk about, what gives you some hope, and honestly, what gives you some caution or concern? What do you really think people should be mindful of, especially those of us who are newer to the space?
Definitely. Okay, so let's do like one on one. So I would say Terminator's not coming anytime soon. The concerns you should have about AI are not whether it's going to create a Skynet, it's whether the biases that are introduced and the fact that you're starting to have levels of decision-making that is abstracted from people, and then the people at the top might be politicians or other people that haven't got any clue about the actual technology. That could be a challenge. And actually, the funny thing is that this threat is not a threat. It's actually happening right now. Social media make a heavy use of machine learning for a long time, and it's been proved that that has biased elections. That is having an impact, right? So I would say on the threat side, I'm more concerned about the handling of technologies that are not even that far into the future by people that don't exactly know how the system works. On the other side, I'm extremely excited about hybrid architectures, which are both software and hardware. So on the software, let's say edge computing or anything that creates new models for computation. On the hardware side, I mean, quantum is an easy shot, but for example, even new ways of creating parallel computing. So I've seen light being used for very interesting things, and so obviously there is all of that. And then I would say a second one could be new realms where there is, like scale-ups are becoming big enough to make acquisition and to require buying. So for example, space is one of those where scale-ups have now, Elon Musk you all know, but for example, there is an Italian company called The Orbit that is about to go public. Bunch of these around the world. They are becoming able to make acquisitions, but also able to buy from other startups. So all of these fields, definitely like keep an eye on them.
So I think two things I'm particularly excited about is synthetic biology, and then I also think the amount of investment and focus that's being given towards climate change for the next 3-year period, especially because I think we should all pay attention to this 3-year period or maybe 5-year period where a considerable amount of investment needs to go into that space. But I also want to leave you with one thought. I think while there's been a lot of innovation for money in from crowdfunding, DAOs, all of that stuff, there's also innovation for on the way out. And what I mean by that is exits through things like SPACs, etc. So that's also relatively a new phenomena, right? So, but the caution I would just give is that the market participants need to be aware of the fact that lots of these things are riddled with risk. For example, the SPACs, you've all seen what the challenges are. But nonetheless, and on a positive note, I think robotics, synthetic biology, and space, let's just hope we don't mine the crap out of the asteroids. But it's going to be a lot of fun.
Thank you so much for all of your wisdom, all of your thoughts, and being so open with us this morning.
Thank you.
Thank you all so much.
Thanks.
Take care.
Good morning, everyone. I'm Jo Holland. I'm Australian. I was born in South Australia. So can I just see a show of hands? How many people are Australian? A few. How many people have been to Australia? A few more. Great. So I'm going to talk to you about the Australian UK Chamber of Commerce. The first thing I'm going to say is that when I was 16, I signed up for a workshop in entrepreneurship. And we had a product, we were given products, and mine was a lifting commode chair. And our team won. And we won $10,000, Aussie dollars. You can't do much with that. So that was my first experience. Since then, I've spent the last 16 years, or my first 16 years of my career in financial services. I was the CEO of a trust company and CEO of a building society. And then I decided I needed a break, so I went to Switzerland and did my MBA. And I got headhunted by Arthur Andersen and ended up in London 27 years ago. I just wanted to tell you a bit about that because those 27 or 20 years since, I've been working with private equity and VCs, basically helping their underperforming assets. And what I've seen today with what John said was absolutely amazing in the way that VC has moved and changed since I started my career. So I'll talk to you a little bit more about the Chamber of Commerce. We connect people, we connect businesses, and we connect individuals, and mainly from the UK to Australia, although we have a lot of Brits in our teams and also in our membership. This goes to show about my eyesight. I can't actually read that, so I'm going to have to read. I'm going to have to read my notes. We hold a diverse membership, so we've got everything from the people that play in the deep end of the swimming pool, like the big banks, etc., big British companies, to startups and SMEs, and we mix them all together. We have some very trusted partnerships, so we work with people together to deliver a range of products and services. So they can be anything from various accounting services. We don't deliver themselves, but we have partnerships. So even SMEs we can partner with. We're government connected with the Australian and UK governments, and we work with the DIT very closely here, and we share business intelligence. We also support trade opportunities between Australia and the UK. And I'm not sure how many of you know, but in December last year, Australia signed a free trade agreement with the UK. It was the first free trade agreement for the UK. It was the 17th free trade agreement for Australia. And that means that we're now your new best friends because we have this relationship where we're able to trade with each other in and under an agreement. We recognise qualifications under that agreement. We have innovation under that agreement. We have space bridges, innovation bridges, etc., between Australia and the UK. And I can tell you more about that if you come and have a chat to me later on. We deliver events and strategic initiatives. For example, the Mayor of the West Midlands came to me and said, I want to find people who will invest in brownfield sites in the West Midlands. So we put together a number of key super fund managers from Australia on a round table, and then we had a big party afterwards. We work in all these sectors. I'm not going to go through them all, but they're everything from, space tech through to food and drink. And recently we worked with Austrade to put a food and drink show on in Australia House, and that was to promote Australian product to the UK. So our wines, our gins, and various food items that you will see more readily now that we have a free trade agreement. I want to talk about networking. I'm not going to tell you anything you don't already know. You're here, so you're networking. But what I am going to tell you, what I am going to do actually, is remind you, because I think sometimes we forget, we race from here to there, and we're not really thinking about the power of networking. So it's not only where you can share knowledge and information, but you can learn something new. You can make some good connections, and it gives you more confidence when you're seeking to raise funds. By speaking to more people, you may crystallise your thoughts about your actual opportunity or opportunities for others. You'll gain access to opportunities. I'm actually a private investor myself, and I see huge amounts of opportunity coming through the chamber for SMEs and startups, people that are coming from Australia to take advantage of the EIS and SEIS tax breaks that we have in the UK. And you'll make friends. I did my MBA in Switzerland. I said I wanted a break. I also wanted to get connected globally, and in our class we had 99 people that were selected from around the world, 39 different nationalities. So when I went to turn around a parachute company in Irvine Aerospace Canada in Fort Erie, my good mate Jeff Bell lived in Buffalo, New York, and I'd just zap over to the Peace Bridge and go partying with him. So you make a lot of friends by networking and getting to know other people. There's no right or wrong way to network, but do choose events that are relevant to the people you want to meet. We can give you introductions. Even if they're not part of our membership, our business is to try and introduce you to people. I ask you to be brave and just get out there. Go to every event you can, because you never know who you're going to meet. I did say be selective, but sometimes just do something for fun. Join the dots. I think that's a really important art form, to join the dots. It's very important to be able to connect people and to be generous in your connections. And that leads me on to being generous and being helpful and being engaged. Most of you probably know how to network well, but there might be some of you that find it difficult to network, difficult to just go up to somebody and start a conversation. I think the best way is to ask people about themselves. I ask a lot of questions. I also try and help people with all my contacts. I feel that being generous is a very positive thing to do, and to share all your contacts as much as you can, because it will always come around to be positive for you in the end. Also, exit a conversation gracefully and follow up after all events. It's really important just to have that note to follow up. Again, you know these things. I'm not telling you anything you don't know, but just reminding you. We held an event last month. It was on London Tech Week. I hope some of you were there. We had all the Australian states brought in about 100 companies to London Tech Week. They were SMEs and startups, mainly startups. We held a function for them at Australia House. We had over 400 people. We had people trying to bribe us for tickets, believe it or not, and it wasn't a cheap event in any stretch, but it gave people the opportunity to network. And what we did was we put helium balloons around the room with prop tech, med tech, health tech, whatever tech, space tech, and it meant people could just move over to those areas and engage with people that that had a common interest. So I'm happy to take some questions, but there's our contacts. My colleague Jessica Sullivan's in the room today. We've got a stand out there. We'd love you to come and join, or even just talk to us. We've got a wealth of experience in our membership, people that want to help companies like you in all ranges, in technical areas, but also in matters of accounting and law. So thank you, and I'm happy to take questions. Okay, no questions. Oh, one.
So is joining the chamber, I've been to many chamber conferences in many countries, and they're also always quite helpful. But in this particular context, is it limited to UK companies, for example, who want to perhaps open or look at business in Australia?
Yes, it's really the connection between Australia and the UK. And there's lots of good things about Australia that make it a good place to invest. One of it's some tax breaks in Australia, particularly around video gaming and film. We recently held a webinar about opportunities to invest in Australia in the video gaming sector. 45% tax breaks for companies that want to invest in that sector in Australia. Equally, Australia's got a lot of talent, so a lot of UK companies are trying to drag Australians over to the UK to work with them because they don't have the tech staff.
Actually, we are doing exactly that.
Right, well, come to see us and we can get you some Australians. Okay, I'm not sure if we've got the next session or people are having a coffee break, but thank you very much, and come and visit myself and Jess in our little booth out there. Thank you.
Very much. We are now onto the company component, where we're going to be meeting the founders and CEOs of the businesses here today. So the first one is GISP, and this is Julian Fisher, the CEO. They are a grocery retail brand marketing solution used by some of the world's biggest brands. So everybody welcome Julian to the stage. Thank you.
Hello. Hello, thank you. My name's Julian Fisher. I'm the CEO and founder of GISP. I'd like to introduce you to our solution, which is a retail marketing solution that we have delivered inside stores, convenience stores up and down the country, and are now looking to scale overseas. First thing though, a video. Yeah, so basically what we've done, if you imagine stores are websites and the shoppers are visitors to the websites, what we have managed to do is leverage the physical activity of a shopper engaging with products using a digital solution called GISP. What we've done is we've managed to convert that activity into brand-funded promotions in store, the level of which is now running at many tens of thousands per week. One store in particular recently did roughly 20,000 activities in a week through our application, delivering £16,000 of voucher redemptions to consumers and around £60,000 of incremental sales to their sales total. So our objective is to deliver connected solutions within a physical space, which is worth around $100 billion. It's a new market, retail media market that's come about in the last couple of years. Our company is looking to raise up to $5 million for a 6% stake, and we are raising it over the next 2 to 3 months. Our company is ambitious. We're run by a series of individuals with very significant retail backgrounds, around 150 years it was calculated. We have a number of individuals who are retail influencers, so we have a very, very high profile, punching well above our own weight. Our objective is very much to be the leading unified commerce. So this is a separation from what you might understand is omni-channel. What we're doing is we are bringing about solutions that deliver focused promotional activity, personalized solutions for individuals across retail and wholesale. The problem that we're solving is multiple. It begins with a substantial cost for brands to reach the marketplace, enormous amount of waste spent on trying to establish a promotional activity, very little compliance, if any, and certainly very little data. We've solved all these problems, and we've done so with some very substantial backers. So our trading partners are the top 4 wholesale companies, starting with Booker, Nisa, Co-op, and Bestway. They combined have around £15 billion of business, operating around 80% of the convenience market. Our clients, the advertisers, are all the household brands that we all know and love. At least I hope you love them. The results that we deliver are pretty substantial. In one case, we've delivered an upsell of products in a comparison where there are no solutions available, certainly not from GISP, of around 1,500%. So our solutions are absolutely delivering results for our clients. We recently had a trial with Bookers where they achieved 4 times more shoppers than Nisa. We're about to announce our biggest deal with Payzone, owned by the Post Office, with 24,000 stores, and we just won an award for best use of AR. Hopefully it will catch up. So why GISP? Well, basically because there is an absolute need. There's an absolute need from the viewpoint of brands. There's an absolute need from the viewpoint currently from consumers, with energy costs being so significant. What brands are hoping to achieve is to deliver their promotional opportunities, the discounts, direct to the consumer. And we provide that specific solution, allowing the brands to go direct to the consumer. And again, the retail market of media has been estimated at around 100 billion. Now, it's only a 2-year-old industry, so it is growing rapidly. Our own growth has also been pretty spectacular, with a number of stores that are signing up and joining to use the Scan and Save application. We also have a home delivery and click and collect solution, and the number of users that are joining the application using either the app or the web. Both are available. So the number of solutions that we are providing to consumers is growing. One of the reasons why is that we have a loyalty solution. It's the first of its kind. It was dubbed the Club Card of Convenience, which of course is the Tesco's solution, the most successful loyalty program. So what we're doing is we're delivering a loyalty solution for each and every store, independent of any other store. So you go into a store, you shop, you get your rewards, you spend them in the same store. Quite revolutionary. We have a spectacular, I appreciate it's one of these hockey stick curve forecasts. The margins, the profitable margins in our business are pretty spectacular. And it's all dictated by the fact that we are being joined by a very large number of groups, convenience store groups, who are joining us and want to add their stores, the numbers of which are growing literally week by week. In terms of competition, well, actually there isn't any real competition. There are voucher solutions out there. You certainly can go out and find a digital voucher that you can use, but we're talking about delivering a personalized voucher solution at the time you're purchasing in a physical space. The majority of the providers out there do paper-based coupons. And just to prove it, Mondelez said that they have not seen anything quite like it anywhere else in the world. Our market is pretty substantial, 47,000 stores in the UK, 148, nearly 150,000 in the States. We're going into the States with our partner Omnicom. And our growth over the next, and timeline over the next year to 2 years includes all of these companies. And we're literally about to start moving into what everyone knows is the metaverse. That is the obvious place for our solution. I think that's about it. That's my time. I hope you enjoy. I've got a demonstration, live demonstration, if you want to see the application working on my stand next door. Thank you for your time. Bye-bye.
Here he comes now. We've got a Jay coming up from PLMD. They are a property business that structures, manages, and builds properties across the UK. So I'll let you take it from here.
Thank you. Good morning, everybody. More like it. Let me try again. Good morning, everybody. Thank you, thank you. And thank you, Steve and the team, for organizing this today. This is amazing. And thank you to all of you for coming here on a nice, warm, sunny day, which we are getting a lot of nowadays because of global warming, I guess. So let me tell you about myself. I think the slides are still loading. Okay, good, perfect. My name is AJ, and I am from a real estate background. I am the CEO of PLMD Group. What is that we are here for? We're here for talking about venture capital. We're here to talk about investments. So what's in the mind of the investor right now? Any guesses? I think 8th of July, which is where we are today. This is what's happening in the market. GDP, inflation, high cost. There's things like high volatility. These guys decided to go on a war. And these guys decided to resign. And what happens next? Boris Johnson resigned. And it's all happening in this country, but we all know this is happening around us, yeah? What does that mean? That means a very strange outlook for investors. In times of deep uncertainty, what should we be doing? We should go back to the basics. Buy something that you can hold for 10 years. That's what we should be focusing on. That's what the message we are giving. Now, how do you do that? Let's start with a clean slide. Stock market. Yes, going well, but let's see what happens. Commodities, wow, they're going somewhere. I would not spend time on Bitcoin. We all know where this is going. Hey, so where's the answer? Property investment is the safe way out. Look at this guy. He poses like this to save the investments. That's what he's doing. Now, let me tell you about us, full-service property investment firm. We've done 15 plus projects, so we're not a startup. We're not getting money for something where we're going to try. We have been doing this for a long time. 20 plus years we're doing this, 15 plus projects. This is a high growth opportunity, and we are on a mission to build 1,000 homes. We are a full-service property lifecycle firm. We do project acquisition, we do project management. We do development and construction, so we buy land, we construct. We do estate management, which means we talk to our tenants day in, day out, we manage them, we retain them, we look after them. And PLMD Capital raises capital because we buy this land, we convert them into flats, we retain the clients, we don't sell them, so we need capital, and that's why we are here for. Let me just quickly get into BVP. Beautiful, isn't it? This is one of our recent developments. It's called BVP for Bellevue Place. I call it beautiful because it really is beautiful. We have spent 2 years building it, and it's nice, isn't it, where it is? Let me tell you why this is nice. We bought a land for $750K. We spent 3.6 million building it, and voila, what we have created. 19 apartments, 5.6 million value, 240K rentals, and 22% return. So what are we doing here? We're here to share these returns with our potential future investors. This is some of our developments. Let me get into the problem and the solution space. Housing affordability is very complicated. It's very difficult to manage investments in UK. Legal compliance, a lot of stuff is happening. And then we've been talking about deep uncertainties in the market. What are we doing? We're building more and more homes. This is our solution to this. We're offering passive investment, which means we take money from investors, we manage this investment. On top of this, UK real estate, in my view, offers a very good hedge. Things can go up and down. Boris Johnson has resigned, a lot of things happening, but real estate is still fine. Let me tell you our offering. We are here to raise 1 million. This is the group. If you can see PLMD Estates, we have bundled 52 rentable units, and they're all producing income. I'm not saying, hey, we're going to go and do something, and then we'll find some customers and give you returns. No. This is it. It's happening. It's delivering results. 8% profit share on top of this. Let me look at this offering in detail. 12% projected returns from 50 plus rental units. There's no ifs and buts. This is easy. We are delivering it. It's not like we're going to take the money, do something, then we'll deliver. We are actually delivering it now. Profit share from capital appreciation. Property prices are going up. This morning there was a news, 11.6%. Property prices have gone up in the last 1 year. We're here to share that return. So 12% return on investment, 8% on capital appreciation, safety of returns because you are the priority shareholders, which means you will eat first, then we will get anything. And the best thing, safety of capital. Nobody talks about that these days, but I'm an old timer, so I talk about safety of capital. Where is the safety of capital? Behind the 1 million that you would invest, we would have 2.8 million of our own money on the line. Before our investors would lose a penny, we would lose 2.8 million. Does it get better than this? I don't think so. I haven't seen it. Anyways, this is a construction project. This is how we kind of measure ratings on stock markets. We're going to use this rating for a construction project is WB. So BB, so like risky. If you have an income generating project, the way we looked at Bellevue Place, it goes to A because there's no construction risk. This is their producing income. This is A. Now look what we do for our investors. We get building insurance, landlord liability insurance, rent protection insurance, and amazingly, fixed interest mortgages. So this 1 year, interest rates have gone up 3-4 times already. Am I bothered? No. I'm on a fixed rate mortgage. Our game plan is working as planned. And this is where we believe our investments are. Now, we will use these funds for development projects. We'll use them for improvement of assets and for sustainability practices. We're big into this. On top of that, operational expansion is what we'll use it for, and 2% for branding. This is the time when I come and stand here and tell you about the company. So that's what the 2% is for. Let me move forward. There are 4 major milestones. We're going to be raising 1 million, and the idea is that this would add 10 million to our asset under management. Second big thing is we're adding 35 homes every year, then we increase it by 40% every 2 years. Moving forward, more branding, and the best thing is by 2028, we aim to build a 120 million sustainable buy-to-let portfolio. This is the financial forecast. It shows how we raise money from investments and how we add it to our AUM and what the returns we get out of them. We've got a brilliant team here. There's a lot of us standing here. We are presenting in the stall, so if you want to, please come and talk to us. These are the familiar faces. You would see all of them here. What would you do in a market like this where house prices are going up, volatility is going up, affordability is down? Property is the answer. So if you're ready to invest in something like this, come and meet us in the stalls there or come to our office in Stratford. Thank you.
We have Anastasis, and they're a biopharmaceutical company developing disruptive therapeutic drugs in oncology and virology. And you have Lorenza. Welcome.
Good morning, everyone. Thank you very much for sticking around, and I hope I will be as interesting and exciting as the previous speakers. The title of these slides already tells you half of the story and has been already announced. So what we're trying to do here, we're trying to block the cancer in its progress. I'm sorry, I have to show you this one because we're raising funds. We are raising a large amount, and so our legal department has asked us to have this one on. Oh, this is not. Why it's not working? Help. Here we are. So finally, as decided. So just to give you a brief overview of the organization, we are a preclinical stage company. We are small. We started about a couple of 2 to 3 years ago almost. And we are developing targeted protein-based therapeutics to treat metastatic and refractory cancer that carry a specific mutations. And also a viral respiratory infection. We have a unique approach to the mutations. We have 4 assets that they are proprietary and patented. The patents range from the oldest one will expire in 2024, and the one that we are still waiting for approval for granting will be around September 2041. We've just received one for the US market, US territory, and is due to expire in October 2038, so we are well covered under that point of view. We have a fantastic team. We are small, but we are always very well experienced in both on the scientific side and on the business side. We are here to raise 10 million to support the pipeline and operation over the next 3 to 5 years. This is really allowed me. Okay, so what are the challenges with proteins? Proteins, they are notoriously difficult to get into the cells, into the cell membrane. If we consider that there are about 130 FDA-approved protein-based therapeutics, most of them, they target, what they address is the extracellular target, so they don't go inside. Going inside would improve enormously the possibility, the effect of the drug itself. Now, when we turn, we earlier mentioned in the previous slide, mutations. A cancer, we have a mutation, we all carry P53 and Notch. We all have it. They are actually kind of a guardian angel, if they work well. But at a certain point in our lives, these two can get nasty. They change. And what happens here, they gain an oncogenic functions. In other words, the cells start to really to go wild. We start to have an increased number of cancer cells going around, invade the body, we have metastasis and drug resistance. So this is something that we are trying to tackle. For this reason, we go on to the metastatic and the drug-resistant cancers. And the last one, well, again, the protein could help here. COVID-19 is with us, by the sound of it, it loves us so much that it's not going away. What we are seeing is that with the mutation at the moment we are having, or the variants, as you want to call it, we start to have drug resistance, or the drugs don't work at all. So you end up in hospital, is largely becoming a try and error for what you have. So what have you come up as a solution? We have developed a cell-penetrating platform, and we have demonstrated through the preclinical studies. We have done tons of preclinical studies, so we have all possible imaginable data about it. It works. We can get protein through the cell membrane. The 2 drugs for cancer, addressing cancer, in one inhibit the Notch signaling, whereas in the second program, we deliver a full-length P21 to the P53 mutated cancer cells. And I'll explain in a moment why we're doing this. For the last one, for the COVID, this is a very young project. And what we have, well, now we are trying, we know we can do it, is to inhibit the main protease. In inhibiting the main protease, what we do, we block the viral replication. So in other words, we're trying to stop the virus continuing to proliferate across a body. So we're talking about a transporter, something to go through the cells, to go through the cell membrane. It is an antennapedia transporter protein, or also known among us is ANTP. ANTP, you can see it here on the side, is a three-dimensional. In the three-dimensional image here, we have 3 helix, 2 that run parallel, and 1 is perpendicular. And the perpendicular one is the one that can take the cargo, the protein, the therapeutic protein. What have we found out throughout the preclinical work? So first of all, it's highly effective. We go through, we really tested on a wide variety of cell lines, and in vivo and in vitro, in animals in different conditions. And one very interesting aspect, if we inoculate the ANTP with no cargo, there is no damage to the body, but there is also no benefit, nothing happens. It goes away by itself. Another differentiating point of our way to deliver this protein, therapeutic protein, is that we don't need, it's not receptor mediated. And this, again, it differentiates from whatever is already right now on the market. It can be recombinantly fused or chemically conjugated. So it's very versatile the way we can prepare it. Potentially, we tested with some of the chemotherapies. We loaded the chemotherapy on the helix number 3, and we got it through beautifully through the cell. So potentially, we have a standalone asset that can be used with already existing drugs and transported through the cells. And this would be, we could give us also extra revenue going forward. And when we come to manufacture, again, this is the versatility of this platform. We can do it recombinantly, synthetic or semi-synthetic. So what does the pipeline look like? As I already told you at the beginning of this presentation, we have 2 drugs for cancer and 1 for a viral infection. So S4 is for metastatic, hormone-resistant prostate cancer that is notch mutated. So we are targeting only the patient that they have a notch mutation. We block the notch pathway, and at the moment we are finalizing the pre-IND studies, and the next bit will be an NDA application. AB1 is slightly behind, and what we are targeting here is a drug-resistant colon cancer, that they are P53 mutated. Again, we're going after specific patients with specific mutations. Where before we block, with the S4 we block something, in this case we introduce the full length, the wild type, so the healthy P21 into the P53 mutated cells. And I will explain you in a moment why. It is very important to understand why. Where are we with this? We are optimizing the manufacturing, and hopefully we get to the final stage of the pre-IND studies. Now, ABC is the baby of the situation. It came out because, as we know, the viral infection is still with us, the COVID, and it doesn't look like it's gone away. So what we have here, we have done some tests, enough to file a patent, so we do know that can work. For what we have seen so far, more study will be required. And it is a protease inhibitor. So what we are blocking here is the capacity of the viral replication. Just a little bit more about, I'm not going to go too technical here because I will need hours really to explain you biologically the mechanism behind all this. But the takeaway from these few lines is 1, we inhibit the notch signaling. There are 4 notch within our bodies. We don't go after number 1, number 2, number 3, or number 4. What we are tackling all of them inside the cell. So we are tackling the notch intracellular domain. And this is very important. So it's not that we leave 1 behind or 2. The whole of them are tackled at the same time. With AB1, I've said already enough about it. But as I was mentioning before, what is very important here is that with the full length of the P21, what we are introducing here is the apoptosis pathway. When the P53 is mutated, P21 loses the apoptosis, so the killing of the cells. In here, by delivering this, what we are doing is to restore. And this is very important. We restore the transcriptional function of the wild type P53. So we have a healthy P53 going on. And the ABC is a main protease inhibitory antibody. I think as before, without wanting to go down into the very technical aspects of it, again, what we're trying to do is viral replication out of the way, but more than anything else, what we're trying to avoid is to end up having the mutation-based drug resistance.
I think unfortunately we're going to have to end it there, the 8 minutes. We can continue the conversation outside of you.
Certainly.
And as always, I want to thank all day. That was very good.
Thank you.
Thank you very much. Marcus from Scalable Global Solutions, and what they've developed is the first department as a service, helping SMEs to develop remote working teams. So welcome, Marcus.
Yeah. It's there. Great. Do I need this?
No, you need the pointer.
Good morning, everybody. Can you hear me loud and clear? Is that okay?
Stand by the podium.
Can you hear me loud and clear? Forgive me my enthusiasm regarding this. In case I'm going too fast or so, or too enthusiastic, just forgive me because I really like what I'm doing, by the way. It was nice to come to London here. It's very cold. I came from 36 degrees Celsius, Croatia. So let me give you a brief overview on what department as a solution is. Our motto is das ist out, das ist in. So imagine you have a piece of software and the people with it. So every company has all the departments or all the segments of a company you see there: operations, IT, human resources. And our target audience is companies from 50 to 5,000 people, the SMB and SME market. That's 96% of the world. And they are utterly conservative. If you go to them and talk about outsourcing, they're not interested because they fear loss of control and that know-how leaves the company. So DAS is not outsourcing. We are Croatian-based because I put it there as a market analysis. I'm not Croatian. I don't speak Croatian. I'm German. I don't have a Croatian heritage. I just simply made an analysis from the Balticum down to Turkey. What's the best country to start out as a service for my clients? Croatian was the clear winner. So the customer can build his own departments into Croatia, the same way as he builds his own departments in his company. So he gives HR the requirements, what he needs, so he gives them to us. We search for the people, but we don't interview them. Our client interviews the people he likes. Know-how, competence, expertise, skills, and cultural fit. When he says these people are good enough for him, we hire them on his behalf. We deliver the whole service, the whole office, infrastructure, laptop, but anything on the laptop comes from his client's IT for data security, data compliance. So to their own employees, they look as employees, even though they sit in Croatia. And then they go off to the customer after we hired them. He trains them completely. And when they come back, there's nobody in SGS Croatia who tells them what they have to work on. Why would we? It's the department of the client. So one of the largest Microsoft Dynamics and SAP integrators in Europe has started to build his development team in SGS. We are about to sign one of the largest IT integrators who just won a bank project for 145 million in Germany, who wants to put this entire development team in here. We have an automotive supplier who wants to build between 50 and 150 people into Croatia. All our contracts are 36 months, automatically extending by another 12 months. But we not just deliver the people, we also deliver the software. Now all the big players, SAP, Oracle, Microsoft, Salesforce.com, are feature-rich. Their target audience is companies with tens of thousands and hundred thousands of employees. One of my customers sits in the Black Forest. He has massive problems for efficiency, winning top talent, and driving efficiency. They have 1,200 people employed in China, Italy, and the Black Forest together. 1,800 sit in production, 1,200 in the overlay. So if you go to the head of sales globally and ask him what system he uses to manage the sales team, the sales forecast, his answer is Excel, because he has 7 people for the 140 million turnover organization. Then I walk from him into the office of the head of HR, where his team of 4 assistants are sitting there. And they have hired last year 70 people in 40 different disciplines. So I've asked him what system he uses for his repository for every job when people apply, or how does he manage the entire onboarding process. And with a swollen breast, he says, Outlook. That's the typical SME customer. They don't like the big companies because they cost millions in customization, millions in adaptations, license fees are expensive. They use 1% out of the million features but pay for all the other features and have high resilience to implement this in their organization. SGS1, which is our software, which we program by ourselves, look at it as a super light version of SAP, Oracle, Microsoft. Implemented in weeks rather than months. Used 80+% from day one, 30 to 40% of the license fees, and only the features that the client actually needs. So if you combine software to optimize the processes and people defined, selected, trained, managed, and operated by the client together, you delivered a long-term business process optimization. We usually reduce the cost of operations by up to 50%, increase the efficiency by a minimum 15%, to 25% through the means of people and software. We call this the future of employment. Possible made by Corona. I had the idea to this in 1998 when I was sitting in San Jose in the Silicon Valley, and John Chambers, president and CEO of Cisco, where I work, gave the following speech where he said, one day the internet will change how people work, live, play, and learn. I just thought I'd take this idea a step further. So the customer retains 100% of control, no outsourcing, no loss of knowledge in-house, legal and compliant, 15% more affordable talent, and SGS1, the CRM solution that is just tailor-made to the size he needs and not bigger. That's an example out of the software where you can do project management, human resources, sales, finance, controlling, etc. If I would have shown this presentation 3 years ago, before every one of you ever heard the word Corona, the target addressable market on my presentation was 110 billion worldwide and 24 billion for Europe. Then Corona happened. Our target audience is utterly conservative. They never have outsourced in the last 30 years. But a little virus, since the 27th of March, 2020, forced any company, 96% of the global market, to have people work from home. Now, when you discover that your controller can work from home, not even the same quality, even better, well, then he can work from Croatia, where it costs you 50 or 60% less, right? Same for sales, IT, marketing. So between Corona, that went to 300+ billion. Now it's at 630 billion. And it went from 24 to 140 billion right now for Europe. And the prognosis is for 2024 to go to $1 trillion for any investment in technology supporting future work-life initiatives, which department as a solution is. If you would have invested into the company 2 years ago, the share price has doubled since a year before, and now the share price has doubled since today. The company is a stock-registered corporation at the SKDD, which is the FEP in New York for Croatia, but not public trading, privately trading. We see ourselves in the top right quadrant when it comes to service all departments and 100% control of operations with the customer. No other company currently has this today in the world. The easiest way why I can make this statement is when we make an offer to a client, in a normal bid process, you've been told, thank you very much. When we have the other offers in, we continue the conversation into the second, third, and fourth round. This conversation in the sales cycle never happens with us, ever, since we started. The company will be breaking even by the end of this fourth quarter this year. We currently grow at 22% month over month. We are about to sign 2 major deals, which will probably put this in the double range month over month. Last year we had Corona. So as much as Corona will be the accelerator going forward now, it was a hindrance at the beginning, because when everybody of our clients was hit with Corona, nobody knew what to act, nobody knew what to do and how to react with the situation. But that has dramatically changed. Now our clients giving us references. So we're signing a customer. We had yesterday an interview with the CEO, a discussion with the CEO. They want to implement 30 people. We have an automotive company that wants to implement 50 to 100 people in 18 months, starting somewhere in September, October this year. We're signing this provider I said before. this month, which will build up 10, 20, 30 people. So the company will definitely hit break even Q4 this year.
There's plenty more to discuss, but we've got to be brutal on the 8 minutes, I'm afraid. And we've got
10 seconds?
10 seconds, and you can time it.
So this is an old dated presentation because we made that last week. It's now 4 clients. Next week we'll have 5 clients. We raised 845. We pre-money evaluated 10.845 million. If we sign any of the 2 aforementioned deals, which are by its way 2.5 to 5 million per year, the evaluation will go beyond 15, most likely to 20 million. I would love to talk to you if you have more interest later in the day. And thank you very much for listening to us.
We've got one more before the morning tea break, so hang around. We've got Dovidas coming out now from Transcount, and they are building an eco-friendly SaaS product to help with small logistics and micro logistics. Dovidas, welcome.
Hello everyone. Super exciting to be here today. And having this opportunity, I would like to introduce myself and my startup. And all my professional career, I have been in various roles, managing transportation, logistics, and procurement companies. And today I would like to talk about logistic digitization problems and challenges and the solution we are bringing in. What started as a tool to simplify documentation management workflow for my own logistic company needs, finally it grew into a new startup in 2017. And today, Transcount is innovative software built to empower the digital or paperless transformation of micro, small, and medium-sized procurement, logistic, and freight forwarding companies, and simultaneously support the fight against the climate change and global warming, and especially deforestation, by moving businesses into a paperless solution. Digital transformation is a very costly thing, and especially for young and small companies that are lacking the resources. To build a business digitization software can cost more than 200,000 euros and above. And globally, only 7% of businesses have fully implemented their digital transformation, while the rest companies are still managing manually their business operation using office tools, equipment, paper sheets, and different type of in-office printing material. It creates a slow, repetitive, and ineffective workflow, decreasing company cost efficiency and profit, and even causing a high probability of business to fail during the first years of activity. And to solve this problem, we are bringing in the Transcount, a solution that will be the world's first eco-green software as a service to digitize logistic and procurement businesses via a fully software integrated and single user interface dedicated website. It will allow to use all the benefits of a digital freight forwarding. And firms will now have to use their business workflow manually. So let me explain how it will work. It works exactly. Transcount allows companies willing to became a digital freight forwarding companies to use a fully software integrated website and I'm sorry. Yeah, and the users will be able to use a fully software integrated website, and through the single user database. I'm sorry. and they will be able to use all the benefits of a digital freight forwarding company. The single user interface will allow to create networks and communicate with the customers and carriers in real time and share paperless documents and use the power of big data to make accurate predictions and improve performance and drive cost effectiveness. Our value proposition is built around our paperless and digital e-doc solution, and also a real-time shipment quoting and booking tool, and also AI-driven website. Our unique paper company pricing model enables companies to save on subscription fees while they grow with us, and also our customers gain eco-green status by moving onto web-based page integrated, fully integrated by our software. Our solution can reach also broader audiences, not only logistic and procurement companies, but also shipping department companies and trading companies can use our software. Our profile of our client is micro and young companies, small micro companies, logistic and procurement businesses, and also the shipping departments of existing companies that growing sustainably and looking to implement a digital transformation. It is estimated that there are 40 million companies, businesses in the world that suits this description. Our software offers different subscription plans, and the average annual revenue per customer is 1,200 euros, which makes the total addressable market more than 17 billion euros, and the total serviceable obtainable market, including the 1% penetration ratio, provides us with 170 million euros worth of market obtainable in 5 years. Transcount is a new improvement of existing solution, operating in a very competitive environment where a lot of both commercials and technical risks are included. And enough to say that our team has enough technical skills and experiences to mitigate those risks. However, our company needs to enter the market fast and scale because the competitors can kick in the market. We didn't find any turnkey solution that describes our product as digital freight forwarding software market. It doesn't simply exist yet. Competitors offer transportation or freight management software, ERPs, but these only cover 60% of functionality needed to deliver the digital freight forwarding. And the digital freight forwarding companies like Flexport, Zencargo, Turvo, they are using their own proprietary software unavailable for sale into the market. Our competitive advantage is that we are approaching our customers with a unique and individual approach, offering a digital customizations opportunities, and our unique single price solution allows to. We launched our MVP in 2017, and a few years later we launched our product, and more than 1,300 companies signed up for our demo version, and currently we have 27 companies using our product. More than 300 companies are still testing and providing available support for our game. Can I just
run them through it outside, because I've got to be strict on the 8 minutes for everyone, unfortunately, otherwise it'll just get inconsistent. But sure you can run the numbers outside at morning tea.
Okay,
So that
thanks
is the
so much.
end of the morning session. Thank you, everybody. You can pop outside for a
Thank you
coffee,
so much.
snacks. Thank you, Dovidas. Thank you, everybody. So we'll be back on in about 20 minutes. In the meantime, go and enjoy yourselves outside. I'll introduce him now.
Oops. Oh. Is it okay to start? Yeah. Hello, good afternoon. My name is Marcus Paletti. I'm the founder of a global business called Loretti that is going to own the passenger experience economy. What do I mean by passenger experience economy? The future of mobility is going to be connected, digital, and on demand. We're looking at the evolution of a $1 trillion market where Loretti is at the forefront of this emerging space. But passenger experience has been neglected for decades. Corporate travel in general is suffering from productivity loss, the impact on health and wellness, as well as costly bills, and they're desperately looking for a solution. Travel in general is unproductive and fragmented, especially when an international trip with multiple legs of journeys involved. The rise of on-demand mobility and decline of private ownership of cars, and especially the role of AI, autonomous technologies, and advanced driver systems are minimizing the role of the driver and putting more emphasis on the passenger. At Loretti, we believe that mobility can be harnessed as a useful tool rather than a stressful necessity. Our vision is to create that passenger-centric future that is seamless, productive, and accessible. So we are building a mobility ecosystem that is going to give back the richness of time to people, where you can be more productive, more effective, and more energized while going through complex travel schedules with the least effort. Our solution will make mobility to be as useful and personal to you as a smartphone that's become indispensable in your daily lives. But we go one step further. Your experience will not be tied to a single device or a single vehicle, but portable to multiple, any vehicle that's powered by our technology. I'm sure this is something that you're familiar with. This is what you're used to today, and let me show you what Loretti is about. Yeah, the video.
Meet Clay Wilson, a successful LA-based entrepreneur who runs a global tech firm. He is a frequent transatlantic flyer and also uses Loretti's vehicles as his fleet across multiple international cities. Loretti's vehicles come with a passenger-centric technology that acts like a satellite assistant and supports Clay's mobility needs throughout his trip. Let's see how that works. Today, Clay has arranged meetings in London and Madrid and back to New York, all smartly integrated with Loretti's technology, which prepares an itinerary in real time with options for the best way of accomplishing the entire travel in the most convenient and effective way. When options are ready, Clay takes one good look, et voila. On the day of travel, as he finishes his breakfast with his family, his Loretti watch alerts him to the Loretti fleet service waiting outside. The vehicle recognises Clay as he enters and informs him of the journey time to the airport. The ambience and posture are automatically adjusted to suit Clay's physical, mental, and emotional state. During the journey, he decides to fine-tune his presentation for meetings and access his work data without the need for carrying a laptop. This is done through a simple authentication process through the interactive screens before him. We also see that the vehicle's rear seats are ergonomically designed to comfortably accommodate the work mode seating. These large format screens are robust and adjustable, used for entertainment, communication, connectivity, and much more. The vehicle system can also inform if there are any delays en route. As he exits at the destination, the system confirms that any of his personal data is automatically removed from the system memory. After a long flight, Clay has now landed in London. Gentle vibrations of the watch guide his movements and accurately navigate to the car waiting for him outside the airport. With almost an hour journey ahead to the destination, Clay dozes off, and the connected seat gently adjusts the position to help him relax more comfortably. All of this happens in the background, with no interruption to his sleep. At each destination, Clay never had to think about the details of each leg of the journey as we do today. Now you may wonder, how do Loretti vehicles provide such great features of wellness, in-vehicle experience, productivity, connectivity, and most of all, high-level data security? The secret is that all Loretti vehicles are operated by its centrally integrated operating system called Mira.os. From vehicle design to technology, the central theme of Loretti is to provide a unique, efficient, and enjoyable passenger-centric mobility experience that goes beyond its vehicle door.
In order to create this experience, our solution is a combination of hardware, software, and service elements. This is Mira One, our flagship vehicle. This is your business lounge on the move, where you can relax, where you can work, and indulge yourself if you want to. So in addition to Mira One, we will roll out the basic entry-level experience across taxis across the globe. And over the next 3 years, following 3 years, we will roll out this experience in multimodal transport, planes, cars, and other modes of transport. In order to create that fully seamless experience from end to end. An example to that is Icona Group, who is a multi-billion-dollar contractor for Hyperloop and SRE, which is a maglev train, and as well as smart cities. They see the value in our technology to bring in that connected application across smart cities connecting with multimode transport. And the technology behind all of this is a globally connected ecosystem called Mira. It's an operating system, and that is what is enabling that passenger experience both inside the cabin and also providing that experience beyond that vehicle door as well. And it's also the technology that powers the multimodal transport in 3 years down the line. So this way, every Loretti user can connect to every Loretti vehicle, and every Loretti vehicle can connect to every Mira user. Our development model is asset light. Oh, sorry. We are an asset light company and partnership based approach. What that means is that we don't have to spend a lot of money in building factories or on expensive engineering programs. Instead, we partnered with several of these companies where we house ourselves or co-locate within their facilities. The purchase interest we got so far from sales and purchase orders from governments validates our roadmap to $1 billion in 18 to 24 months' time after the pilot. Recently, white papers such as Innovate UK and other white papers that came out of focused on mobility talks about the connected journey and passenger experience, etc., and that strongly validates our thought leadership. And lastly, we have 200 plus years experience coming from great companies, renowned companies across the various industries. I know the time's running out. But lastly, though, you have companies like Apple, Sony, Huawei, etc. And these companies are now focusing on mobility, especially electric vehicles or autonomous vehicle programs. Why is this? Because they understand the future of mobility is not in the hands of the traditional players. The future of travel is not about just getting from place to place. It's about making journeys work for people. And Loretti is your opportunity to participate in the emerging passenger, to own a piece of that passenger experience economy that is going to dominate for the next 100 years. Thank you for your time.
Perfect. Thank you. Next up, we have Derry from Raglan Country Estates. So welcome, Derry.
I want one of those cars, don't you? I think that looks pretty sexy. Now, let me just check. Apparently, I just pressed one button, so I can't go wrong on this. And we're away. I believe there's never been a more important time in human history to create environments around the world where people, and humans in particular, can connect back to nature. Connect back to themselves and connect to other people. And we've created spaces to do just that, all over the world. Welcome to the houses of Earth. And there's no lack of opportunity in the marketplace to do this either. The leisure tourism market is huge, it's multi-trillion. The actual tourism market within it is billions. And in the UK alone, just in the holiday park market, which we are on the periphery of, it's a nearly $10 billion market now. It's also rapidly increasing, last 5 years of 65% up in revenues. It's the staycation boom, which we're all aware of. Thank you, COVID. COVID's helped in some certain instances, right? The difference is this was already on a boom since 2010. It's nothing new to COVID. COVID hasn't done that to the industry. The problem with the industry, as you could see in the previous slide, is it's stacked full of caravans, very inspiring wooden cabins, and it's driven at the high end by private equity guys who are stacking them higher rather than doing anything nicer. We've done big international research on this. The issues of the industry is massively fragmented, lacks consistency, lacks identity, and there's quality issues everywhere. You just don't know what you're going to get when you show up to these places, right? And the opportunity lies in premium resorts, high-end facilities, mixable activity ranges, but done properly. Local in its intent, but global in its impact. We would take it further than the research, looking at future trends, the future trends in green, the future trends in affordable luxury, and also bringing health and well-being at its core as well. Therefore, we want to be doing a back to nature focus, which is creating a new genre within a genre that's already there, with sustainability and green at its core, not a whitewash that sits on the side. So, how do you differentiate within this space? We believe in 6 core pillars. We built everything around back to nature, green, quality, hostmanship, local focus, and deep experiential. Now let's look at what that actually looks like, okay? First of all, we needed to redesign the genre because we instigated a global research on designs of cabins and units. And to be frank, after we've done about 3 months worth of work, we decided to build them ourselves because it was pretty shit out there, what we saw. And also, it was just getting worse, by the way. We're in an innovation conference. This industry is lacking innovation on so many different levels. So we went back to the drawing board, and we designed our own. And that's what we've come up with. We also designed them with aesthetic nature. They need to look beautiful. It needs to fit within nature. It needs to be 100% energy sufficient. We've got solar roofs, vacuum solar roofs, ground source heat pumps. So we've really pushed the barriers of what the innovation in all of the units. We've built in water technology, no foundations, no concrete. And it's taken a while to do that, but now we've built them. Now we're ready to go. We've got planning permissions, and we're really still pushing the boundaries of what's possible within this genre. Now, we're also bringing the interiors up a notch. I don't know if you've all experienced some of these holidays interior designs. It's hardly inspiring. We've worked with the world-class interiors to bring nature back inside as well as outside. And we're going to continue to push the boundaries in design. I'm particularly excited by the one on the left as we're pushing this into phase 2. As we continue to push, because I think this whole industry is just prime for innovation and aesthetic design. Now, we're not going to do any greenwashing here. We've got a huge green pledge. We are measuring ourselves off all of the 17 United Nations Development Goals. We actually tick all 17. We also have a tool to measure our impact on this so we don't whitewash this area. In fact, I want to stand up in this area for something new and actually prove and measure the impact that we're having. This involves a full rewilding project across our first site, which includes 227 acres of rewilding. So it's not just myth and legend and something we're thinking of, we're doing it. We're already deploying. The first site is on the Welsh borders. It's nestled in between the Wye Valley on one side and the Forest of Dean and the Brecon Beacons on the other. For those internationals in the room, you just have to understand it is beautiful countryside, arguably some of the most beautiful in the country. It's also within a 3-hour drive of London. It takes you 2 hours 15 to get there, which is quite important. So it means that you've got the shorter breaks as well as the longer breaks, and the stats pick this up. And this is the plan. We've already got, the master plan is fully submitted for the 227 acres, including leisure, tourism, rewilding, agriculture. Everything you eat on the site is grown on the site. So we have to join the dots up across multiple parts of this industry. We got the first 15 units planning permission are ready to go, and it's ready to build. And we're already working on the next genre of the next 35 units, which will include different designs. That'll be ready by Christmas. So we're ready. We're ready to go. Infrastructure is ready to build. As soon as we build them, Landals will fill them. We've actually signed exclusivity with Landals, Green Parks. That is the largest distributor of high-end holidays in Europe. They own things like Wholesale, cottages.com, etc. They're one of the biggest distribution agents. So we've got confidence in them. They've already got all the stats. They've got the reach. So we don't take any risk on distribution. We focus on what we do best, which is creating incredible experiences in back-to-nature environments. They've got all of the unrivaled performance in this space. So we've partnered with the best who are delivering the highest end results, and they have a sustainability agenda, which was quite important to us. So they're not greenwashing either. We have a full management team ready and deployed. So I'm very blessed to have Magdalena Sartori as Chief Creative Officer globally. She built 600 million of real estate out of New York with the assemblage, which is anyone that's from the New York state will be aware of. And the Chief Financial Officer, Alan Rowley's been 30, 40 years in the industry, done multiple IPOs, and very heavily involved in the PE space, which is a natural exit for us. As you can probably be aware, the PE space is very hot. We've got an incredible advisory board. Michael Pask has been a leader, head of IMG globally in leisure space, so we've got very good skill set on the leisure side of things, because actually creating a back-to-nature leisure, which doesn't involve plastic, is quite difficult. Savills, ex-board member Sean Gillies, guides us from a property perspective to make sure that the land and the structuring is done right. And Vishal Panchani is in the PE space. He's put $500,000 of his own capital in personally. He backs this project so much. There's 2 other people I can't actually show, which are quite titans in this industry. I'm not allowed to publicly talk about it, but come and talk to me and I'll tell you who they are secretly, okay? We've also got a full management team deployed. So on the first site, which is the House of Raglan, we've brought in Glenn Lewis. Glenn has been in the industry for 40 years, incredible talent. He leads talent, hospitality in 5-star environments and has done for years. He was ex-MD of the Celtic Manor, and we poached him quite well locally. So he knows the local environment, he knows the local talent, and he's actually there to deploy 5-star quality. We've got the head chef, Adam Whittle. He's arguably the best chef in Wales. I don't say that lightly. He literally represents Wales in chefing, and he is awesome. So please come. The restaurant's open, the cafe's open. We've got a 9-hole golf course, and it's already ready to go. So you're all welcome. I don't play golf, by the way, so don't judge me on that. So we've got all the rest of the management team is already deployed, and we're open, and we're ready to build the units. So what do the financials look like? The first 3 phases, the first 2 phases in particular, is a £15 million project. We've already raised 2 million and we've deployed it. We've got 10 million pounds of the debt secured, and we're literally concluding this round on this site for the first few million. So there's a 3 million raise in this raise. We remain open. This is a complicated structure. There's assets behind this, as you're probably aware, and yet there's an EBIT multiplier. Those in the room, we're open to debt equity blends, so please come and have a conversation on if that works. This is site 1. There is another 10 sites in the pipeline. So this is our prototype site. We want to get this right and we're ready to deploy. We've already got pipeline for the next 3 in the UK, but it's also international in its deployment. We're looking at North America and several other topical sites. I was talking to someone earlier about Portugal. There's different structures available to this. Although we've got an equity raise, and this can be a pure equity round, we are open. We're having conversations about convertible loan notes as well for those in the room who are interested in other alternative structures of investments. We have incredibly detailed financials available. We have done full due diligence to get the debt with both private equity sectors and debt sectors. So any of the Excel jocks in the room, you're welcome. We can take you on a magical mystery tour with that. But the most important thing is this is an EBIT driver. We are now confident we can do year 6 projections in year 3 because we've speeded up planning. So by the end of year 3, we're expecting 8.3 million EBIT at a 12 multiplier. That equals about 100 million asset on the first site. And within that, you will find we've got evidence that sales in this sector in the last 9 months are going at 16 to 18 multiples. So we've been pretty conservative in our numbers on that. Okay, thank you very much. I'm out there. Come and see more pictures. Thank you.
Perfect. So the next one we've got is Fennec Financial, and we've got Max speaking from them, who's the executive director. So they are a next-gen banking platform as a service. Thank you, Max.
Thank you. Thank you. Good afternoon, everybody. So all large financial institutions and corporates have multiple banking relationships, and they do this for 4 key reasons. First of all, they need a series of banks that they can have some competitive pricing with and a range of services, because not all banks provide the same range of services. They need suitable geographic coverage for the areas in which they operate in. They need to mitigate their cash concentration risk, and they need to diversify their sources of funding. And in addition, I need to press the button, don't I? There's a button somewhere. In addition to that, all large organizations are effectively payment and collection factories. So that every year they're dealing with millions of transactions, both in outgoing and incoming payments. So if you put those factors together, which is multiple banking partners, multiple accounts, millions of transactions, a range of services from the banks that don't even talk together, you have a real problem. And that problem is this. How can I track what's happening across all my multiple bank accounts with my multiple banking partners? How can I manage my liquidity needs across all my trading entities? And how can I best orchestrate and manage all those payables and receivables? So hello, my name is Max Pell. I'm from Fennec Financial, and I'm here today to talk to you about the next generation corporation banking platform that we've built specifically to fix this problem. Okay, it's gone back. Okay. It's the big button. It's very easy. There's a very big button, and I'm pressing the small button. So there's been an awful lot of investment in retail banking, but until now, there's been very little innovative investment in corporate transaction banking. So what we've done with the Fennec platform is we've taken the technology and functionality that normally sits within the bank, we've stripped all that functionality out, and we've created a banking platform as a service that sits within the corporate. And this allows our customers to manage their relationships and interaction with their multiple banking partners in a one consistent, true digital manner. So the current lack of a single unifying platform to address the challenges of managing multiple banking relationships give rise to a series of inefficiencies which cost these global corporates £30 billion a year, year in, year out. And if you combine that with the very high cost of the run and change of banking technology platforms, that gives you a big problem in terms of it's an inhibitor to change and it's an inhibitor to innovation. So what we've built is we've built a next generation banking platform, which at its infrastructure layer, which is the bottom layer on this slide, is powered by smart contracts. So they capture the details of the transaction, a series of entity models that you can then, using business rules, machine learning, and AI, map those transactions to. And this in turn allows us to create various digital ledger views for our clients. And all of that data is stored within a data lake, which means it's very easy for audit trail and reporting. And built on top of this layer are connectivity layers and application layers to create an industrial strength platform. The flexibility and configurability of the platform allows us to take our customers on a strategic journey. We can start with a single pain point and then add on more functionality over time. So we could start off with a simple account setup, move on to managing more large-scale payments and transactions, look at managing group liquidity, and then utilising our API hub, which allows our corporate to connect to all their banking partners. Or we could do it in a completely different order, depending on what the need of the corporate was. So in terms of our go-to-market strategy, where have we found early traction? So we found early traction in providing our platform as a software's infrastructure within to power high-volume digital solutions for payment institutions. And I'll talk a little bit more about that when I come to the use case slides. We're already moving into the broader financial services, deploying a wider range of the platform capabilities to create some pretty sophisticated solutions. I know what we set the business up to do is to provide a full in-house digital bank for corporates. In addition, in the medium term, we see the opportunity to build standalone treasury and cash management products on the platform, which will serve a smaller market, so the small to medium-sized corporates. So in terms of our traction, since 2020, we've secured 10 contracts, and we've grown our annual recurring revenue to 525K. These tend to be long, sticky contracts, so the total contract value is at least 2.5 million, and we have 4 million of opportunities in the pipeline. So let's try and make it a bit more real for you. What do you do? So I talked earlier about taking our customers on a strategic journey, landing on a pain point, and then expanding, and these two clients are really good examples of that. So Brinks is a global cash-in-transit business headquartered in the States, and in 2020, Fennec was commissioned to build them a new cash payment network in France, allowing payments in cash for bills and e-commerce purchases. So what our platform does is it links the tills of over 6,500 local points of payment, such as convenience stores, and then the Fennec platform integrates with multiple EPOS systems, and it orchestrates all the payment flows, calculates commission splits, and manages the reconciliations. And since we won that original contract with Brinks, they've awarded us 6 extra contracts. PaySafe is a global payments institution with multiple trading units. Fennec was selected to build an FX hub for all their global trading businesses, and that centralizes, models, and executes all their FX trades. And again, since winning that contract, they've given us 2 further contracts. In terms of market size, the global addressable market for digital corporate and transaction banking is 20 billion, and we can see a credible path to securing 300 million of that revenue just within Europe. In terms of the competition, it's either primarily older legacy technology providers who are focused on servicing the needs of the banks, or it's newer players who tend to be more focused on the needs of the treasury. And what they don't do is tackle this hyper-automation and orchestration of payments and finance. So what makes us different? What fundamentally makes us different is our radical approach to solving the current challenges facing corporates trying to manage their multiple banking relationships. By placing our platform at the heart of the customer rather than in the heart of the bank, we empower our clients to take control and focus their management time on what really matters to their business. This philosophy flows through our design and architecture of the platform, and we deploy the latest smart technology to provide the greatest power. And finally, in terms of the people and the team, we're a group of very experienced technologists and corporate transaction bankers, and we've all come together to solve a problem that wasn't being solved and addressed in the market, and that's why we created Fennec. Our commercial model is an enterprise SaaS model. Most of our revenue comes from a license fee, but because we do deep integration with our clients, we also have a substantial amount of revenue that comes from the implementation. And because we are embedded deep within our clients, we see the opportunity to get more revenue for the existing contracts by upgrading, winning new contracts, as we've already proven that we can do. So this is our first institutional round. We've only raised small angel rounds before. We're raising 5 million, and you can see on the slide that the areas that we're expending to spend that cash. Now, if we spend that cash, this is the forecast revenue growth that we expect to be able to deliver in that time period. So with 17 seconds to go, which is quite good, I'll just put up the kind of elevator pitch slide which covers the things I've talked about. It's a banking platform for corporates to help them manage their multiple banking relationships. We're revenue generating, it's a large market, and we're looking to raise 5 million. Thank you very much.
Hats off for being bang on time there. I was very impressed with that. Nailed it. Okay, next up we have Adam from Just Fix. And Just Fix basically look to connect you to local tradespeople who can help with your urgent needs. And I'll let you take it from here. Cool. Thank you very much. Your mic or the thing up there.
Is that working? Yes. Yeah, we're here from Just Fix, and Just Fix looks to be the only app you need to get home maintenance issues sorted in your home. If you'd allow me to paint a picture, I want you to kind of imagine or cast your mind back, because I'm sure we've all had a similar situation like this at one time in the past. Imagine it's the middle of winter and your boiler's broken down. All of a sudden you've got no hot water, you've got no central heating, or you come home from work late at night and you're locked out, or you've burst a pipe and there's water pouring in through your ceiling, or your washing machine's on the blink. These kind of miniature household emergencies, which aren't, real emergencies, but are time critical and are quite stressful, happen all the time, all over the place. Now, if I was to ask the audience what you would do in one of these situations, how would you find someone to come and fix the issue? If I was to ask a dozen people here, I think I'd get a dozen different answers. There's not a single recognised go-to solution for these urgent home maintenance tasks. You might go on Google and have to trawl through a number of different websites of variable quality. You might ask your friends. You might go to social media. You might go to one of the aggregator solutions, which have long, drawn-out, complicated processes with no guaranteed result at the end. And indeed, you then have to put your details into a black box and wait for people to call you back. What we're trying to create is a really frictionless, really intuitive, fast solution that answers those urgent home maintenance needs. So as I say, you've all experienced the situation, and a lot of these tradespeople, they're busy. They may not be available. They're not necessarily the best at communicating. And if you do find someone through recommendation, you've got no guarantee of the quality of that tradesperson's work. Do they have the relevant qualifications and insurances? What happens if it goes wrong after they've supposedly put it right? And I don't believe that the current solutions are fit for purpose. The reason I started this business was because I had a situation like this myself, and I couldn't believe in today's day and age there isn't an Uber-style solution already for fixing urgent home maintenance tasks. Why isn't there an app that I can just pull up, tell them where I am, tell them what's wrong, and have a frictionless journey to someone coming around and putting it right? It didn't exist, and that's why I started Just Fix. So we aim to take the stress and anxiety out of finding tradespeople when you need them urgently. And we're focusing on speed and urgency in our first iteration because that's where we beat the competition. All of the aggregator solutions that I've described, none of them are set up for the urgent. They're all more optimized around longer consideration cycles, slower processes. Kind of okay if you want to get 3 quotes to get some building work done. Not okay if you've got water pouring through your ceiling. So our vision is to be the fastest, most trusted solution to urgent home maintenance needs. By winning on urgent, which demonstrates our commitment to speed, we can then occupy the strategic high ground in our customers' minds. If we can be known as the fastest, why wouldn't they use us even for non-urgent tasks? So we will also build out the same marketplace for non-urgent tasks, but we're competing on the urgent in the first place because it proves our point. Our customers are app savvy, they value their time, they expect a better user experience than is currently provided for. And that's what we've built. A really streamlined, really straightforward, frictionless process that enables you to just put in your location, tell us what's wrong. When a fixer's on their way to your property, they drop a pin and you can see their progress towards your location, so you know exactly when they're going to turn up, because how much needless frustration comes through when we just don't know when they're going to arrive. They say they're going to be here at a certain time, they don't turn up. That lack of communication adds to the stress. We wouldn't mind that they were going to be a bit late as long as we knew. And these people, they're busy. Communication isn't necessarily their strength. So if we can help them by providing technology to automate a lot of this stuff, it's a win-win on both sides. So we're creating a stress-free situation, and through the use of technology, but also the use of language, the use of color, the interaction design, everything about our experience is around reducing the anxiety in an already stressful situation. Ultimately, this is a two-sided marketplace. We're building the supply side first by getting fixers on board in the locations, and then once we have critical mass of fixers in a location, we tip customers in. Converting the demand side is actually quite easy. There's people searching for these terms up and down the country on a day-by-day basis. And the beauty of using paid search in the early stages to build the marketplace is we can load balance that demand based upon the supply we have on certain trades in certain regions. So we can build that flywheel really effectively. In terms of the market size, our total available market is 282 billion. That's the global home services market. I actually think it's a wider market than that, because once we've built the platform, once we've got the customers, once we've got known for the experience we've got, we can branch outside of just home maintenance. Could be IT support, could be car repairs, could be anything that requires someone to come to your home. In terms of the UK market, $7.5 billion. And if we can just achieve a 2.5% share of that market, that gets us to 140 million in revenue. We have a working MVP which launches this month, literally as we speak. It's going live and we're putting revenue through it. We've done a few tests. We'll be revenue positive this month. We think we'll be at 10k per month revenue by September, building to 20k per month through January. So we're early stage, but we're not pre-revenue now. Our revenue model is primarily based upon commissions. So we'll take 15 to 20% on average based upon jobs going through the platform. We will also be providing video triage, so someone can get a remote video call with a video qualified fixer for things they can fix themselves. There's a number of things that you could do yourself if you had someone qualified talking you through it, which is an even quicker and cheaper solution. There's advertising opportunities to advertise to our fixers, and there's insurance products such as providing tenant and landlord insurance, home insurance, and we can provide instant settlement if you take on the Just Fix insurance products. So we're trying to occupy this position a bit like the AA in terms of the fourth emergency service, but really it's that Uber-style solution of just making it really, really easy to get things done and taking out the competition of all the other recommendation sites, because I believe that the branding, the user experience, the business models are all from a bygone era, and there's a real opportunity for this in today's day and age. So that's Just Fix. We aim to be the fastest, most trusted solution to urgent home maintenance tasks. Myself and Jim are in the corner as you walk in through the doors on the left. If you found this interesting, please come along and say hi. I'd love to talk to you more about it. Thank you very much.
Coffees perk people up. We're back on time. It's good to see. Okay, next up we have Alistair from Newpath, and what they are doing is creating a marketplace for recycled mobile phones in underserved markets. So welcome, Alistair.
Hi there, I'm Alistair Chesney, founder and CEO of Newpath. Newpath's trying to make smartphones more affordable, and we're doing that in two key ways. We're offering refurbished phones, which are 40 to 60% cheaper than a new phone, and then we're offering those phones on installments. And the propositions combined with patented technology, which can gradually reduce the functionality of a smartphone if someone doesn't make the installment payments on time, and that's making it less risky to offer refurbished phones in underserved markets, particularly middle income and emerging markets. So that the pain point we're solving is globally there's a kind of cost of living crisis. Smartphones are a big purchase cost for a lot of people globally, particularly in lower income countries. Coupled with that, there's almost no installment finance in middle income and emerging markets. People take it for granted that you can get a phone on installments in the UK and the US, but most of the world can't get access to a smartphone on installments. So our proposition takes a £1,000 new phone down to £500 as refurbished, and then down to £25 a month, or a £200 phone down to potentially £6 or £7 a month, and that's kind of what we're trying to solve. Globally, there's a huge opportunity. There's around 1 billion people globally who, if there was an installment finance offering, could get a smartphone for the first time. And there's also huge numbers of people who'd like to get a better device than the one they can currently afford. So we're playing in a very large space where more than $500 billion worth of phones are bought a year. So we were the fastest growing social impact company last year in the UK. We hit a £6 million revenue run rate in Q4, which was 8 times higher revenue run rate than the previous year. We're trying to get up to more than £12 million run rate in Q4 this year, with a view to getting to 22 million in revenue the following year, and then 50 million in revenue the year after. In terms of the technology, we have a patented technology which is built in at the operating system level of the handset and can gradually reduce the functionality of a phone if someone doesn't make their installment payments on time. As an example, if a customer is late on their first payment, we can block the games on the device. Second payment, we can block the dating apps. And the third, we can block the social media. So it's a way to kind of basically allow asset financing for higher risk customers, which otherwise wouldn't happen because they're too risky to provide the technology to. We've had funding from the United Nations, USAID, a lot of international development organizations to kind of help build out this technology and deploy it in emerging markets as a way to get more people accessing devices. We secured a patent on the technology in the US last year, and we filed the patents in about 15 other countries, and we're close to securing in a number of jurisdictions. The patent covers not just smartphones, but tablets, TVs, laptops, and IoT. So this is a way to finance all sorts of consumer products. In terms of our competition, there's a lot of interest in the refurbished phone sector. A lot of big European companies who've focused on Western Europe. We're more focused on underserved markets, middle income, lower income countries. We're also doing B2B2C, not just business to consumer. So we're looking to partner with telecoms operators, retailers and e-commerce companies. And we've also got a bigger focus on our installment finance technology, which is patented. In terms of the sort of trajectory of the business, so we raised funding early in 2017 to build out the technology. We secured a $3 million contract with USAID to deploy the technology in Africa, preloading the devices with agricultural services. And then more recently, we found that it's actually easier to scale in bits of Europe. So we've grown very quickly in Europe, hitting a £6 million revenue run rate in Q4 last year. And it's a very, very scalable business. And ultimately, we're selling world-class products from likes of Samsung, but in a more affordable and cost-effective way for end consumers. There's also a circular economy bit to the business model where we buy back consumers' old devices, and that can also make the whole offering more affordable. In terms of the team, we've got an experienced management team with a lot of telecoms expertise. So my background is I previously founded an SMS and telecoms business, which grew to 4 million customers. Tom, who's our CTO, was previously CTO of the Cordwell Group, which owned Phones for You. They had, I think, 2 billion in revenue when they were sold to private equity for 2 billion. And when Tom was CTO, they also sold a business to Vodafone for 400 million. And John, who runs the refurbishment bit of our business, has got more than 8 years of expertise in the phone refurbishment sector. Michelle is also, who helps on investor relations, has previously worked at Goldman Sachs. And so we've got a high pedigree team in a very exciting market. In terms of our rounds, so we've got a number of VCs who've backed the business previously. We've raised basically about 14 investors have signed equity subscription docs in the last 2.5 weeks. So we've got a lot of momentum in the round. About half the rounds filled, so about 740,000. And we're eager to take on extra funding in the coming weeks. We've got a kind of very strategic shareholder base. We have a family office who owns 2 telecoms operators. They own 100% of the telcos. They also own a national bank and a handset distributor. And our angel investors have been on the boards of Vodafone, Bharti Airtel in India, Tigo in Latin America, Maxis in Malaysia. So we've got a very well-connected shareholder base on the telecom side. And that's particularly important if we want to do B2B2C partnerships with big telcos and other distribution partners as a way to really scale up the business. As mentioned, we're trying to raise 1.5 million, of which half of that's already been closed. But we are also in talks with more institutional investors who might do larger amounts than that. The round's an EIS round, and it's valued at 12.5 million, which, just given the revenue run rates we've hit, is hopefully quite a reasonable revenue multiple. Particularly as a lot of our competitors are being valued at 10 or 15 times revenue. We're looking to use the capital to scale up the geographic expansion, increase working capital, which has held some of our revenue growth back, file extra patents, and build out the team further. ultimately, our wider vision is to put a smartphone in every hand. There's, as I say, there's around 1 billion people globally who can't afford a smartphone, but could if there was handset financing. So we think we're going after a huge opportunity. Not only is it a highly scalable business model, but it's very socially impactful as well. We're using refurbished phones, which are good for the environment, and we're also getting people onto smartphones for the first time, which gives them access to financial services, the internet, and a whole host of other things. And that's one of the reasons the UN and USAID have been keen to support the business, because they see it as a great way to drive international development. I think more broadly, as a team, we're very ambitious, and we're really trying to build a multi-billion-dollar business here. We're backed by VCs, so we need to kind of aim for that. And I guess we're looking for investors who kind of share the vision and can support us as we try and scale. But yeah, I'm looking forward to meeting anyone afterwards who'd like to discuss things further. Thank you.
Okay, so we have Alex from Sprint Law, and Sprint Law help small businesses and startups with their legal stuff, and they've also got a tech platform which enables that. But you'll explain it far better than I just did, so I'll let you take it from here. Alex.
Awesome. Thanks so much. Hi, everyone. I'm Alex. I'm the co-founder of Sprint Law. So Sprint Law is a new type of legal provider, and we're on a mission to reinvent the way that small businesses do legal services. So we've been around for about 5 years, and we're growing really fast. We currently have 4,000 business clients, a little bit over 2 times annual growth, and 4.5 million Australian dollars in annualized revenue. We've won lots of industry awards, and we were recently ranked as the fastest growing legal business from the Asia Pacific region by the Financial Times and the Deloitte in their fast growth companies list. As you can probably tell from my accent, we're originally from Australia, but we launched in the UK in early 2021, and we've been growing there really quickly, and the plan is to expand to a number of other countries in the next few years. So the starting point for our business was answering the question, why is seeing a lawyer such a headache for small companies? And research was telling us that 75% of small to medium businesses weren't going to see a lawyer when they had a legal problem. And the leading reasons were that lawyers were seen as too expensive, too slow, and too confusing to use. And for any of you who've worked with a lawyer before, it's probably no surprise. Most lawyers still operate using the billable hours model, which is really outdated. It actually dates back to the 18th century, and it incentivizes inefficiency and complexity, because basically it means the longer that you take, the more you're going to make. And so this kind of model is really low tech and not scalable. And as a result, the industry is really fragmented, with small businesses serviced by a network of thousands of these sort of high street style, very old fashioned law firms. Our model was to create a very different kind of legal provider. And what we've done is we've turned legal services into a suite of simple packages and products that cover the majority of legal needs for small businesses. We deliver our packages online through an e-commerce style shopping experience, and they're serviced by our team of online lawyers who are supported by our automation technology and our data-driven learning system. The result of our model is that we're able to provide higher quality services than traditional lawyers at a fraction of their cost, which saves our clients time, money, and a lot of headache. So what do we actually do? Well, most of our work comes from selling our fixed fee legal service packages. And these packages cover all of the different sorts of services that a small business might need. So we have general things like our company setup package or our trademark registration package, but also more niche things like our gym terms and conditions package for gyms or our recruitment T's and C's package for recruitment businesses. The packages include the actual document or deliverable, but they also include phone or video time with one of our experienced lawyers. We also have legal subscriptions. Now, our subscription offering is optional, but it's something which about 75% of our clients sign up to, and it's a really key part of our retention model. As a subscriber, you get access to unlimited quick calls with our lawyers, discounts on those fixed fee legal service packages, and access to our growing collection of legal software tools, which includes e-signature tools, doc generators, and also document storage lockers. So how do we reduce our costs? Well, traditional law firms are incentivized to be inefficient. Because we're a productized fixed fee model, we're actually incentivized to be very efficient. So we spent the last 5 years really automating every aspect of the legal service delivery process you can imagine, from collecting information to collecting payment to regulatory compliance to generating documents and file management. And we've created a library of automations, which means that our firm is staffed just by lawyers supported by workflow automation technology. We have no legal secretaries, no paralegals. And this automation system runs about 150,000 automations every month, and it's one of the most advanced systems of its kind in the world, as you can see from this very impressed-sounding quote from the CTO of Zapier, who are one of the world's leading automation companies. But the secret sauce in the way that we do things, I think, really lies in the way that we collect and use legal data to improve the efficiency and the quality of our services over time. So through our learning management system, which we call the Sprint Yard, we collect and analyze data on every small business legal job that we do, and then we mine and use this through de-identifying it to create new package-specific resources. We have package-specific legal templates, package-specific clause libraries, package-specific automated client questionnaires, and checklists, and so on. And so the result is that our lawyers have all of the ingredients of a legal service package right at their fingertips, and they become significantly faster at performing legal work over time. So you can see on screen we have an example of a privacy policy. We've done 408 of this package. It used to take our lawyers 4 hours. Now they can do it in 15 minutes. But the result of this is not just that the speed gets faster over time, it's also the quality, because we end up having examples from every single possible client scenario after having done it over 400 times. And so the proposition to a client becomes simple. I mean, would you rather use the lawyers that have done, a privacy policy hundreds of times, collected data on every single one, and they're going to use it to draft yours? Or would you rather use the high street lawyer that's done it maybe a few times a year and probably lost their paper-based records? So how do we scale? Well, a key feature of Sprint Law is that we run a fully online team which mixes employees and on-demand contractors from all across Australia and the UK. And that means we don't need ever-expanding office space as we grow. And when you combine the online team with our automation system and our data system, you end up with a highly scalable model. So we're currently able to service our client base of over 4,000 with just 20 lawyers. To acquire customers, we've structured Sprint Law like a B2B SaaS business. We've got a sales team and a digital-first marketing strategy, and we invest a lot in content and SEO and SEM. So our websites currently generate over 500,000 visitors every year, and we get about 1,500 small businesses inquiring every month. To retain customers, we put them all on our subscription offering, or as much as we can, and we nail our customer experience, as you can see from our really high NPS scores and Google review ratings. The business model is pretty simple. We acquire customers for $900. Then we make around $900 profit from our first package sale. So this might be a startup that needs to set up a company. And we then expect to make around $3,000 to $5,000 profit in lifetime profit over the next few years from subscription fees if they sign up to our subscription, or if they come back and buy, a privacy policy or an employment contract or some other piece of legal work. The market we're in is really, really big, because basically every small company needs legal services. And just sizing Australia and the UK that we're in now, we estimate the serviceable market for SME legals is about 10 billion. And so with our current revenue, we've really got a long way to grow. And having successfully taken Sprint Law from Australia to the UK, our plan is to expand the model to a number of other geographies in the coming years. So we'll be launching in New Zealand later this year, and we're looking at Singapore, Canada, South Africa, and eventually the US market over the coming years. A quick note on our team. Our team consists of ex-top-tier lawyers, including myself, and technology experts who know the industry really, really well and have worked together for over a decade in various jobs. And our advisory group includes former CEOs, Magic Circle law firm partners, Magic Circle legal technology experts, and digital marketing experts who are all invested in and advise the business. So how are we different? Well, people have tried to productize law before, but we're the first provider to really try and productize the full range of services that small businesses might need. And so we're the first provider to be a true replacement for a traditional lawyer. Do-it-yourself doc generators, which are everywhere online these days, are really only able to productize very limited basic legal documentation, and people still end up using a lawyer when they use them. And Seed Legals, which some of you may know, has focused on productizing just one more narrow and complex area of law, which is capital raising and cap table management. For the current round, we'll be raising 2 to 3 million Australian dollars, of which we already have a portion committed. The majority of that's going to be spent on sales and marketing, product, operations, and technology. And it's intended as a bridging round for a much larger round we're going to be doing next year to support that international expansion. So that's it from me. I'll leave you with this inspiring quote about the vision and mission for Sprint Law. Thanks so much for your time.
This morning tea has worked wonders with the timing. I'm so impressed. Okay, so next up we have Mass Media Outdoor. and they strive to make digital out-of-home advertising efficient, affordable, and effective for every brand, agency, and landlord across the UK. Thank you.
Hello. Hello, everyone.
Good afternoon, everyone. Just thank you all for giving us the opportunity to pitch our business for you today. My name's Mass. I'm the CEO of Mass Media Outdoor. We're an out-of-home media owner based in the UK. Basically, just to give you an overview, out-of-home is it's any kind of advertising media that's not in your home.
So, Mass Media Outdoor challenges the notion that digital out-of-home advertising is inaccessible to everyone. Its vision is to build a national network of high-quality, reliable and environmentally friendly screens, delivering a premium and affordable way to connect businesses and brands of all sizes with their target audience. So we've just done a brief key investment highlight. So about the market, about digital out of home. It's actually growing year on year. So it's a very exciting time to get involved. I do believe it's up by 34% at the moment for 2022. We've got access to highly promising sites that are both, we've got the quality because we've got a background in the technology, and also location. We've also got some eco-friendly screens whereby they use only a third of the power that the traditional screens use in the industry. And you know, we've got agreements in place all over the UK whereby we can have a national footprint, whereas at the moment we're more London-based.
So when we done an industry analysis of the out-of-home in the UK, we found that there's a number of issues. This has basically mean that the advertising was too expensive for the local brands, the SMEs and the hyperlocals. We also found that there was a lot of bad technology out there that was not reliable, poor quality, just the realising that some of the other media owners didn't really have a good understanding of how to put something in a place to give a good image. One of the things that we are striving to do is making advertising campaigns affordable. We will build a campaign for any budget, providing that we feel that it will actually work for the client. The other thing as well is we have a good background in technology. So we are looking to build a network of screens that, as Kate mentioned, is going to be reliable, quality screens, and they're going to be more environmentally friendly than a lot of screens that are out at the moment.
So, as I said before, it's a rapidly growing market, and at the moment, we have so 50% of the advertising spend in the out-of-home industry is spent on digital. Excuse me. What's the next one? So this gives you an idea of the competitive landscape. So it's, as I said before, it's expected to grow by 34% in 2022, which is actually more than pre-pandemic. We're able to sell our sites at a cheaper rate because we've got the quality, reliability, and we build, as Mass said, we build bespoke campaigns to make sure that people can hit their key target audiences. And it's a campaign that's going to work for them, so we can make it more cost effective for them.
Just to give you a brief history on the company. So the company formed in 2017 as a division of another business at that time, a shareholder in as well. For the first few years, we worked on looking at the areas that we wanted to target, getting agreements in place with prospective landlords and, you know, working on our business strategy as well as seeing how to do it right as well in the industry. We then decided to do the split. I mean, the split was always in place, but doing it in the middle of a COVID, in the pandemic, was just to make it more interesting, which we split away from them in 2020, and we've been trading independently since the 1st of August 2020. Since then, we've launched multiple sites. We've also got agreements in place with quite large landowners in the UK to be able to rapidly scale the business in terms of getting sites live. So the model that we work with will identify locations based on the strategy of where we want to target. The Wildstone route is the new agreement that we have in place. This company basically has access to over 4,000 media sites within the UK. So we can rapidly scale the sites using them, and we also work on our own sites. We'll agree heads of terms on the site, we'll put the planning application in, and then, fingers crossed, we'll obtain the licence to be able to build on that. Then the construction starts, and once we have a go live date, we'll start selling advertising, and it tends to be about 3 months before the site goes live.
So this gives you an idea of our diverse client base. So we work with local businesses as well as national brands. So we've had people like a local vitamin shop right through to Warner Brothers. We've had Talk Sport advertising. So we work with a full range of clients because we build those bespoke packages for them.
So the strategy that we're working with is, rather than doing it the same to lots of competitors out there, we're looking to build our digital screens on the main arterial routes in and out of towns and cities, sort of capturing the migrating audience. The road traffic at the moment is 110% of pre-COVID levels, and there's a report yesterday, I think by Global, that actually in the towns and cities they're still 20% down on pre-COVID, that people are still working from home.
So this gives you a snapshot of our senior management team. So you've got obviously Mas, who is our CEO, you've got myself, who's our COO, but then you've also got Kanjiv, who's our commercial director. Now we've all got different expertise. So Mas has experience working with startups and then building them up on that, and also experience on the technical side. I've worked in selling advertising space in the outdoor industry for over 10 years and building bespoke campaigns. I've worked with startups as well as the larger media owners in the UK. And Kanj has 25 years of experience working in media, working with startups, building them up. And then also on the, he has the relationships with the specialists in the industry. So he sorts out the commercial deals with them as well. So this gives you an idea of our growth opportunities. So we, as Mas showed on the map previously, we do have the ambition we want a nationwide footprint. That is what the plan is. We already have contracts in place so that we can, once we get investment, we have the opportunity to not just build the team, but also build new sites with our eco-friendly sites as well. On the business development side, we've already got our trading deals in place with the specialists in the industry, so that's why we then started getting bookings with Talk Sport and all of those national clients as well. And then for the product development, as I said, we've got eco-friendly screens that only use a third of the power, and Mas really works on that and knows that industry.
So our historical performance at the moment is loss-making, but there's been a lot of investment in from my other company to build the infrastructure, get the sites in place, a lot of capital outlay on the hardware. But moving forward, as we do have our forecast, if you wanted to come speak to us after that, we can show you the potential growth on the next slide. This will show you the forecast from 5 years from investment. Now, we look at other businesses that have built up and sold as well, and one recently sold with a 3 million EBITDA for 32 million, so it's quite a high multiple of EBITDA that out-of-home companies can be sold for.
So this is what the use of the funds would go on. So we would be looking to build the team so that we've got people selling the sites that we've also got live now, but also install new sites as well. We would do an... Oh. Sorry, guys, I think we have to stop. Yes. Please feel free to come and find us if you want to talk about it more.
Thanks for your time, guys. This was literally the last slide.
Thank you very much.
Thank you.
Okay, perfect. So next up we have ambient heating. This is Oliver, and they have a proprietary low-carbon heat panel technology, which is the only electric space heating technology to rival the energy efficiency of heat pumps. So I'll let you take over, Oliver.
Hi, good afternoon. Not long till lunch, I can assure you, so hang on in there. Welcome to a new era in home heating. I'm Oliver Baker. I'm the CEO of Ambient Heating. And our mission is to become the primary low-carbon heating technology for smaller homes and multi-occupancy buildings. Electricity is the energy source of choice in the low-carbon world, but it creates a big problem, which is the unit cost of electricity in the UK is 4 times that of gas. And therefore, to get a low-carbon heating system, you need a system that's going to use fewer kilowatt hours than a conventional system if you are to avoid fuel poverty. Heat pumps, and you need new technology to do this. Heat pumps is a new technology, newish anyway, and they certainly do achieve 3 times the energy performance of conventional technology, which is a 67% saving in kilowatt hours used. So that's a useful clawback. The problem with heat pumps is they come with significant upfront costs, 60% above conventional technologies, and because of their size and complexity, they're very difficult to deploy in smaller homes like terraced houses and with multi-occupancy buildings. That is up to half the UK housing stock, 8 to 12 million homes that are beyond the reach of a heat pump. We have the solution with our ambient low-carbon heat panels. They have similar energy performance, 2.6 times that of a conventional system, a 63% energy saving in kilowatt hours, but we're much cheaper. We are half the cost of a heat panel and similar to conventional technologies. And we are suitable, being a small compact system, suitable for all house types, including small buildings and multi-occupancy buildings. This is what the panel looks like. It is a robust, sleek panel, complete with its own microprocessor and temperature sensor. And it is easy to fit into properties of any size. It's fully electric, no moving parts, no maintenance required. The way we save energy is through our unique control system, which completely throws away old technology thermostats. We use a constantly dynamic pulsing control mechanism in order to save energy. And every time we are pulsed off, we are saving energy. And we combine that with infrared heat panels because, usefully, infrared is readily absorbed by building materials and stored and then released in the off pulses of our system. By this means, we can achieve constant thermal comfort whilst being pulsed on for only 14.4% of the time. That's what our data tells us. We've got lots and lots of data. Our technology is patent protected in the UK, Europe, Canada, and the US. It's a totally proven technology. We've got 1,000 systems out in the field so far across a whole array of house types and for many, mostly B2B type customers, including social housing and landlords. The market opportunity is huge. In the UK alone, the market for heat system is over 8 billion a year. We are currently focused on the B2B segment, so that's like 2 billion a year. And if we allow half to go to heat pumps, we've got a 1 billion a year opportunity right now in the UK. And why now? Because from 2025, no gas boilers can be used in new build, and that's government policy, that's government legislation. From 2035, there will be no, all new heating appliances have to be low carbon, and that's declared government strategy. And there's plenty of research out there to back up the idea that there is up to half of the UK housing stock, 8 to 12 million homes, that are unsuitable for a heat pump. Our commercial strategy is to focus on house types that heat pumps find it difficult to operate in, as seen on this slide. We are focused on B2B markets at present, not consumers, social housing, private landlords, rural estates, developers, house builders, and modular house builders. And in terms of routes to market, we have a sales team embedded in the northeast, northwest, and a sales team at our headquarters in Wakefield. And we are building a national network of regional electric installers whose job is both to install but also to win new business on their own account, and they get an incentive for doing that. And that is a growing part of our selling mechanism. And in Scotland, we have an exclusive reseller. My colleague Richard Davis here and I are the hands-on day-to-day management of the business. We're both ex-Big Four, as it happens, and between us we have over 25 years of hands-on experience running entrepreneurial and fast-growing businesses. We're supported by a team of 20 staff in Wakefield, covering sales, product development, tech support, manufacturing, and administration. And we're also supported by a weighty advisory board. Between them, they are directors of 3 listed companies. They've founded 5 clean tech businesses, invested in a whole lot of other businesses, clean tech businesses, and have a wealth of contacts and experience around fundraising, exits, and M&A. In this current fundraise, we are raising $1 million, of which it says here 0.4. In fact, we've just got another 100,000, so 0.5 has already been accounted for on a pre-money valuation of 11.8 million. The money we're raising is focused on growing the business. So in the technology, we are about to launch next year. We're going to launch a ceiling tile version of our product for the commercial market, investing 370 in sales and marketing and 300,000 for general administration and working capital. And we are clearing some really important milestones. We had a product launch in Liverpool and Manchester early this year. We've just taken on 2 new sales executives. Our low-carbon ceiling tiles are on track to the prototype will come out at the end of this year for commercial launch next year. And we're on track for a Series A raise of £5 million towards the end of this year or early next year. And our target is to get to 1,000 systems per annum run rate by the time we get to September next year. We've had some really good recent milestones. We've been selected by 2 national house builders for trial in their test houses, including one in the world's leading test house, which is Energy House 2 up at Salford University. It's the most amazing facility. Google it, you'll be amazed. We've been selected as the only infrared technology to go into that facility, and we continue to build out our regional network, and recently just taken on someone in Kent and Essex, and they've got an annual target of 350,000. So in summary, we are the only electric technology competitor to air source heat pumps that can operate in buildings where heat pumps will really struggle. We have significant customer wins already in proven technology, and we are sitting in front of a massive market opportunity, which in the short term is 1 billion, will become 8 billion, and that is only the UK. This is actually a global phenomenon that we're looking at in terms of the decarbonisation of home heating. Thank you very much for your time. Enjoy your lunch when it comes, and thank you for listening.
I'm loving it. That is how it's done. Perfect timing. Beautiful to see. Okay, so next up is Mike from Medmin Group, and they are transforming the precision of surgery to self-pay patients across the UK. Thank you.
Thank you. Good afternoon, everyone. My name is Mike Yanis. I'm the CFO of Medmin. We are transforming the provision of healthcare in the UK.
My name's Keith Duddy. I'm the CEO and one of the founders of Medmin. Medmin is a new kind of healthcare business that's transforming private surgery for patients and the clinicians that treat them. 6.2 million on the waiting list for treatment, 300,000 waiting more than a year, and 7 million people who data tells us should have appeared in the system but haven't.
Medmin presents a fascinating opportunity in terms of it's the right business at the right time in terms of what's going on with the market opportunity.
What really attracted me to Medmin was 2 things. Firstly, a passionate focus on providing clinical medical services to patients as consumers. And the second thing is a real focus on developing consultants' private practice, supporting them to do what they do best, which is deliver great clinical care.
The NHS is not going to be in a position in the short or medium term to be able to meet the demands that those patients are presenting.
We need to change the way we as clinicians think, the public think, patients think about
private healthcare. We need to take it out of the leafy suburbs, the white Georgian buildings, and bring it onto the high street and bring it into people's day-to-day thought processes. And we need to make it more accessible for people.
For some people, waiting isn't an option. They may need urgent treatment in order to return to work. They may have family responsibilities that require them to be fit and active. They may just want to resolve an uncomfortable health condition and get back to the life they love. For the 89% of the population who don't have health insurance, self-pay private treatment is their only option. GetWellSoon.co.uk is aimed exclusively at self-pay patients. Customers can be seen by a consultant surgeon in days and operated on within a month. We're focused on 50 of the most common elective procedures, most of which are day case. Price and quality of care are paramount, and we want people to have a retail-like experience. We focus on the outcome rather than the process. To drive and scale our offering, we're building a patient management platform that will allow communication, payments, information exchange, scheduling, and post-operative follow-up to happen.
Technology is a great enabler, but it also means that you can scale the number of people that you're helping, and that's essentially what we're trying to do. You know, we want to get lots of people to consume our services in a very straightforward manner. All of it is backed by a human being, by a Medmin human being.
The industry has not changed for decades, so what Medmin is offering and is already delivering on is a real disruption to that market.
This is the beginning of something great for consultant surgeons and physicians and for the sector generally.
So just a short introduction there of our vision. The business was set up a couple of years ago by a colorectal surgeon in the Midlands, initially just to provide back office and support to surgeons. He saw the market opportunity, pivoted the business, brought in us as a management team, and we're now implementing our new business model. We raised just over £500,000 from friends and family under EIS, and we do have advanced EIS assurance. And there are two parts to the business. There is a B2B, which is us setting up and running clinics in partnership with consultants. And B2C is our brand Get Well Soon, which is attracting patients into our clinics. Our clinic business has now got 30 surgeon partners. These are surgeons who we have set up 9 virtual clinics with, and they are partners in those clinics, and they work exclusively for us for the private work that they do. Most of them still do NHS work. We're treating hundreds of patients every month, and we're generating over 120k of revenue. Indeed, for June, we generated 140k. And as our number of consultants increases and the number of patients that we treat increases, then our revenue continues to grow month on month. Our market consumer-facing brand is not as developed. So we've created the brand, Get Well Soon, we've designed it, and we've got a marketing plan ready to launch. We've got the technology platform designed, and the website is launching any day now, but the tech is to follow based on investment that we can raise. Another hockey stick graph, I'm afraid, probably exactly the same like you've seen from all the other businesses today, as is driven with a lot of granular data behind it based on number of patients, the average fee that a patient will pay for their procedure, and our costs in delivering those services. Ultimately, you're backing management, and between us, we've got quite a few grey hairs, or no hair at all. So Keith Duddy, our CEO, his background is B2C marketing. He built a number of online gambling platforms in the US and the UK, so he knows how to sell to consumers. The original founder is a consultant there, Simon Radley, who's been a colorectal surgeon for 30 years. Steve Sparks has been working in senior NHS management positions for 20 years. Dan Toner, our Chief Legal Counsel, he was Chief Legal Counsel for the UK's largest private hospital group, Spire, and was also legal counsel to the NHS Test and Trace scheme before it was wound down. And myself, I'm a corporate financier and CFO of private equity-backed businesses, having been involved in over 200 transactions in my career. So between us all, we've got the right skills and the right mix to take this business forward. So why invest in us? Ultimately, you're backing management, and that £1 million that we are looking to raise today will allow us to build the technology platform, to launch the Get Well Soon brand, and to continue to build our back office infrastructure that deals with patients and running our partners' clinics. We're operating in a huge and growing market. The NHS waiting list is already out of date from this presentation. It was announced a couple of days ago. It's now 6.5 million. Now, not everyone can afford private surgery, but we want to educate the public to help them understand that there is an alternative if they've got a problem that is elective and they're waiting months and months to get treatment on the NHS. We've now proven the model in the Midlands. We've got the largest group of consultants outside of London in a single entity. We need to build a tech platform that will automate and make the patient experience even better. And ultimately, we're looking to build a profitable and cash-generative business. So the investment proposition is £1 million of investment for 20%. We've got 250k of it, hard commitments, another 250k waiting for investment committee approval from an institutional investor in the Midlands. We would welcome active contribution from investors that can bring more than just capital to our business. We are EIS compliant and the tax reliefs that brings. And ultimately, our objective is to create significant value for all our shareholders and looking at a trade sale in 4 to 5 years at a value of around 60 million, giving investors a return of 15 times their capital or an IRR of over 150%. So thank you very much for listening today and hope to continue discussions after lunch. Thank you.
Presentation before lunch, and it's a bit of a different one. It is a digital presentation from an ASX listed business in Australia. So the ticker for that is CHM, Chimeric Therapeutics, and they've got a really strong track record, the board, of continually delivering exits and high returns to investors. So you can listen in from down under.
Hi, good morning, everybody, or good afternoon. And I apologize because I am working through, as you can probably hear, a little bit of laryngitis. So I hope that you can still hear me. My name is Jennifer Chow, and I am the CEO of Chimeric Therapeutics. Chimeric Therapeutics is a clinical stage cell therapy company. And for us, what that means is we are focused on bringing cell therapy to life for more patients. We have all had the experience at Chimeric Therapeutics of working on cell therapies that have proven to be curative for patients. And our goal is to be able to bring that to more patients now with solid tumors and cancers. We have multiple assets that are currently in phase 1 clinical programs, and we've already seen positive phase 1 clinical signals. We have a very robust clinical development plan with 8 different assets, and we're leveraging the best in cell therapy from both an NK cell and a T cell portfolio. Our team is very small, but we have very, very strong experience in this space with the expertise needed to be able to drive these assets forward. And you see highlighted on the right-hand side there our information around being listed on the ASX under the symbol CHM. Our market cap is approximately $44 million, and we have about 420 million shares on issue. This is our pipeline, and as I mentioned, our pipeline is innovative in that it uses both T cells and NK cells, and we are currently in development with 7 different unique assets, as you see highlighted here. Our first asset is a chlorotoxin CAR T cell therapy. We have already seen very promising data from this asset. It is currently in a phase 1A clinical trial, dose escalation trial. And at the very lowest dose levels in this trial, we have already been able to see 5 out of 7 glioblastoma patients have disease stability. Now that's incredible because glioblastoma is one of the most difficult cancers to treat. So for us, this is highly encouraging data. This trial is continuing now to dose patients at higher dose levels. Based on the data that we've seen here in glioblastoma, we're also now expanding our chlorotoxin trial to look at patients with metastatic melanoma. Our second asset is actually a platform asset, which is allowing us to build 5 different unique assets from it. It is an NK cell platform that uses universal healthy donor cells as its backbone. And it is highly differentiated. As you see, it ticks all of the boxes on the right-hand side. This particular asset has also been in a phase 1 clinical trial that is now also read out and been published. What we saw in that phase 1 clinical trial was safety, which was established, which was key to the trial. But we also saw efficacy in both blood cancers and solid tumors, and persistence and expansion. Perhaps most notably in this trial was the case of one particular patient who came in and had tried all previous therapies that would be appropriate for her, had 2 doses of the NK cells, had a complete remission, so all of her cancer was eradicated, and now more than 15 months later remains cancer-free. So for us, this is a very encouraging early signals for this platform. We are now taking this platform and we're building on it. We're developing combination therapies, we're generating a next generation platform, and we're developing CAR-NK therapies off this platform as well. Our third asset is a CDH17 CAR T cell therapy that comes to us from the University of Pennsylvania. And this asset is a first-in-class asset. It's a 3rd generation cell therapy that's been worked on for over a decade. It was just recently in the May edition highlighted as the cover story in Nature Cancer. And this particular asset has broad applicability in gastrointestinal tumors. In Nature Cancer, what we actually were able to see is all of the preclinical data that talks about how this particular asset has an optimal design, how it showed very, very strong efficacy in preclinical models, and how it was able to establish safety alongside that efficacy. So our team is incredibly excited about being able to take this asset now forward to clinic early next year. So with those assets, what we actually have is we have a pipeline and portfolio that reflects the 7 different assets you see in development here across both T cell and NK cells. We plan to have 8 clinical programs by 2023, and that spans 10 different cancer areas, giving us multiple or very broad commercial opportunity as we move these assets forward. Finally, I'd be remiss not to talk about the team that is driving all this. As I said at the beginning, our team is actually very small, but our management team has a very extensive experience in this particular area. Cell therapy is a relatively new area of development in cancer therapeutics, really being around for the last 5 or 6 years. Our team has more than 50 years experience across us. We've worked on more than 30 different cell therapy development programs, and we've actually worked on 4 of the 6 approved CAR T cell therapies that currently are on the market today. So very strong experience to be able to take all of the ambition that we have and drive it forward into clinical trials and through to commercialization. So just highlighting where we are today, 7 novel assets in a very innovative and diversified portfolio. Very, very positive and promising signals already with 2 of those assets in 2 different phase 1 clinical trials. An extensive clinical development program that is planned for 2022 and 23, with a very broad therapeutic focus that gives us very strong opportunity as we go forward. We have a very strong industry-leading team internally, and we're very fortunate that we have world-renowned partners and advisors working alongside us. So with that, I thank you very much for trying to actually listen through to my voice today, and certainly invite any questions that you have. My contact information is there. Thank you so much.
Perfect. Okay, everyone can now make their way out to have lunch. It's currently being served. We'll be reconvening a little bit sooner than before, about 25 minutes, 20 minutes for lunch. Then we'll get back on to the presentations. Thank you.
Today, just before we have sort of networking and drinks and so forth, I'll actually give a quick presentation on WI as a business, because we're actually looking to aggressively sort of accelerate our growth in the UK as well. But quite simply, the way we see it is that effectively, we obviously launched the business in October 2008. So if you can think about the week of October 4th to October 8th, while the markets were going like this, that's when we were launching, and people thought we were mad at the time. But the way we see it is that effectively we curate opportunities, and we think about it firstly from the founder's perspective. We're always looking for founders that have got that sort of been there, done that experience. We're obviously looking for growth sectors as well, because the common saying that a rising tide lifts all boats. And also then if we're working with sort of B2C companies, we're often looking for metrics associated with their growth. And if we're looking at B2B businesses, you've got two elements. You typically have metrics, but then also we're looking to see if they've got blue chip clients as well. And the reason for that is because often with B2B companies is when they've got blue chip clients, they've obviously gone through a fair amount of procurement process. And you would have seen that with like Lorraine Motors, for example, as an example of a more technical business, but already got blue chip companies on board. And also, one of the key things for us is the board and management of the company. Often, when we think about capital raising or we think about investment opportunities, we think of it in terms of brand, because ultimately we're all, I say this in the nicest possible way, we're all borderline ADHD, right? We've got information flowing at us from all different directions. So often we only have seconds to look at an opportunity. So when you're looking at a board and management of a team, at that time, you're getting a quick snapshot of who's involved in that company, what's their background, what's their experience, have they gone through exits, etc. And so that does help us sort of form our own opinion on companies. And then the last part is we love technical businesses. So like we've seen Anastasia Biosciences and so forth, they're some of the harder businesses because not often driven by the sort of well-articulated CEO, often driven by scientists and so we're always looking for what industry awards have they won, what is their background, what is the experience of the team behind them, etc. So if you're trying to understand why this event may feel slightly different to what you've experienced beforehand, there's some of the curated elements that we're looking for in companies which we work with. So whilst I'm sort of feeling, I hope that sort of provides a bit more context for you as an attendee. I know it sort of wasn't expected, but obviously it's very hard getting people back from lunch. And on that note, I'm going to look at Oliver so he knows to introduce the next company. Enjoy the next session. As I said, following, we've got, I think, one more afternoon break. Obviously, I'll be hosting the FinTech panel session towards the end. I'll mention I'll do a quick presentation of WI, and then at the end of today is actually the best part, which is when we bring out the drinks. And you'll note that what I love about the drinks time is obviously just, not just, of course, there's alcohol involved, but effectively just the more sociable aspect. And to me, I think that becomes the most important part when you're looking to form long-term relationships, is just getting to understand someone in a bit more relaxed format. So enjoy the rest of your day. Over to you, Oliver.
Good afternoon, everyone. Hopefully you enjoyed the lunch break. I've got the pleasure of introducing Chris Russell, who's the CEO and founder of Celebrate, who are a digital tech company promoting retailers in a global virtual superstore.
Hello. Is this working? Yes, it is. My name's Chris Russell. I'm the CEO and co-founder of Celebrate. So imagine looking down at your phone and being able to see any product from any retailer around you, where you are at the time. The prices, images, the details, whether there's cashbacks attached, rewards, anything, instantly comparable side by side on your phone. So in retail today, local retail is still the most popular form of selling in the world. So over-the-counter sales is 75% of retail sales. The 25% is e-commerce. It's sort of not a widely known fact amongst the community, but over-the-counter sales still widely outreach all of retail sales. So in e-commerce, there's about 50 billion-dollar online giants. Amazon, Etsy, you name it. In local retail, there's none. So we've spent the last 4 years, there's no digital home, we've spent the last 4 years building the technology to come up with this platform to become this global platform and home for local retail. So really creating the world's biggest shopping centre, albeit virtual. So blanket coverage is what we seek. Ranked according to proximity of where you are, obviously. So bring it up and it'll show you all that around you. You can buy the products online as well through the app, facilitating e-commerce as well. So the benefits for consumers, I mean, the convenience, of course. We've all gone in and out of Google as we go. So through to find websites that are selling what we want, spending that time to do it. This is all instant. It's the same search, comes back side by side the retailers, either proximity to where you are, or you can just do a non-default search and it'll show you just the online results. So the time savings, the convenience. What's happening in today's world is that with your Amazons and those, they've made it so convenient digitally that offline shopping, it's just falling behind the wayside. People want that instant sort of gratification. So they're not going out there and probing like they used to. So of course then the money savings, because you're getting more options. You're seeing what all the deals are around you or online. And as I said, whether it's cashbacks, rewards, discounts, you name it. And of course then there's that joy of discovery. There's that little boutique around the corner when you've put in, a floral dress. Okay, I didn't know that existed. But there it is, and there's the whole image, everything you can just pop around to it and go through the process. And then there's lifestyle. We're a real integrity-based company, and we see what's going on with the high streets, what it's doing to local communities and local economies, this issue with the demise in local retail spending. So we're uniting retailers as one. So if we move on to the retailers themselves, so we're providing that digital platform that they just don't have. They're all disparate. Good luck with a retailer these days being seen on page 1 of Google, a local retailer, no matter how good their SEO is. This will have that force. And then if you go to Zellerate, you'll find those retailers through proximity, so they get that extra lick at it. And it's all free. We post it up for free. And then there's connectivity. So it's all about connecting right in, like that Google and those don't do, into your retailers. And that is providing content, articles intimately with the retailers as well. So it's all about then really trying to reduce that market share that's going back out to your Amazons and those, and providing live deals. So as I said, we've built such a platform. It's taken 4 years to do it with our tech team. It's enormously complex. We've rolled it out live here in the UK. We're just populating it. We haven't gone public with it per se. We have built up some subscribers and the like, but this raise is all about bringing together that capital to do the marketing, to get an email subscriber base, to get that going, and then through the problem. So the technology, there's 3 layers of tech. Really have to come out and meet with me outside or go through our platform, because it's quite serious tech. But fundamentally, we get layers of product data from the affiliates, the affiliate networks they're called, and then we crawl all those retailers with websites that don't go through affiliate networks with their streaming data. So we crawl those, map up that data from all these retailers' websites automatically, and then boutique is that where those retailers without websites, they can submit their data and get on the platform, and we even provide a free website automatically for them doing that to incentivise that process. So the commercialisation, it's anchored into affiliate marketing. Once again, this is quite a detailed area that we can represent after this, and otherwise we'll run out of time. But affiliate marketing is now a very proven formula in this world. Lyst, L-Y-S-T, you might know of it as a fashion retailer here. It's a £500 million valuation, and they just represent fashion. You click on the products that you find within Lyst, you'll go through to the e-commerce page of that particular retailer they're representing, make the purchase, all that's trackable back, and there's a 5-10% commission, whatever that may be. And that's how we go about ours. We've done it before. One of our co-founders has done this with the Into Shopping Centre group. He created their online marketplace and took it from 0 up to generating millions in revenues and beyond. But that was limited to the specific shopping centres. Our tech is scalable worldwide, already no restrictions here and overseas. So at the moment with our traction, we have 1,300 retailers here already signed up. willing to pay us commissions coming through with this thing. They've all embraced this whole local element to what we're doing. We've been talking to US retailers, your Nordstroms and those, even your KFCs and those want to get on. It's not just restricted to your non-retail. Council's doing pilots with us. End of the year, we're going to clone the tech over Australia, start mapping Australia. The US started next year, and then Canada. So all the tech, all that scaling is already done. It's a significant amount of tech. I can't sort of go into take any further. So myself, I've been in the game for a while. Carl Bennett, our CTO, he's the genius behind the tech. And Indy Mukherjee is the one that who took the Intu platform from nothing to being the hero before the Intu group was overgeared and had to shut that down. We benefited from that because he came in as a co-founder. Financial projections are significant. We've scaled up what Intu did, what Indy did. We've got the same machinations in place. So that's going out to this enormous revenues throughout. We have other with big data revenues we'll be getting in. We'll have premium subscriber services. And the actual revenues will be across 25 countries within those 3 or 4 or 5 years. And we have SEIS, EIS here in the UK. So just to finish off, the cap raise, 1.35 million. There's about 500 of that has come in so far. SEIS and EIS, previous raises to get to this point, about £2 million. The deliverables from this raise will be about 200 plus subscribers. That has your M&S's and your John Lewis's and those actually paying us big sums to tap into those and expose their products apart from the commissions through our email marketing skills and techniques. Australia and the US will be added at that point. We'll be mapping those into the systems. World-class UX UI, we're improving that all the time. This next half of the year, it will change dramatically. There'll be more of a focus on local once we really flush out here in the UK. We have about 7 million products here at the moment, at about 2,500 retailers and 40,000 store locations. That will double, as it says there. We'll go to 10 million products, 100,000 store locations by the end of the year, and we'll be in revenue. This raise takes us to revenue. And that 25K, that's escalating really quick at that point. That's going up to about 100K within 6 months because we're scaling. Thank you very much. There's my door. Perfect timing. Thank you.
Thank you, Chris. We've now got a panel discussion on NFTs and digital assets. It's chaired by Oliver Oram at Chainvine. We've got Sankalp Parapalli of Concilium Ventures, and joining on Zoom, we've got Erica Sanford of the Crypto Curry Club.
Should I take that? Yeah.
I can sit up. Yeah. Cool. Great. That's my sunglasses. Hi, everyone. Are we on? Are we? Sorry, is my mic on? Thanks. Yep. Great. Well, welcome to today's panel on NFTs and the rise of digital assets. My name's Oliver Oram. I'm the CEO and founder of Chainvine, and that works with blockchain and wine. What could go wrong there? Absolutely nothing. It's a great job, and I love it. Today, I'm joined by Sankalp from Concilium Ventures and Erica Sanford of Crypto Curry Club and the famous author. I'm just going to leave it to you guys to introduce yourselves. Let's keep it to around about 30 seconds each so we can get straight into this exciting session. Erica, would you like to go first?
Hi, sure. So sure, thanks for having me here, first of all. So yes, I run the Crypto Curry Club. It's a big crypto and fintech community in the UK. Networking events. I wrote a book called Crypto Wars, Fake Deaths, Missing Billions and Industry Disruption about the biggest hacks and scams in crypto. And I also work at CMS. It's a main law firm in the space, heading up crypto and fintech strategy.
And Sankalp.
Sure. First of all, thanks for having me here. Great to be here. I'm a part of the founding team at Concilium Ventures. We started nearly 3 years ago now. Started building a tokenized venture platform where we have a group of investors and early stage companies, mainly focused in fintech, medtech, deep tech, and then post investments we help them through a network of experts and operators. But the thing is, all of this happens within a tokenized economy where we tokenize the equity of the startups that come into the portfolio. And now we're also starting to white label this platform and help other asset managers or fund managers who are looking to do similar stuff.
That's probably a good place to start. I mean, if we look at the audience today, there's probably a few of you in the audience who are a bit skeptical about investing in blockchain or NFTs, for that matter, if you've seen the news and they say it's winter has come for the area. But let's start on a positive note. So, Sankab, can you tell me what you would say? What are the most exciting ventures at the moment in NFTs? And just give me a couple, if you can say so. What businesses should be using NFTs and why?
If you look at the current marketplace, logistics is finding some good use cases, and then there's GameFi, play to earn games. So the gaming industry has been very large, a few 100 million people playing and spending loads of money in gaming, but they never get to really own their assets, right? So if any games go down the drain, or if people who spend, say, a few hours or days every month tend to earn some tokens or coins in games, those tend to stay within the games and not monetizable outside. But whereas when you could turn it into an NFT, you're able to bring it on chain and then onto the main net, trade it with other assets. And
right, you're saying use your NFT to take your own IP with you, if you like.
Or whatever you've earned over.
Okay. You can take it out and it's yours. Okay. So gaming and logistics. I'll back you on logistics because of that. It's sort of in my area. Erica, could you give me a couple of sort of examples there of why investors should be interested in blockchain and where the NFT should be used in business?
Yeah, I mean, Alex touched on gaming, but NFTs, have some really cool use cases, and you touched on why one should be skeptical for numerous reasons. But to the use cases, NFTs have been around longer than things have been called NFTs. I mean, just one example, De Beers have been using digital certificates, which are basically NFTs, they just weren't called that, for years now to prove the authenticity of diamonds. And just one example, they basically take a scan of a diamond, and each diamond has like a unique structure, a bit like a DNA, and they create a digital certificate for that. So you can trace a diamond throughout its life cycle to see when and where it was mined, and was it ethically mined, and then throughout its sales process. So of course that proves that it's that it's real, that it's authentic, where it came from, that it was mined ethically. But also then if you want to sell the diamond, then you've got to prove that this is authentic. And going into sort of the luxury goods space, we're seeing many companies using NFTs in this form. So not as sort of the sense of a very expensive digital cartoon animal that's sold for too much money, but using NFTs as digital certificates to prove authenticity and origin of things like alcohols. We're seeing fine wines and whiskey bottles as well. We're seeing it a bit in the food industry and in fashion industry. I mean, one example there is there's so many fakes and counterfeit goods, be that expensive handbags or designer clothes or whatever it is. And some of the brands are now teaming together to fight the counterfeit industry and working together to have digital certificates, effectively NFTs, of their items. So not only do you get the real world.
NFTs for everything.
Sorry?
NFTs for everything. I mean, if I were to say to you, if the one industry, gaming, fashion, fine wine, alcohol, where would you put your NFT? If you have one NFT and you could use it in one industry, where would you put it? Which industry do you think has the strongest probably ability to use this technology, such as NFTs, and really be the outbreaker from the herd?
Now you're putting me on the spot. I'm going to put it in the fashion industry because a few reasons. A, there's so much counterfeits, just so many, so that would reduce a lot of that. But also, sort of going on to an ethical point of view, the fashion industry is awful. It's a disaster environmentally. There's basically zero accountability, and you've got so many chains in the supply chain between big fashion brand and people in factories who make it. You end up with horrific amounts of abuse and unpaid labor.
Okay,
so what that shows is sort of...
Thanks, Erica. I think, I agree with you on fashion. And Sankab, what would you say if there's one industry, where would you use this technology and why?
That's a tough one, but probably intellectual property, because you can bring the costs down in terms of proving that you own your IP. And then earlier, it has been quite hard to prove in terms of digital assets that you own it, especially a piece of content or whatever has been done digitally has been relatively harder to prove that you're the originator of it or creator of it, whereas when you can NFT it, there's your wallet address and whatever right from the time it has been introduced. Yeah.
So more like a legal IP rights type of platform. I just got a question for the audience. How many of you bought an NFT? Oh, actually, we got a few. That's good. And have your NFTs gone up in price? And you don't have to put your hand up if you don't want to. Or have they gone down in price? So up in price? Oh,
but lately everything's been down.
So here's a question, and this is an interesting one. People think that the NFTs are really, everyone is a newbie when it comes to an NFT. I personally think it's a blockchain address, if you like, so I think they've been around for longer than we think. But what do you think, and we use the term Web 0.3, what do you think needs to be done to get this technology further and more widely adopted by many industries? And Sankamp, if you can give me a real quick answer on that one.
I think it's the infrastructure, right? Right now we're still at the building the layer ones and the infrastructure to facilitate mass adoption, and also user experience of the end user needs to be improved hugely to remove all that friction. Earlier it was much more harder to get a wallet address, get acquainted to it, store your seed phrases and all of that. But now it's getting relatively easy in the last couple of years.
And what about security? Because I've read a lot of...
Security, absolutely another one. I cannot comment deeply on that because I'm not the technical guy here. But
so Erica, I mean, you've covered a lot of stories on crypto and stuff, and one of the themes I've been reading a lot about NFTs lately is that they're very unsafe and the security around them is pretty poor, and everyone's going to get their shirts taken off their backs. So could you answer that question?
Yeah, I mean, that's a pretty accurate summary. You hear about a different NFT hack every day. And, it's a little bit silly. I mean, as was said, that the user experience isn't as good or as easy as it could and needs to be. But, the thing is, in the digital asset space, there are now custody providers that have institutional grade security. So there are ways of storing digital assets that are trusted by institutions for sort of billions of pounds, i.e. that can keep things far safer than certain NFT exchanges or marketplaces or wallets seem to do that. And there's also digital asset insurance, which is becoming more and more widely available. So I do think a lot of the hacks are basically the fault of the platform. There's so much more that could be done. You've got cybersecurity firms that do basically ethical hacking, like penetration testing, that can be hired to basically sort of hack a platform to find out where the vulnerabilities are and fix them so that they find out before a hacker does. And the problem is they're skilled people and skilled companies, and they cost a bit of money to employ to do that. So a lot of platforms and companies haven't yet recruited the security checks that they could do because they're lazy or tight, but then of course it costs a lot more when all the NFTs are stolen.
Thanks, Erica. So that's going to lead actually quite nicely into the next question, which is quite amusing because you'll see I'm looking at my phone because I got sent some very interesting questions. And that goes into, what did somebody say? Well, Oliver, there's a lot of shit coins out there. There's a lot of actually not so very nice people telling you that they've got a great project, but in fact, all they really want is your money, and they had no intention of giving you a return on that. And there's just some really mediocre projects. I always say the one thing you can't regulate in this business is stupidity. So that's one of the hardest things you'll ever be able to do, and that's one thing the regulators would like to do, but they can't. So what can an investor, say, in the audience do if they're looking at a project? If you had, like, say, 3 major tips, and we start with you, Sankalp. So if you're an investor looking to, say, invest in Coinzillion's ventures platform, what assurances would you give the investor, and what would be your pitch to that investor?
Absolutely. So due diligence is obviously important, and we tend to start with the team of who's leading the project or wanting to start it. But then let's say if it's a crypto project with anonymous wallet addresses or whatever that's out there on the internet, then you'd want to look at the smart contract, see if it's open source, if the code is open source, because people may say something on the white paper while they may write something else on the actual smart contract. So you may want to verify the code and see if it's actually doing what it says it does. then look at the token economics, see if there's something unusual there. For example, if they're taking in large chunks of money from a small number of investors, do they have a lock-in period?
Yeah.
Or are they able to, sell all of their tokens or coins as soon as the retail?
So that's a really good point, the lock-in period, because that was a big problem with the old ICOs. I don't know if anyone was familiar with the old ICOs. I think there was a white paper called S.C.A.M, and they raised, I think, around 3 million, and it was basically scam. But there you go. There was
another one that called itself Ponzi ICO or Ponzi coin.
Brilliant.
They ran a total Ponzi, and they still managed to raise money.
So from a technical point of view, you've got your traditional investor hat on, due diligence, look at the project, does the project make sense? And then
Is there a market?
And then when you say look at the smart contracts, is there a place I can go and look up my smart contracts to check this?
I mean, usually most projects deploy on GitHub, so you can go see it if it's open source. If not, then you'd probably have to ask some more questions, put questions to the team.
So you're a fairly technical investor that has to look into this?
I'd say yes, yeah.
Okay. Eric, if I asked you like 3 points, what would you say to an investor looking at an NFT project?
I'd say it doesn't have to be that technical. I mean, probably first of all, if I could say read my book, because that highlights how a lot of the scams work and fool people. One of the things that a lot of the sort of the bad projects have in common is anyone that makes sort of promises or claims like, oh, this is going to go up in value, or you're going to get X% return, or whatever, any claim like that, basically run for the hills and avoid. I mean, A, it's illegal to say that, but B, most of the ones that do say that tend to have bad intentions. There's a few of a sort of red flags. One is some of the worst projects and the scams out there basically operate like network marketing or like Ponzi's or pyramid schemes. They pay commissions to people to get other people in. So a lot of the sort of hype around them and why people buy into them and why people refer them and promote them on social media is because commissions have been paid. And on that note, you get a lot of influencers recommending projects. TikTok has become a bit notorious for it, with lots of influencers on there who quickly get often thousands or millions even of followers promoting projects. And they say, oh, they buy this, it's great, and they don't say that they've been paid to say that.
So never listen to an actor or a pop star when you're buying an NFT.
Or just don't listen to anyone, just do your own research.
Same thing when you're buying tequila and wine, you've got to be careful there. No, I just wanted for the audience, because obviously you've got two very knowledgeable people here. Is there any questions that you would like to ask if you're going to go into an NFT? Yeah, please.
I don't really understand the advantage I get by not investing directly in the. What value are you adding? Sorry, what value are you adding?
Are you talking about our ecosystem we are building? Yeah, sure, absolutely.
You're taking money from investors and investing in deep tech companies.
Yes.
So what's the need for?
I can explain. Probably a use case. One of our first portfolio companies is called Syme Clinical AI. They save premature babies from ARDS, respiratory distress syndrome. This company has gone through Microsoft for Startups, where our founding team comes from, received several grants in the past. After they have gone through the due diligence and we made an investment in them in about 150,000 worth of tokens, they could find the support they needed within our network and then paid those guys in the sweat equity tokens, which are backed by the equity of all the companies in the portfolio. Because on the other hand, what we have are a network of people, majority of them highly experienced operators in the specific fields we tend to invest in, including CTOs, CFOs, CEOs, head of regulatory affairs, and so on. These guys have worked for sweat equity in the past, right? Which is highly illiquid, and sometimes you never see it liquidate. So by tokenizing it, we are able to, fractionalize equity, one thing, and two, there's an index of companies behind the token, not just one, so that if one of these experts work for startup A, God forbid startup A fails, they still get an exit when startup C exits, or E pays dividends. And the other advantage is if some of the investors want to liquidate early, instead of holding it on for 7 years or 10 years, if they want to sell it after 2 years or 3 years, they're able to liquidate some of the tokens. And on the capital table of the startups, there's one entry, single entry, Consilience Ventures. They may be working with 10 experts from the ecosystem. They may be having 20 angel investors. And there's still one entry on the capital table. And for...
That's good, I think.
Unless he wants to know more, I can chat. Yeah, absolutely.
Do we have any other questions on that? Oh, got one right at the back. This is good. It's a lively audience. I did this in Iceland once. Didn't get one question. Reykjavik. Exactly, I know, it was terrible.
Thank you. I wonder if we could clarify the last point on the, let's call it the recommendations that was made, because the very essence, and I think obviously the fact that not many hands went up with the NFT question. I work for a family office who does invest in crypto and NFTs. The very essence of it is that you have a community that recommends. This is obviously a very different world from what would be termed Web 2. Yep. And I think it's quite interesting the way that it was reported that anyone who is recommending an NFT may be doing it for outrageous purposes and to be paid. I think there's a really subtle point there that should be expanded on, because by definition the community recommends the community. Not all of them get paid in dollars. Most of them get paid in the NFT that you are earning. So if you don't believe it's valuable, you won't earn anything anyway.
Right. So
and I think it's super important to clarify that for an audience that perhaps is not 100% clear on the topic.
Okay. Erica, do you want to have a stab at that one?
Sorry, what was that? The exact question?
The gentleman's just pointing out that one of the reasons that the NFTs are so popular is the communities that build up around them. You could say the same thing about Bitcoin, really. I mean, it's always going to have value as long as it's got a community. So in that essence, you know, we mentioned that perhaps don't listen to too much social media and influencers telling us to buy something, but at the same time, that community maybe needs a voice. Would that be correct?
I think that there's...
Sorry, the guys just carry back on.
Yeah, sorry. Possibly not quite correct. So there are some bad actors that recommend these things to get paid.
Yeah.
There are also a number of the very essence of this market is it's a community base as opposed to a oligopoly in a let's call it a Facebook style where we will make Mr. Zuckerberg very rich. So we need to be careful not to say that everyone who's recommending, for example, an NFT or a certain coin is a bad actor, because the very essence of what a distributed network is that people recommend it. Many of them are earning the very thing they're recommending, which if it has no value, they will not earn anything from it. So it's important to make sure, I think, for the audience that we clarify the difference between a bad actor and somebody who is recommending a network that they enjoy using.
Okay.
I mean that's true, of course. Like anybody might recommend something that they just enjoy. I think I'd err on the side of caution, though. I've certainly seen a lot of, and especially in the ICO period, but also now, people that buy in early and then start recommending things and start promoting things, you know, acting really like, I love this project, I love this community, and just don't mention the fact that they've bought in early and that when the price gets high, they sell out and other people are left holding their bag. So yes, of course, some people do promote things just because they're interested and excited. I mean, I do that 1,000 times a day with whatever it is, a drink I enjoy or whatever. So of course, and some people do abuse that and make it look as if they're just really interested in the project without mentioning that they have bought in low and are planning to sell high once they've helped push the price up.
I think there's always a good, I'll just say that's a good level actually. I saw my nephew towards the end of last year, and he said he was buying a token. I won't mention the token's name. And I said, do you even know how to spell blockchain? And he said, no. And I said, well, you should really not be doing this. Really not be doing this. Because he said, could you tell me what it is? And I said, if you don't understand what you're buying, don't buy it. That's always the golden rule, in my opinion. We've come to the final question for two panelists, but were there any more questions there? Because it's good when the audience gets involved, I think. You're the community, you're here to learn or help us learn. Any more questions? No? Oh, there's one. brave.
Thank you very much. Good discussion. I guess the question is how do you see the future of art market being connected with NFT world? Because synergy is kind of obvious, but we've seen here and there a few projects, but not the market kind of division, sort of movement. So any focus on that?
All I can say is that was a really interesting new NFT gallery in Mayfair a couple of weeks ago. It was really interesting, and I think it's definitely got legs. But Sandra, can you go for that one first?
I mean, I don't think I know much about art or specifically that domain, so I wouldn't comment on it. I know it's picking up very quickly, and we have seen some great use cases for artists, cutting out middlemen, owning a piece of it so that they make money every time it's resold, which hasn't happened in the past where they were only keeping a tiny piece of it. But yeah.
Just one follow-up question back to the gentleman. Would you be talking about digital art or all art?
Yes, well, traditional art I think will come later, but digital art, sort of from modern artists, of which I know few, and they are quite interested to put their artwork into NFT form, but they just don't know how to do it.
Right. Erica.
Yeah, I mean, I think there's a few answers. I mean, first of all, we are seeing people buying NFTs because they like them and they think they're cool and they want to own them and they don't really care, you know, just if the price goes up, it's not about that, you know, to them it's just the same as buying a Beanie Baby or a piece of art. So that on one aspect, it's just a new art form, and some people have their own sort of online NFT galleries that they're very proud to show off. I think if you're looking sort of at the more, you know, traditional art market, I've certainly seen some projects and even charities looking at things like, well, if you buy a piece of physical art, you also get the corresponding NFT with it, or if you buy this NFT, you get the corresponding piece of physical art with it. So we're seeing more and more sort of the merge between the two. I think one comment on art, because I've often been asked and I've often seen the question posed that, you know, if you have expensive, valuable pieces of art, the Mona Lisa or whatever, will that be split into, you know, 1,000 bits so that everybody can own like one piece of it as an NFT and sort of tokenize and all of that? And I'm not by any definition an art expert. My ability to produce or know anything about art is absolutely lacking. But what I've been told is that just won't work, because whilst people may think, oh, it'd be fantastic to own, you know, 1% or whatever of this valuable piece of art, the value is in one person owning it and holding it, and people wouldn't want to sort of share it. So apparently that sort of breaking art, physical art, down into lots of different little NFT bits and selling them off and having them tradable, apparently that won't work, just because the value of the art is apparently in one person holding it.
So we're not going to have any timeshares in art too soon with NFTs?
Apparently the market doesn't work. I'm quoting what I've been told by an art expert. I'm not an art expert. So.
We're coming up to our last couple of minutes, so there's just one last question, and I suppose that's, you've seen this gentleman at the back, his family office, they invest in NFTs. What do you think the role of the institutional investor, and that's quite a wide a group to be talking about. What do you see their role in the investment of NFTs and Web.3 and where this is going? And you could go back to how NFTs could be used. We've seen very large sports companies, I believe, NFTing some of their goods.
I mean, I see many areas where institutional investors or large companies could support, but probably bringing in liquidity would be one big place where institutional investors could come in and, for instance, by tokenizing existing assets and so on, we're able to create secondary markets which haven't been possible earlier much more easily. So if institutional investors could start participating in those, obviously they'd have to go through their due diligence. The regulators have to let them do that. It'll take some time before it gets to all of that. But I see them coming in as one, liquidity providers, and two, fractionalizing their assets at the same time, enabling more participation.
Erica?
Yeah, I think there's two angles. I mean, the obvious one is you've got these platforms, be that the NFT marketplaces or the NFT creation studios or the custody platforms and so forth. Either they're big companies that are more sort of the infrastructure around NFTs, and some of those are getting institutional investment, and certainly from what I've seen, the original investors have done relatively well. So I think one answer is investing not so much in the NFTs so much as the infrastructure around them. It's like the sort of the shovel sellers in the gold rush, but also you do have some of these, as was mentioned, some of these platforms that are looking to do NFT launches. It might be companies or it might be charities or artists or whatever that have a brand or have the sort of the art or whatever it is that they want to sell as NFTs. But doing an NFT launch is quite expensive. Right. You've got to have graphic designers, you've got to pay for the aid that you marketing. So it's investing in that.
Yeah. Erica, I'm just going to go to the audience quickly. I just want to, after this discussion, we're almost over now, we're in the last sort of 1 minute, 30 seconds. How many of you would actually go out and buy an NFT today or tomorrow? Right, there's a few more hands than who had NFTs before. And okay, I'm going to finish with this question. If you could NFT one thing and one thing only, and absolutely don't, it's got to be an object or anything like that, one thing, what would you NFT, Sankar, today?
It's a very tough one.
Do you have a favorite T-shirt, maybe? I don't know.
Or something to do with intellectual property again, so maybe not my T-shirt.
Okay. Which could be intellectual property. You never know. Erica, if you could NFT one thing today, what would it be?
Of my own object, absolutely no idea. I think one idea I saw was a charity, an animal charity, looking to do NFTs of endangered animals left in the wild to raise money and do awareness around that. So I'd go with that.
Okay, well, I've got a really expensive bottle of wine that I'd love to NFT, and I probably already have NFT'd, so talk to me about the future trading of that wine if you like. Anyway, thanks everyone for today. I hope you enjoyed the panel. We had unfortunately one guest couldn't join us, but Sankar, Erica, really thanks very much. And Erica, I didn't get a chance to mention your book that's just come out, which is very successful. Could you just please tell everyone the title quickly?
Yeah, it's Crypto Wars, Fake Deaths, Missing Billions and Industry Disruption. So available from Amazon and all good bookshops.
Yeah, and it's a great read, so definitely have a look at it. Thanks a lot, everyone. Cheers.
Thank you.
Bye.
Hopefully you all found that very, very interesting. We've now got Simon Vandy, the CEO of Fortress Capital, who are a specialist across regulatory technology, providing capital for cutting-edge innovations in red tech and hybrids in any sector. Enjoy.
Hi, everyone. I'm, as you said, Simon Vandy. So I have 26 years in investment banking, worked for every single tier one investment firm in the UK and worldwide. I specialize in regulatory compliance. I am well versed in 12 different regulations. I have saved banks hundreds of millions of dollars of fines. I liaise with competent authorities in UK, the US, and ESMA, the European Securities Market Authority. And our focus here today is to discuss Fortress Capital, and of which I'm a managing partner. It's a fund, a $250 million fund, which is set up in the US. That's just a disclaimer, just the usual disclaimer to say whatever I'm telling you, it's not for you to invest in it, but of course we know. So our mission statement is Fortress is focused in harnessing the power of blockchain to open up investment opportunities globally, worldwide. We've placed a lot of emphasis on regulatory compliance and safeguarding and investor protection, asset management. We're very much focused on opening up innovations worldwide, so we focus very much on businesses which are owned by women and ethnic minorities and those persons out there who are underserviced. And we have a very substantial amount of stellar team. So Phil, myself, Goplan, and Sakti, and all have stellar backgrounds in different sectors, whether it's in asset tokenization, whether it's in private equity, venture capital, or investment banking. And we also have advisors who are also very much dominant within this space. And that is just a bit of our traction. So currently, in some of our funds, we have 3 billion assets under management. We have a collective 56 years of experience in investment. And we have 100 million acquired in assets since 2021. In terms of Fortress, we set it up in this year, and we're trying to reach a 250 million target, and we're now already at 41. My job here today is two-way pitch. So I'm looking for businesses to invest in. I'm looking for other institutional investors to co-invest with, and we're also looking for investments. And we have a 350-man consultancy team. We also have a media arm with 300,000 billboard screens accessible worldwide. And we have lots of substantial, very strong partners globally. Okay, so talking about tokenization, what's the biggest problem we see here? I spoke about illiquid assets. So illiquid assets, the true value of illiquid asset is not realized. We see mostly large corporates operating within this space, and they settle bilateral agreement. Now, what this means is that most companies don't really get to see the full potential to participate because the investment barriers, and also we don't see price discovery. So really, do we know the true value of something? So somebody mentioned about art and tokenization. Now, the good thing is that we don't really know the true value of that. We don't know, the entire journey of that, and therefore it's impossible for you to really put a price on any asset, whether it's real estate, or whether it's oil and gas, whether it's carbon credits, etc. But we're going to give you a few details. Now, what does this mean? It means that there are barriers to investment. It means that there are liquidity risks. It means that there is a much more wider spread and greater volatility. It means that we have issues in terms of understanding the structure from creation all the way through to the supply chain, and therefore we don't have enough data for us to do fundamental analysis, economic analysis, and regulatory analysis. And however, we do know that illiquid markets present a great opportunity. So if we look in the last decade, the greatest amount of wealth allocation actually has come from illiquid assets, okay? And we see has much more diversification potentials with minimum disclosures and many other factors. Now, we talk about blockchain, and blockchain can indeed help us to realize many of these things, but there are a certain amount of risks. So yes, I am all for blockchain, which is why we're here, but I'm going to tell you what makes the difference between the way we do things. Okay, so here you see, just so that most of you guys are thinking, blockchain, cryptocurrency, no, but there are two aspects of blockchain. That the one that is native to the blockchain, such as Bitcoin, for instance, and the one that is not native to the blockchain, for instance, asset tokenization, security tokens that are backed by real-world assets. So if you think about mortgage-backed security, I want you to think about the token that backs an underlying that actually has a real value. So now you see here about global VC investment in blockchain surpassed 33 billion in 2021. That tells you something. And if you want to know the investors, the biggest investors in blockchains, they're actually financial institutions, they're banks, okay? And we also see that 70% of central banks globally are developing their own stable coins, their own CBDC. That also tells you that it's something that you need to get on board. And we see here also that most of the major economies are actually developing their own regulations around cryptocurrency. Okay, and you see here, the World Economic Forum estimates that by 2027, 10% of GDP will actually be dedicated to transacted through the distributor ledger. That we're talking about some 24 trillion assets managed by 2019. Okay, so that's quite substantially. So for many people, and I hear from many of my my investment institution colleagues that we're not going to go down the line because guess what? It got a lot of issues. But guess what? You have to be part of the journey now. You're not part of the journey out and understand the whole deal from origination all the way to submission, to allocation, Otherwise, you're going to be left behind in this space, and you'll be thinking, I should have got onto that very fast. So our process, especially because I come from investment banking background, and I'm very much into research, merger acquisitions, credit derivatives, and all that stuff, is that being part of the process allows me to really understand and study and create the control framework that allows me to really actually code that into the blockchain to actually protect investors, but also make things better for consumers. Okay, so what is opportunity? So, as I mentioned, so I want you now to imagine a future where we have an advanced ecosystem, a blockchain ecosystem, whereby a retail investor can sell 20,000 shares in a private equity position in exchange for commercial real estate, in exchange for oil and gas, for instance. Or imagine a time whereby we have an investment manager in an alternative investment fund decides to gain liquidity by actually selling some amount of raising amount of capital through the blockchain, or whereby you have an investor and a speculator who can buy, sell, and shares in a private unicorn, for instance, okay, or whereby you have a new fund manager who is trying to raise amount of liquidity by retail shares. So all these things are happening. As I said before, many of the financial institutions are actually doing this now. So the question is, what is the issue and why are we moving slow? The issue lies between really understanding all issues for the entire supply chain, and also understanding what allows us to kind of control, from a regulatory perspective. Now, the good thing about blockchain is that there's quite a lot of opportunity. Those opportunities allows us to do things like better classifications of clients in terms of categorization and risk profile, helps us to do better equity research, and ESG ratings, investor sentiment analysis, best execution, product intervention, and manufacturing and understanding, to client asset management, to client communications, and many other issues, etc. Okay, and as you can see there, tokenization can actually go across very different areas, etc. Now, what happens brings the best part of tokenization is that you can actually, you can go across many assets, but some level haven't reached level of maturity for them to be regulated. But you would see under the UK, the US, and many other of the great economies out there, the crypto regulations actually goes in fact more deeper, tell you the ones which are listed on their securities law and the ones which are exempt, etc. Okay, so
Simon, we're going to have to wrap that up, I'm afraid.
Oh, is it finished?
So, yeah, that's finished.
Oh, wow. Sorry.
I'm sure he'll continue his presentation next door if anyone wants to hear it, but yeah, we're going to have to move that on.
What? Oh, it's it? Okay, sorry. Anyway.
So we're going to have to move this on. You can carry on next door, but yeah, we've got a tight schedule, I'm afraid. We're going to be joined digitally now from Fish From and their director, Andrew Robertson. They're raising capital for the development and construction of small-scale land-based salmon farm using leading recirculating aquaculture systems. So thank you.
Hello, my name is Andrew Robertson. I'm the CEO and co-founder of Fish From Limited, a land-based salmon farming business. RAS technology has been developing over the past 40 years and is now seen as the most sustainable way forward for aquaculture. Using this technology, Fish From will provide a consistent and predictable supply of quality salmon constantly, every week, all the year round. The fish are reared in ideal growing conditions, swimming in clean, highly oxygenated and temperature-controlled water, free from pathogens and parasites. Phase 1 will be the blueprint to expand and scale the business model and allow us to embark on Phase 2, a 3,600-ton facility that we already have planning consent for. Scotland is the world's third largest salmon producer behind Norway and Chile, but at only 210,000 tonnes of production, makes up less than 10% of the global farmed salmon production. It is the UK's third largest food export behind whisky and chocolate, but its excellent health properties have driven it to become the nation's favourite fish of choice, with over 1 million meals prepared each day and 1 in every £5 spent on fish being spent on salmon. Our 3,600-tonne business model shows that this methodology is more cost competitive than traditional sea cage farming, giving us at least £1 per kilo improvement in EBIT and there's the potential for premium prices for the high-end restaurant and catering markets. So why do this on land? And here are 7 very good reasons. We have complete control over the farming environment. We have no parasites, no pathogens, no predation, no algae blooms, no jellyfish, and we're not really worried too much about the weather either. All of these 7 issues dog the existing industry and consequently costs the industry a lot of money in treating and managing the constant issues that bombard it on a daily basis. And so we have signed up to the following USPs that highlights the difference between us and the existing industry. We will rear our fish without the need for any vaccinations or antibiotics. Our fish are not exposed to the challenges that the marine environment poses sea cage farmers, including parasites like sea lice, predation and seaborne pathogens. By being on land, future farms can be sited close to market. We will rear our fish in generations, stocked 2 months apart, with a 2-month harvesting cycle. This means we will have fish for sale every week, all year round. In addition to all the above, we will capture all our waste streams and recycle for use as fertilizer or waste to energy processes. We will also recycle 99% of all the water as we continually treat to return it to the tanks in pristine condition. There is a known issue that affects salmon production using RAS systems, causing the fish to have a muddy taste. Geosmin and MIB are bacteria molecules that can be found in the biofilters of RAS systems. RAS operators currently need to depurate their fish for 2 weeks prior to harvest to eliminate this muddy taste. But we have a solution, and one that will have an increasingly beneficial effect on this emerging industry. An Italian university has devised a proprietary technology that combines ozone, a widely used function in RAS farming, with photocatalysis. The system works instantaneously once in position and will eradicate the flavor-tainting molecules of geosmin and MIB. This technology will be easy to retrofit and install with other existing RAS projects, and will save operators significant amounts of capital in reduced operating and capex. We have an exclusive agreement with the university to commercialize and exploit this technology and develop our own process IP as we do. We have an 18-acre site on the west coast of Scotland and have all the requisite planning and regulatory consents required to farm salmon on land. There is an existing building on site that was a former hatchery that can be repurposed for our phase 1. With the ocean just 20 meters away, there's no issue in getting an abundant supply of seawater. Phase 1 will see us rearing 2 generations and producing approximately 50 tons of head-on gutted salmon. These will be sold to our contracted customer over a 4-month period. And as you can see from the map, we are close to Glasgow, and that operates as a main hub for the majority of all Scottish salmon distribution. The aims of phase 1 include demonstrating the ability to grow Atlantic salmon from 150 grams to 5 kilos in 10 months, and by doing so, provide the data that proves the commercial viability of phase 2. Proving the technology can solve the muddy taste issues that currently affect the RAS salmon industry, and get buy-in from our contracted customer and indeed the market after carrying out multiple taste tests with the trial. We will create more value from our waste streams, and we will conduct feed trials with the aim of designing a locally sourced, low LCA feed not reliant on Peruvian fish oil and fish meal. The timeline for our project is as follows. Mobilization and groundworks would be completed after 3 months, with the RAS installed and commissioned 6 months after that, ready for the first stocking of 150 gram smolt. We anticipate having 3 kilo salmon by around month 15, and at this point we will have commenced our initial taste tests. At the end of the project, we expect to have grown 50 tons of salmon across 2 generations to 5 kilos in size. After 18 months, we should be in a situation to go to the investor market and raise funds for phase 2 with a project cost of £60 million. We already have interest from a sizable family office to provide the equity, and it's expected that the Norwegian export credit agency GIEK can provide 65% of the debt at very reduced rates. The Fish From management team boasts over 100 years of experience in aquaculture and as much as 70 years in senior management and board roles. The team covers all aspects of fish production, including feed, genetics, husbandry, and processing, as well as sales and marketing. In addition, we have experts in construction and design, complemented by world-leading suppliers and subcontractors with experience in building and installing RAS projects from the ground up. We're seeking to raise 1.6 million in equity and already have 500,000 pledged. The balance of the funding comes from an Innovate UK loan of 2 million, with some additional support from Highlands and Islands Enterprise, as well as the Scottish Aquaculture Innovation Centre, with salmon sales and R&D tax credits bringing the total revenue received to about 5.1 million. Our total cost for the 24-month project is 4.2 million, leaving us with a 900,000 surplus at the completion of the project. So we are seeking investors who would like to join us on this most extraordinary journey that will challenge existing industry methodologies. A successful phase one will lead us to unlimited opportunities across the globe, as we will have proven all the requisite data required to scale the technology to a cut and paste cookie cutter simplicity. And of course, it doesn't just need to be salmon. Most finfish and crustacea can also be reared using this technology. Thank you very much indeed for your time today.
We're now joined by Robin Hughes, who's the founder and CEO of Clever. Clever is a clean energy transport solutions company specializing in the emerging markets.
Good afternoon. I'd just like to start by saying today, and this is the truth, today is my golden wedding anniversary from my first wife. Next Friday is my silver wedding anniversary with my current wife. I recommend it. Thank you very much. Okay. Clean vehicle solutions. Our primary function is not only in the operating of vehicles, we also are involved in transport services, particularly in electric, and we are also in clean vehicle technologies where we've just patented a methane catalyst. Methane is 30 times worse than CO2, and we now have the lowest temperature operating system in the world, developed in Britain over the last 5 years, and the patent was issued last July, and we're now ready to roll. We know how to get from 1 to 2. We have some good ideas about how to sustain number 3. But if they go brown and black, we're in trouble. I think we're probably already in trouble. 5 million people die of emphysema, air pollution. 40% of that is caused by transport. 40% of methane emissions, which are bad for the health, are produced by cattle, rice, and other very, very damaging gases. Methane is by far the worst, CH4. Britain has got dates on when to leave its concentration and focus on internal combustion engine vehicles, commonly called ICE. Norway will stop importing ICE vehicles in 2025. Volkswagen will stop making any diesel or gasoline vehicles in 2025. And the world is moving to a transition, it's not going to be overnight, to those types of vehicle which are not producing this on the right. We have 3 main product groups. We're only involved in public transport, we're not involved in private cars. We designed our own buses with a Spanish company. They formed an alliance with an electric EV Dynamics in Hong Kong, and we at the moment market those in the Philippines. E-trikes, which is our largest sector, are designed by us, made by us, and we own them. We don't sell them. We own them, and we do a revenue sharing by paying the cost of the salaries, the benefits to everybody who uses our trikes, and you'll see in a minute how variable they are in their application. Next week in our dealing room, there will be a separate room just for methane emissions, partly because of what I've been speaking to people to today, but also because it is very separate to operating a transport business. That's a vision of our vehicles pretty well. The Philippine bus that we have there are 400,000 of them running. They're called jeepneys if you've ever been to the Philippines. They're horrible. Euro minus 100 in terms of emissions. 100% electric. They're fully apt with GPS, Wi-Fi, tap and pay. We only sell our vehicles, those vehicles, to government-registered transport operators. So we're not trying to sell to somebody who might like a bus. They have to, because the government has said you've got to replace 400,000 vehicles. We also have a mini fire truck and a mini garbage truck to get into places where a normal fire truck can't get through. That's a fairly new business, and they're on prototype testing now in most of ASEAN, in Southeast Asia. Our e-trike, and you'll see a new model of that in a second. We're not running as a taxi like Bajaj in India or tuk-tuks in Thailand. You'll see how we're running those. We also have, particularly for the hospitality business, the people movers, etc. That's a drawing of our latest trike. We operate it 24 hours a day. The drivers are on an app, so they can be called up regularly by somebody who wants them every day or at random. Early in the morning, we'll go and pick up a driver and take him to his transport depot. Otherwise, he's got to walk. School run, 6 till 9 o'clock. We pick up the kids from their home, take them to school. In Asia, if it's hot, you sweat. If it rains, you get wet. And so we're providing comfort for the passenger as well. Last mile delivery, we are the marginal provider of last mile delivery in the rural areas where people don't, well, courier companies don't have their own operation. They don't have their own vehicles, they don't have their own office. We provide that marginal collection and delivery service. Health service, taxis don't like taking people to hospital. They don't know what's wrong with the person in the back, and they don't like taking them home because they don't know what they've had done to them. So we provide pick up from home, take to the hospital for their appointments. Retail, pick up somebody, take them to the mall and back. Everything can be scheduled, and if they're not doing anything on the top 5, they're a taxi, either by a Uber-type call-up or flag them down. We're talking about big-scale numbers. 400,000 jeepney buses, public buses, is a $40 billion market if you replace them all. The government has mandated in the Philippines you have to do 130,000. Well, that's a $13 billion market. We'll never do all of that. E-trikes, there are 3.5 million. We will own those trikes, so we need to buy them. We pay the salaries of drivers, we pay benefits, health, pension, whatever. They don't get that at the moment. We're dealing with marginalized economies where affordability is nil, creditworthiness is even lower. So we are meeting a social need as well as a demand for cleaner transport. We've already started discussions with the Education Department in England to run our initial electric bus as a school bus, and we've been engaging with schools authorities individually and group-wise in that market. We'll launch that in second half of next year. The biggest market which we're promoting at the moment, and which we've formed a new company, Catalyst for Change, is methane catalyst. We can get rid of 96%, not just of automotive, but industrial, boilers, generators, turbines, marine. There are 3 LNG ferries, inshore ferries up to 50 kilometers from shore, being built and put into operation every quarter in Europe. They all produce methane. We can get rid of 96% by putting a catalyst on there. Power generation, we can cap the flaring on methane wells, and we can also cover power generation, diesel power generation, by capping their emissions. And we're working with a number of international power generation companies on that already in the near future. We deal with all of these people. Our major, Queen's University Belfast did our research on the methane catalyst. Our main design partner is Mahler, the largest powertrain company in the world. They're German, but their office here is in Northampton. That's me on the left, a little bit younger. I've been in Asia for 40 years. I started in Ford with transport 50 years ago. A lot of that's coming back now. But in between, I had a banking and a money broking career. 20 years ago, I've been doing clean energy. Adrian is my CFO in Hong Kong. Although we are a Hong Kong company at the moment, we have formed a new company, a group company in the UK. We're looking for anything up to 20 million, but we're looking for it in segments. And if I... Oh. As I started late.
Thank you very much for that.
Okay. Please go to my dealing room, and I'll be outside if you'd like to know any more. Thank you very much.
Thank you, Robin. We're now joined by Neuroempathy and their advisor, Christian Kumar. Neuroempathy is a clinical stage medical device company developing a non-invasive home use treatment for painful diabetic neuropathy.
Everyone awake? It's a long day when you all got here about 8 o'clock this morning like I did. Right? Can you hear me in the back? Because that thing's over there and I'm going to walk because my wife said I've got to get my steps in. So my name's Christian Kumar and I run a little organization called MedTech Makers Lab based in Milton Keynes where we develop medical devices. Now, one of my favorite clients is Neuroempathy, a lovely piece of technology based in... Now you're in trouble. I've got the mic. Oh, I've got the clicker as well. Got it. Right, so my name's Christian Kumar. We run an organization called MedTech Makers Lab, and our entire life purpose is to simplify the problems in healthcare. We develop a range of medical devices that can be used external to a hospital environment. So during COVID, did anybody have a problem getting a doctor's appointment? Yeah, about everybody. Wouldn't you have rather have had that treatment or preventative treatment at home? Yes. So one of our favorite companies is Neuroempathy. Like I said, Neuroempathy is a microcurrent device for painful diabetic neuropathy, right? Now, how many people have diabetes? You don't have to put your hand up, but a lot of people, right? Do you know how many people? About 5.5 million people in the UK alone. That's not the alarming figure. The alarming figure is all of us that are walking and talking diabetic or pre-diabetic, because we're getting fatter as a nation. I'm the poster child for that fatter as a nation, right? I still love my cakes, even though I'm a type 2 diabetic. Now, the problem we have is if untreated, diabetes can lead to horrible conditions, right? And one of the most painful is neuropathy. Neuropathy is nerve pain, right? Generally starts in the feet. And non-treated, that nerve eventually dies. So then what do you have? Constant chronic pain. There is no cure or treatment program for diabetic neuropathy. You know, you'll go to the GP will refer you to a clinic, and he'll say, you know what, here's some opioids. Now, we all know that word opioid. It could be something as simple as paracetamol. It could be something very, very invasive to your central nervous system, like amitriptyline. It's costing the NHS £10 billion, but that's not it. People think of quantitative numbers when they evaluate a cost of treatment. How about the number of people that are staying at home because they can't physically walk, right? So the overall impact to GDP productivity is much higher than the cost of treatment to the NHS. Diabetes is our next major killer. Now, just in the UK, as I said, 5.5 million diabetics, half of which at some point in their life will develop some form of painful neuropathy. Now, what we're trying to do is reduce the amount of prescriptions prescribed by the NHS, reduce that cost, get people treated at home with some simple device and methodology. Let me introduce you to electroceutical. I love that word. I didn't make it up, but my colleagues in Israel did. And if you combine that with e-textile, and here's one I've made earlier. That is actually that sock. Just trust me, it's been washed. And this is the actual device, right? So the current comes from the device into the fabric, which stimulates the nerve endings in the feet to ultimately provide treatment, reduce pain, right? And this is what we're all about. I've got to get my clicker, haven't I? A very, very simple app that monitors the pain threshold. And what that should do, it should reduce the frequency of visits back to a consultant, reduce the frequency of prescriptions being used to kill the pain, right? This is a non-invasive treatment. Now, what we're doing for this company at MedTech Makers Lab is writing a preclinical protocol the preclinical protocol will allow the product to be tested in a clinical environment, the results of which we hope, well, we don't hope because some of the clinical trial work's already been done, but will allow the NHS primary care or diabetic consultants to issue a prescription for neuroempathy as a treatment in the home. It's affordable, accessible, scalable, non-invasive, all the tick boxes that are required in today's healthcare environment. Right? I know that those of you that didn't raise your hand know somebody with diabetes. They know some of them suffer. I'm Asian, I'm Indian. Right? So we're predisposed to diabetes. Right? Not the fact that I eat donuts. That has nothing to do with it. The mechanism of action, so I'm not the scientist here, right? So you'll have to get this. Mitochondria. So what we want to be able to do is stimulate the nerve endings to create healthier nerves, stop the degeneration. Now, we have clinical papers, we have due diligence. And at the end of today, I want you to come and register onto the CRISP site and download some of the data room. There's some incredible information there. What we are doing is innovating a new class of medical treatment, right? Electroceuticals. So whilst we have chosen diabetic neuropathy as the first treatment program, the same technology can be used in other areas as well, other nerve endings, other nerve damage. So we are in the middle of our clinical trials. We have done our preclinical protocol. This summer, we will recruit a series of patients to do a blinded study. And this is to confirm studies that have already taken place in Israel. So when it comes to your investment criteria, whether it's seed, pre-seed, Series A, I look at investment in a different way. I look at investment according to a tactical roadmap. So you've got research, you've got development, you've then got pre-production, and this is well beyond pre-production. So following the trials, the production side of the business will produce these units ready for distribution. It'll access the market very, very quickly. Very experienced management team, mainly based in Israel. The headquarters of the business is in Milton Keynes at the moment, within the MedTech Makers Lab. And Dr. George Lowell has been sort of the driver behind non-invasive pain therapies. This is what we're looking for. Not very hard. Under an EIS scheme, if those of you are the UK taxpayers, £500,000 on a pre-money valuation of £2.5 million. It doesn't sound like a lot of money. It's not a lot of money compared to the projections of launching a non-clinical device, a non-invasive device, into a sector that is growing like a pandemic, right? So my name's Christian Kumar. I've got 30 seconds. So I told them I would do this on time. And I represent a company called Neuroempathy. If you have any questions, I'm at table 12 back in the corner. And I expect a line of you to line up. You're all laughing, but you don't think I'm going to call you, do you? So I'll be calling each and every one of you. Get out your checkbooks. Thanks a lot for your time.
Christian promised he'd do that in 3 minutes, so he obviously got a little bit carried away there. But we're going to welcome up Plain Character Productions, and to the stage we've got Mike Midgen, who's the founder and CEO. They're an independent animation, app development and publishing company.
Thank you very much indeed.
Are you ready? Let's go see! Where are we going? It's a mystery. Where's the next stop? Come on, let's go see. Backpacks on. Yeah, it's time to explore. The GJ1 is charged, so let's jump on board. It's a big wide world. Come and fly with me. What's out there? Let's go see. Is it the highest mountain, the deepest sea? Trucks away. Let's go see. Let's go see.
afternoon, ladies and gentlemen. I thought we'd start with something a bit different. That's our theme song. Just something a bit different from what you've seen so far today. There we go, if it will go. There we go. So, what we're here to talk about today is investing in our children's future. And to quote the song sung by Whitney Houston, children are our future, teach them well and let them lead the way. And what we are working on is a rounded package of educational content for children. So we use animation, apps, augmented reality apps, and books to educate, entertain, and inspire young children. We are trying to teach children about the wonders of the world and allowing children that don't have the opportunity to travel to bring the world to them. So, the founder's story. This started, as many good ideas do, sitting with the chap there on the right-hand side, who is a British Airways training captain. And in his travels with British Airways, with his two young sons, he'd been asked many, many times, where did you go? What did you do? What did you see? What did you eat? And so, sadly, I also have to admit that is me in the blue suit. But one has to do what one has to do. So we sat there in his garden one night drinking grape juice. And it ended up that he'd written these stories for his two young sons. And he said, I don't know what to do with them. So I said, well, let's publish. So we took this decision. We got a local illustrator, a local printer. And over the space of 6 years, we published 8 books. And in all, we've sold about 85,000 books. That then led us at the beginning of 2020, because this small detail of a COVID epidemic struck the world. And being a captain flying around the world for British Airways, didn't have actually that much to do. And so we took that opportunity then to actually create a second company. And the second company then was designed to take advantage of tax credits, SEIS, and now EIS pre-approved. And between us now, we've actually raised first round of funding from friends and family. We've assembled a team, an animation team, 3 amigos, a Norton PR and marketing team, an M&L team, and a school program focus team. The animation team, 3 amigos, are specialised in producing 2D and 3D animation. They've taken a number of properties from zero to multi-million-pound exits. The Norton PR marketing team is actually a marketing team founded by the ex-marketing director of Waddington's, and currently has in his customer portfolio Lego, Paw Patrol, Hasbro, Harry Potter, and a wide range of brands that exist within this space. Brands with influence are an M&L team, and they have a lot of experience in taking properties from zero into multiple merchandise and licensing opportunities globally. So, why are we doing it? The reason we're doing it is because educating our children about culture, diversity, and acceptance of the world has never been more important. Many children don't have the opportunity to travel, and what we want to do is bring the opportunity to travel to them. In addition, if you see children nowadays, gender bias on career opportunities starts at a very, very early age. You ask a classroom full of children of 4 years old who wants to be a pilot, all the boys will say yes, almost none of the girls will say yes. There is no reason why women can't be pilots. Less than 5% of the pilots in the world are women. And it's not, there's no justification in it anymore. We are trying to get through to children that at an early age, you can be what you want to be. In our own small way, we're trying to do that. So what we have, and where are we now? So with the Friends and Family investment round, we have overall sold 85,000 books. We've created two 8-minute animated episodes. We've had over 1 million views in total. We have signed now 6 distribution agreements globally with digital distribution companies. 1 in India owned by Disney, 1 in the US owned by Fox. And we've had more than 1,500 app downloads on the augmented reality app that we have out in the space on both Google Play and the App Store. We now have, as well, we wanted to validate the idea to make sure that it was suitable. So we've engaged a lady called Dr. Amanda Gummer, who is the go-to expert by the BBC and CNN on children's play. She's a children's psychologist, and they have validated the app. We have engaged the Educational App Store, who have reviewed the app and said, quote, "This is by far one of the best applications we have reviewed in terms of content, fun, engagement and presentation. It provides a valuable education experience." We launched with Little Dot Studios as our first digital partner. They were seeing 160% growth month on month. So the process of where we've gone through, from April 2020 when we did the first fundraise, we produced the episodes, and through that we've now signed all of these agreements in place. And when you start to look at the exposure numbers, Little Dot has 6 billion views per month across all their channels. You go right through to Hungama in the network in India, 7 million views per month. So the audience potential is huge. We have agreements verbally from 2 in-flight entertainment companies. They will take content to put it on Asian airlines across into also European and US airlines. We are moving into growth segments. So the edutech market, because there is an educational core, we are trying to entertain but educate young children. So the edutech market is growing. The licensed merchandise market is growing. The animation market is in constant growth. So we are putting the company up at a pre-money valuation of 3 million. We are seeking £1 million investment over a period of time. And as we do that, the idea is to create more content that will be used to support marketing globally. We'll drive the number of views up, and then that covers us from the number of episodes we need to make over the next 2.5 years, because we only need to make 52 episodes, because that gives us 3 years worth of content, at which point the children in the age segment, is aimed at 3 to 6, 7-year-olds, grow out of the age segment and a new audience grows in. So then you end up watching the reruns because you've got a completely new audience. So realistically, that's where we stand today. We are seeking investment in tranches. Boarding now. We welcome questions, we welcome more information, we supply you with more information. We have the augmented reality app for demonstration at the stand, and we welcome your attention. Thank you very much indeed.
Impeccable timing, thank you very much. I'd like to welcome to the stage Rosanna Jagard, who's the CEO and co-founder of .coms, who are a mobile communication and real-time workflow management system improving medical areas.
Thank you. I am the CEO and co-founder of .coms. It is clinical communications to elevate patient care. And why do I mean that? Why do we even need it? At the minute, what we are facing in the NHS is a situation where doctors, in order to communicate quickly, securely, and efficiently, do not have an option. They normally rely on their mobile phone, and what they will do is actually, in order to be able to get hold of people, they will use WhatsApp to put patient information onto the system and actually then start talking about their patient conversations. They will seek second opinions, they will send clinical images, or they will send scans of videos. Let me have a look, is this working? Yeah. They will send videos, they will send scans, they will send annotated images on WhatsApp. The data is then lost. It isn't held within the NHS servers and will not be included in patient discussions or in their medical records. The reason we developed this is because my husband is a consultant surgeon and he has lived and breathed this problem. What we have designed is a solution to that. So we have basically enabled, okay, the wrong way. Oh. There we go. So the problem is poor communication. It actually impacts patient care directly. It creates delays, it wastes time, it creates waste. We have numerous problems because people are using social messaging, and not only that, we're actually risking the GDPR claims being presented directly against the doctors or even the NHS. So the deep dive on the problem really is, the critical thing here is that we're losing that information. That information can drive increases and actually increases in better care. better systems for communication, and also the ability to derive better treatment at the point at which the doctor's delivering it. If we can reduce the amount of time the doctor spends writing the notes at the desk, we can actually enable them to spend more time focusing on the patient, which offers reassurance and gives a better level of care. So the solution, it's an app, it's software. So it's held securely on mobile phones. 98% of doctors will have a smartphone, and that's not a UK figure, that's a global figure. So that means that not only are these doctors always carrying around a solution, a hardware solution that they can actually use to improve the patient care, but it means that they can actually start using that internationally. So think about West Africa. They don't carry laptops around, but they will all carry a smartphone. The value proposition is pretty big. So what we're talking about, we are deriving a new stream of annotated medical data. We are deriving a clinical medical network, which will be secure and used not only for second opinions, but obviously will span without going across borders. We have AI capability and machine learning in the back end of the system. We'll improve treatment, which obviously is ultimately one of the main benefits of this, but also medical research. What we are deriving, this medical research, can then actually go through to drug trials, it can go through to cancer research. A lot of the information being derived from the system at the minute isn't used, it's lost because it's simply not included within the system. And obviously we need to have a revenue to keep going, so that's a license fee, an annual license fee to use the system. The competitors. A lot of the people on this system now, on this slide here, are actually trying to do something similar. What they don't have is doctors who are actually living and breathing the problem. Microsoft Teams, for example, you know, the NHS is suggesting that people could use that, but unless you're sat at a desk, it isn't always the greatest thing to use. It also doesn't allow patients to be in a list format, so clinicians don't actually know who's on the ward at any one time. So there's no system solution for somebody who's actually living and breathing the problems of managing lists and lists of patients, or even emergency care on a daily basis. The market size is huge. There are 43.5 million clinicians, doctors in the global market. So what we're saying is that even if we got 10% of that, it's a huge number. The milestones so far for our company, we have raised £600,000 to date. We are TR7, so for those who understand that, we're technology ready. So we're beyond the stage of a prototype. We're now rolling out into live stream settings. So we are now being used in the NHS, in UK motorsport, in sports medicine, and we're now to say this money that we're trying to raise now will allow us to scale further. So just to talk about the figures. What we are saying is the medical data per annum could be worth up to about £9 billion. We have taken these figures directly from the likes of Forbes as a sort of user case and actually looked at what one individual record would be worth and then looked at how many would be held in the back end according to how many people are using the system at any one point. So a clinical network, if you have 600,000 users, and just to put that into context, the NHS employ nearly 2 million people in the UK alone. So if you have 600,000 people on the system, your clinical network will be worth about 45 million. The license fees, this is a sort of minimum figure, but this is a UK figure only. So what we're not taking into account here is expansion internationally. But from the NHS alone, you would derive about £10 million in license fees. And that would just be for the basic product. That wouldn't be for add-ons or additional modules, which we're starting to offer now. The main thing is that, you know, .coms, when it starts to be deployed in a hospital, it saves clinicians time. It allows them to focus on the patient. It allows them to improve patient care. And actually, when you think about everybody in this room being affected by a system like .coms, we all stand to benefit, whether it's directly or indirectly. Because let's face it, when we're sick, you want the most efficient and the best treatment possible. We have quite an experienced and diverse team. So obviously myself, my husband Matt, who works in the NHS. We've got John, who's worked in commercial development for over 30 years. Rob, again, years and years of experience. And then Nina, who's actually just looked at a redesign of some of our screens to make it even more user-friendly. Let's just think about the people that are using this system, and actually those people are not time rich. They are under pressure 90% of their day to get things done quickly and efficiently, whether that's just because they've got a queue of people waiting or whether it's because it actually is time critical for somebody's life. The funding required. We started around in March. We have got commitment for 2/3 of the round, but we're looking for just that little bit extra, then we'll close. The company valuation is 7.4, and this is just a sort of vague breakdown of how we will spend that money. Primarily, the money will be spent on scaling and resourcing the business in order to be able to make sales and actually work with the NHS on a more close basis. Just to put into, we are actually pre-revenue at this stage, but over the next few months, we expect to be revenue producing as we have our first 3 contracts out. Thank you very much for your time.
Thank you very much. I'd like to welcome to the stage Del Zarinli, who's the founder of Astra Metaverse. Following on from our panel earlier, Astra is a network of virtual cities in the metaverse where you can create and enjoy virtual experiences.
Hey everyone, I'm just looking for the clicker. Yeah, great. So hope everyone's great. Like, had a great day today. I know it's been loads of presentations. I wouldn't take too much of your time. Just want to tell you about a very exciting investment opportunity, and hope you can come over there and I can show you a demo. We can speak more about this. So essentially, our contrarian view of the metaverse is that it's not about socializing or gaming. It's more about like an NFT first supply chain. So all over the world, there are like millions of brands and millions of businesses. Anytime they create a business, they create this in the physical version first. But, you know, think about the sustainability impact if every idea started off as 3D first. And you have this idea of like an outfit, a shirt, a shoe, a bag, a car, 3D first, and then you make this as an NFT on the blockchain. You know where it's from, you know who owns it, and it's sold to avatars in virtual worlds first. And then you can actually have an idea of the demand first, and then you manufacture it when people have already paid for these things. So think about a new way of like, you know, shopping that's powered by like, you know, giving everybody the ability to create things in 3D first, sell these to people's avatars in virtual worlds, and then only manufacture when it's been bought. Well, the problem is that a lot of people see the metaverse as, you know, a social thing or a gaming thing, and they want to keep people in there all the time, instead of connecting people to the real world via an NFT first supply chain. And if you think about the fact that, like, you know, about half of the people playing games right now are women, and there's about 2.9 billion game players worldwide, there's a huge meta-commerce opportunity if you can present these people 3D assets that exist as real-world assets, you know, and they can buy that and receive that at home as physical assets. And that's why we're building Astra. So, in summary, in Astra, you can play games, trade NFTs, and make new friends. It's a network of virtual cities in the metaverse where you can create and enjoy virtual experiences with your avatar, and it's built on a 3D marketplace protocol called Imagineer. Currently, most NFT marketplaces are all in 2D, like OpenSea, all the great ones, they're all 2D, they're all pictures. But what we're trying to do is like create a new way where you can buy an NFT and it has instant utility because it's in 3D. You can use this in like the world you're in to like go shopping, play games, make new friends, you know, and like, you know, you can buy like really cool clothes for your friends. Don't see this as something that you would probably be using. Think of like, you know, what's happening with Roblox and the kids and the younger generation, the digital natives. This is how they would prefer to buy things to receive at home. And the best part is we've been building since 2020 and we're backed by Epic Games, the creators of Fortnite. They saw the idea early during lockdown when we started and gave us a grant of 40K. And since then we've raised about 1.3 million. So the opportunity here is creating a metaverse product that has realistic avatars, NFT assets, sustainable blockchain choices, an in-game token, social games, and also virtual commerce, or as we like to call it, meta commerce. We started in 2020 and then had our first demo in 2021. And what we did was we created a virtual store you could go shopping in for a brand called Loan Design Club. We did this early enough, got 394 users, and we got the feedback on like, you know, people actually want to try this out, like, you know, a 3D version of the internet where you can go shopping instead of like the current version of the internet, which is all 2D. So it's like playing a multiplayer game, but you're actually shopping. So they thought it was really cool. The next thing we did was to couple that with gaming. So we thought like, okay, if we go shopping and we're building this experience with gaming technology, what if we could actually play games and win fashion in real life? We did that during Christmas, December 2021. We had like, just because of the cost of like hosting this sort of experience, just about 850 players in 2 hours. And we got someone delivered a real life Balenciaga bag. It was the first of its kind, you know, sort of experience where you're playing a game and you actually get delivered a real life prize. And now we've gone through like, you know, raising, and we've developed a new version which we're launching next month at the Metaverse Summit in July in Paris. So just looking at time. Yeah, sorry. I know it's been a very long day, guys, so I'm just trying my best to keep everyone's energy up. But yeah, we're going to launch this in Paris in July, and we're currently like third in the public vote. You know, there are many metaverse projects out there, but this Astra is different in terms of like the branding, the graphics. You know, the way we're looking at doing this is totally different. In terms of the team, I lead the team. I'm the UX and protocol design lead. I have got two master's degrees, one from the University of Birmingham and the other from the University of Warwick. I've also worked for companies like BT and Condé Nast as a product designer, so I designed websites and innovative experiences for them. And the rest of the team were all minorities because, you know, you do things with your mates. Those are the people I could find locked down at home and not having enough funds. Game developers, that's like Luke is a fantastic game developer, has been developing for many years. Nee is like an artistic legend, and Kumbi is a architecture graduate who's like making sure we build everything. We've also been on accelerators like the University of Cambridge, Institute of Sustainability Leadership, Define Lablaco, the Fashion Tech Alliance, the Epic Mega Grants program, NVIDIA's Inception program, and also Tech Nation, which is like the largest tech society in the UK. In terms of what we're raising and the tokenomics, so it's a tokenized startup. And what this means is we're currently raising 3.5, we've raised 1.3. And the check sizes are a maximum 300K because being a tokenized startup, we have to make sure it's decentralized in terms of how it runs. So the team only owns 15%. You know, advisors 5%. If you come in at like the seed round or the private round, depending on your value add as an investor, we're looking for like great investors that can say, oh, look, there was like, we've got connections to this fashion brand that can come on board, or like we've got like, you know, we can introduce you to that. Now we'll be like, okay, this is a very strong investor coming into our seed round. But if you're just more like a passive investor who just wants to see some gains later down the line, we put you in our private round. How it happens is like we price the token. So for instance, you can see like the seed round gives you the token price at 0.01. And, you know, we're going to sell it at the public round for 0.025. You hold this for a year, we get at least 100 brands, and we get like 1,000 to 1 million, who knows, shopping in the metaverse using VR. Then imagine how much the value of the token could appreciate. It appreciates, you have enough to cover. You know, we have like tokenized investors that make, you know, 10x, 20x, 30x, 50x returns because there's a very, very strong product use case. So we're not giving you like a speculative asset to buy. It's more about like, you know, the product use case. And just to round up, the token utility is, you know, the Astra token governs everything inside of the Astra metaverse. It's used for NFT purchases, event tickets, and also staking to earn rewards. And we also have an NFT strategy where you can buy like collectibles like, you know, hovercrafts and like jetpacks to go playing around with your friends. You can buy avatars, and you could also buy a really cool digital fashion, which can be manufactured in real life. So yeah, in terms of our roadmap, we are launching at the Metaverse Summit next month. And where we're going to have like a MetaCommerce VR experience in Westfield where you can go shopping using VR headsets and receive that at home. So yeah, that's everything about Astra. I am in the next room. I hope like everyone keeps their energies up and like, you know, listens to the great ideas from every other team presented today, and I would love to take your questions. So it's a very exciting opportunity. I'm so sure you don't have anything like this in your portfolio. So, you know, come talk to me and like we could, yeah, just give this a roll. So yeah, thank you guys. Have an amazing day.
We're next going to have Stephen Ringler, who's the CEO of Space Store. Space Store offers space and edutainment experiences through a blend of digital and physical channels.
Hello, everyone. How's the energy levels? Really good? All right. Let's see. Afternoon. Haven't gotten any coffee yet. But I'm American, so I have a lot of energy just like all the time. Hi, I'm Stephen Ringler, and I'm a rocket scientist, and I'm really excited to share with you today about Space Store. So we are all about space experience and bringing it to everyone, and we do that in a number of different ways. But why do we even do it? It's because the public wants to have space experiences. When we started this venture a few years back, we interviewed hundreds of people, and 96% of them said, yes, I like space. And 92% of them said, I want an experience of space on Earth. But there's a little problem. Space experiences are few and far between. First of all, if you want to do something that's kind of in the normal person price range. You need to go to Kennedy Space Center, Leicester Space Center, the Science Museum, all wonderful places that we hope to have partnerships with all of them and send people there. They're absolutely brilliant. But then those that want to kind of do a little more thrill riding, go into space, we're talking about, 250,000 pounds. There's only 550 people that have been to space. And over the next 5-10 years, it's only going to really double. So we want to bring those experiences here on Earth. So how do we do that? We do it through a few different channels. One is retail outlets. We started a retail outlet in Didcot, which is about an hour west of here in Oxfordshire, where it was a proof of concept store in 2019 in June. And after 9 months, we became profit making as a store. So the store itself was profit making. We proved our business model. And from there, we said, hey, we now need to make more stores so that we can get the company at the profit making level too. So we do it through retail outlets. We also, at those outlets, have experiences. So you can get into spacesuits. You can try virtual reality. I've got an experience. If you want to try it out today, I'll take you to the moon. We have merchandise, over 200 products, from apparel to gadgets and games, meteorites, all sorts of great things, high margin products. We have food and beverage. You can go to a cafe. You can eat like an astronaut. You can eat like on Earth. We even sell astronaut ice cream, which is not freeze-dried. If any of you think that might be the case, come talk to me later. I'll tell you what it really is. And then we do events. We do lots of events. So Airbus is, for example, down here in the bottom right. They hire us to do team appreciation events. Vodafone have hired us, to name a few. We do things with birthdays, Girl Guides, Scouts, schools, you name it. Education is really important to us. We're very much about edutainment, as they mentioned before. And finally, we're also digital. So thanks to the COVID opportunity, we decided to launch a YouTube channel, which is still small and growing, but we have a fortnightly news show that we put on about all the latest space events. And we have Kids AM, lots of fun projects that you can do with children, etc. And you can also do some of our experiences online. So we send you a box with lots of cool stuff, and then you can do it in the comfort of your own home. So one of the things that gives us a lot of credibility is that we work in the space industry. I've been in the space industry myself over 21 years. One of the things I'm most proud of is a satellite I supported development of, which is currently going around Jupiter. And we have 12 companies that are our space partners that a number of them pay monthly subscriptions to be part of our team. And then we do all sorts of additional services on top of that, which add quite a bit of revenue to the company, whether we do merchandise, we do video production, digital marketing, and education and public outreach. So I get asked a lot about, oh, who's your competition? And it's really hard to answer that question because there's really nothing like Space Store out there. However, there are some really good analogies that I'd like to talk about. And I think one that, since we're in London, would be appropriate to share about is the London Transport Museum. If you've ever been there, it's just right around the corner in Covent Garden. They have an experience that you can go through. You come out of the experience, there's lots of merchandise, and they have a cafe. So those are kind of three of the elements that the stores that we have. So that kind of gives you an idea a little bit of who we are. But there's nothing out there that's just fully immersive retail that's specific to the space industry. Now, the market size is very difficult to pull together because there are no real studies out there that say what's the market of space experiences around the world. So the numbers that you see here for the UK and globally are that come from our own actual revenues that we make and what we extrapolate to the other cities and other stores that we're going to open as we go forward. So those numbers are based off of numbers that we actually make. So for example, right now from Didcot, we turn over about $250,000 a year. We are launching our second store next week in Oxford, so we're expecting that we'll be at about $500,000 a year by the time we get through another year of trading with that new store. We have some pretty cool collaborations that we've done. The one I will just highlight here is Virgin Experience Days. They found us. They said, hey, we know you. We think you're cool. We want to do a space experience with you. And they have now stolen all of our SEO. So if you know what SEO is, If you type space experience into Google, we used to go to the top. Now type space experience into Google, it's us, but at Virgin Experience Days. So thank you, Virgin, for putting in all that money into marketing for us, because literally we have bookings for our most famous thing, which is Astronaut Experience for Two, which they helped us kind of market, not develop, but market. We're booked all the way till March of next year. Now, not fully sold out yet, but we've got lots of weekends that are sold out, very much thanks to them. So, cool team, heavy hitters from retail, heavy hitters from food and beverage, but we have an astronaut. That's pretty cool. Now, you may have seen some other companies that have astronauts. That's super cool, but I really like ours. Michael Lopez Alegria, U.S. record-holding astronaut, most time walking in space than any other U.S. astronaut. He's been to space 5 times. He just came back a few months ago on the Axiom 1 mission, which took the first commercial crew to the International Space Station. Super cool. I love just being able to text him. It feels really neat. And ask him questions like, hey, how was this food? Or this, that, or the other. He basically authenticates everything we do. Our Eat Like an Astronaut experience, he helped us develop, so it's super authentic. I think this is a great investment opportunity. We have raised $410,000 of a $500,000 seed round that we're doing right now, and that is largely thanks to Wholesale investment. We were here 4 months ago, and between then and now, we've raised another $350,000+ to get us to the 410. So we just have a very small ways to go to close the round, and we're going to open our Series A round immediately. So for any of you that are like, oh, 500,000, that's too small. Well, we've got 2 million, and then I've also got another investor that we're talking to who's like, hey, actually, I think we should do more than that, and we should actually make this bigger. So we are open to lots of different discussions around that. But so far, we've stuck to our milestones and stuck to our plans, and have proven everything that we've tried to prove at each stage. So how are we going to use those funds? I could talk through this whole chart, but the main thing I want to focus in on is our large experiences. So large experiences being things like, you can come talk to me because I'll show you one of them, or the beginning of one. But the cupola, which is a big window that the astronauts look through the International Space Station, we're going to build that. We're going to have that experience in a store, and then we're going to license that technology to other centers that might want to use it as well. So there's 2 revenue streams, people coming to us and us getting money from science centers, et cetera, around the world. So the key thing from our business milestones perspective is we proved our concept store was profitable by 2020, right before COVID. We went online during COVID and have created all sorts of digital experiences that you can purchase online. And now we're opening up 2 stores a year every 5 years. And there's a nice picture of our Oxford store. If you're interested in around Oxford next Saturday, we'll have some Bucks Fizz and cupcakes with Space Store logo on it. I'd love to have you come. And finally, I just want to, again, invite you, if you're interested in investing, we're going to change the way people experience space. So thank you very much. Questions? Oh, they turned my microphone off. Oh, never mind.
Okay, so next up we have James from Rocking Horse. So Rocking Horse are actually a corporate partner of Wholesale Investor, and they are in the R&D tax credit space. Amazing Australian business that's moved over to come to the UK to hopefully be an even bigger UK business. And James been working across both countries and losing a lot of sleep for it. But good to have him here today, and hopefully he can teach you a thing or two about the R&D tax process. Over to you.
Great, thank you very much. Just wondering who here today didn't receive one of the actual notes, the real money from China I was giving out earlier. Who did not receive it? Okay, well, I've got a few here. Has everyone else received it? Everyone else? Might just wonder. Who hasn't? Who hasn't? Excellent. We offer the most simplest thing in the world. It's quite literally giving out this money, and what I'm here to do is talk about one of the easiest things to sell, and that is actually providing that money early. So we advance fund R&D tax credits, we advance fund grants, European Space Agency projects, European Horizon project, all these different grants. And the real thing that we actually sell is not the product, we lend the money. It's the easiest sell ever. So of you here today, how many of you have R&D tax credits? Any grants? Any Innovate UK grants, smart grants? So for people here today with that actual tax credit, our concept, again, we can advance fund 80% of what that tax credit is at this point in time. So if it's after 6 months of your year, we can provide 80% of what has been achieved. We can advance fund 40 to 50,000 to one company alone and up to 10 million. And again, it's about that concept of 80%. And the whole reason why, and our ethos is to give your business some money and to help you accelerate and grow. Our real focus and mission is to improve innovation, to improve research and development. However, we want to provide that money early, allow a business to actually grow quicker and improve. Does anyone have any questions? That's the only negative bit, and I will come back to it. But we charge 1.25% per month. We as a business were started in Australia. Australia, the UK, and Canada have very similar tax credits. So on the R&D, it's really the only 3 countries in the world that provide a cash payment for your R&D. All other countries have R&D tax credits, but that's usually against future taxes and to help reduce those future tax amounts. But it was originally started in Australia in 2015, then within the UK started in 2018. We received some institutional funding in 2020 and have been able to provide multiple loans. We received senior funding from a UK bank this year and continuing to grow the actual businesses we work with. The main focus of today is to talk about how debt is better than equity. It's providing that advanced funding. It's about reducing dilution for owners and accelerating the growth. We have no claim on the equity of the business. So we want founders, we want the investors within the business at that point in time to remain their ownership of that so that they create and they benefit from the value of that business. We, as lender, have no claim on future profits, like some VC firms might have. We are pure debt providers. We charge principal and interest, and we charge the interest payment as a bullet payment at the end of the term of the loan. So it's not a monthly payment. It's not obviously over the duration. It's all paid at the end. And the real focus is to make sure that business, like yours, has that ability to be flexible, to use that working capital and continue to accelerate the growth. The most important thing, we as an SME ourselves, you as a business, you as an SME, working for that SME, we know exactly how you feel, and we want to make sure that you keep control of your business. We want you to benefit, and we want the owners to benefit as well. So our concept is about continuing that research, continuing that innovation, and continuing the ownership in the right fashion. You can draw down multiple times throughout the year. So a lot of people think that the actual R&D tax credit we provide is only after they've submitted the CT600 and only after HMRC have received that form. We lend at 3 different stages: prior to year end, at year end, and after year end. And one of the greatest misconceptions is that we have to wait until that tax credit has been submitted to HMRC. We very much can lend at month 6, month 9, and month 12. And that multiple drawdown each year helps a business grow, gives that access to capital early. They might want to expand the business. You as a business might want to do 18 months worth of R&D in a space of 12 months, but still, a bit tight on capital. That's what we're here to help with. very much about hitting those milestones, whether that's revenue, whether that's new employees, whether it's actually helping defeat this inflation we're all experiencing. It's all about being able to hit those milestones. For you as a business, we are purely lenders, so it helps accelerate that business of yours and to achieve what you want to achieve for that year. And as mentioned, very much about increasing the valuation of your business. The way it works is you as a business have an R&D tax credit, whatever that number might be. The accountant, we are not accountants, we're pure lenders, provides us with that number. We then look at your business, assess both the cash flows of the business historically as well as the future cash flows. And with that company information, with the fintech we experience here in the UK, which is the third largest fintech country in the world after the US and China, with that information, we can digest the business. We get read-only access to your zero accounts, for example. We get live access to your bank accounts, really very much read-only, funnily enough, and then look at those future cash flows. And those different scenarios, whether it's to do with the UK recession, whether it's to do with inflation, whether it's just before a massive contract your business is about to sign, we look at these different scenarios, check how things are placed, and then lend the money. The biggest USP we have, the most important USP that all technology businesses, all young, startup, innovative businesses have, is time. We lend the money quickly. All businesses need to accelerate ahead of their actual competition. 30 years ago, it was the big businesses that ate the small. It's now the quick eating the slow. And for that reason, it's our focus to actually process quickly, provide the actual capital quickly, and help you grow. The fastest ever turnaround we've experienced is 48 hours from start to finish, to us obtaining that information, obtaining access to the accounts, whether that's QuickBooks or Xero, through to sending the money. So that USP that we have the money on our bank accounts, we have an internal legal team, internal credit team, and it's all about helping your business accelerate and not preventing that from happening. The short-term funding of 3 to 6 months is mainly what happens. We can look to provide that for longer, where there's a drawdown multiple times throughout the year, so before year end, at year end, and again after if HMRC are late. But then it's 80% of what that R&D tax credit is at that point in time. So if, for example, you have an R&D tax credit of 125,000 at the year end, we could lend 100. If it's 50,000, we could lend 40 after 6 months, and then you can top up and top up and top up. And I think that's the biggest misconception, where businesses should not wait. They should access this money and continue to drive the growth. But it's 80% of that amount. As mentioned, we can do longer loans, so it's that quarterly perspective. It's the concept of being able to achieve that throughout the year, and that funding for R&D, very much quarterly and rolling it. Roll forward 10 years, we hope that an accountancy firm will provide live pricing of what that tax credit is, and we can provide live funding. So it's very much about moving from historic to live. You can see the concept there. It's really important. I'm going to answer the question on pricing, but the focus for us is funding innovation. The second is about accelerating commercialization, hitting milestones ahead of capital raises so you as a business do not get diluted, but also retaining control of your business and accessing financing early. From the concept of pricing, that is the only negative. On average, we have 1.25% interest rate per month, and we have an establishment fee of 3%. That's it. There's no hidden charges, no exit fees. All interest is paid at the end of the loan, and it's all about allowing that working capital and flexibility for businesses. Are there any questions? I'm conscious of time.
Would you mind if we just field the questions next door, if there is any?
Any
James
questions
will be
next door?
Yeah.
Thank you all very much, and I hope Rocking Horse can help.
Thanks, James. Couple more to get through before the end of the day. We've now got Chris, who's the co-founder and CEO of KikaPay. Their mission is to provide fair, open banking financial services to both businesses and individuals.
Hello, everyone. Thank you very much for sticking around to the end to hear, among others, my presentation. I'm here today to present the investment opportunity in KikaPay. We offer a direct from bank method of payment to merchants and businesses, small and large. In very simple terms, what we do is provide an alternative to Stripe. Has anyone heard of Stripe? Whatever they do, we can do faster, better, and 80% cheaper. What they do really well is integrate their system very, very easily, which is what we've emulated. That is pretty much what we do. But it started because we saw, my founder, Philip, and myself saw a problem in the way payments are taken by companies. They're expensive. They're slow to receive the money. And actually, many parts of the payment infrastructure mean that the charges are unfair. Unfair to smaller businesses, but also to the consumers making the payments, because they get overcharged for overdrafts or credit on credit cards. And we wanted to bring fair, fast payments to disrupt this market. We're supported by Etienne, our CTO, who's got experience in 6 tech ventures before, scaling them and exiting them. And David, from a perspective of business development, with 20 years payments experience. Philip brings integration experience in technology and integrating our solution to large companies and small companies. We've got great advisors. Tim was a partner of Deloitte's for 15 years, heading up their payments industry. Pat was ex-CIO of Virgin Media. Great experience, great connections. Our partners are worldwide. We are primary partner of MasterCard, who support us and connect us to all the banks. And we're connected to 99% of UK banks. And by Q1, we will be rolling out to all European banks as the next stage of our development. So what is it the problem we're solving? The card infrastructure, when you make a payment in a shop or online, there are lots of companies that get the money from your bank account as a customer to the merchant's bank account. This makes it slow. Settlement of the payment takes anything between 2 and 14 days. It's expensive, even for the largest company. It's 80, 90p for a £100 transaction, but more frequently, 1.5% to 3% of the value of the transaction as a cost. And it's insecure. How many times do you hear of large companies even losing customer data and being fined by the regulator millions of pounds? But fraud is prevalent, and that's why you have strong customer authentication and 6-digit codes that keep getting sent to you to make sure that the payment is secure. Our solution, a Kika solution, is fast. The settlement is immediate. It's competitive. We look to be 80% cheaper than a card payment for the merchant, and it's secure. I can talk much more about security, but it's virtually fraud-free. And that's why the government in all jurisdictions, not just the UK, but other jurisdictions, are promoting push payments, of which Kika is a good example, rather than pull payments like card payments or direct debits, which are inherently insecure. So we're also in tune with what's happening in all these jurisdictions. It's great for the customer as well. They'll come to the stand, you can try a payment, but it's smooth with fewer keystrokes than a card payment. It's familiar because the customer gets passed to their online or mobile banking, which they're familiar with, and it's secure because there are no lost payments, no declines, and fraud is eliminated. We've got a great pipeline of clients. that we've already up and running with Northumbria Water as our main utility client, doing bill payments for them. We've got a great pipeline of warm clients and early stage clients. What we're looking for is investment to support the sales process to move these clients from prospects to clients and revenue. The market is huge. In the UK, card payments cost the UK economy £20 billion a year. We want to disrupt this market, but that's just the UK. We're highly scalable and can take this solution abroad. There are 560 billion payments worldwide in the next 20 years that will all move to a push payment, of which open banking and Kicker is a good example, and we want to disrupt that market. We're differentiated from our competitors by the way we integrate with large companies. We have 4 different integration solutions. We're error-free, and we provide an easy way for the clients to integrate us. And gradually, we're building brand trust with their customers. In each market we're in, we're also building features and functionality that, again, differentiates our product from our competitors. In charities, we collect gift aid information. In retail, we have an embedded solution at checkout. And in utilities, we're working on a help-to-pay solution to support and optimize help to households just about managing to pay their bills. Boy, how relevant is that just at the moment? We're looking to raise a bridging round of 400 to enable us to reach £50,000 monthly recurring revenue. We will look to raise 3 million next year at a significantly higher valuation, and the exit opportunities in the future are huge because this industry is so scalable. If you want to try a payment, you can scan the QR code. That's to make a donation to one of our clients, collecting money to support Syrian and Ukrainian refugees settling in the UK. Thank you very much. I can take questions if anyone has a question. So we are an alternative to Stripe. Stripe are a card acceptance company, so they offer merchants the ability to accept payments by card. What they do really, really well is make it really easy to integrate their technology into a merchant solution. But what they don't tell you is that they quite often hold on to the money, and they don't give the merchant the money. In fact, one company said they had to wait 2 weeks for the payments to arrive in their bank account, and we do with that within seconds. They're expensive. Anything between 1.5% to 3% of the value of the transaction is what they charge. And
we're
all
going to have to wrap this up, I'm afraid.
Suffer from fraudulent transactions.
But if that's not enough to carry on the conversation, he will be next door. So please go and do that. Thank you very much.
Thank you.
Next on the stage is Bimal Shah, who's the CEO and founder of Elemental Concept. And their BITS product is a master exchange for alternative assets.
So I think I've been introduced. My name is Bimal. I'm the CEO of Elemental Concept, and what we do is we're a technology consultancy. Now, I'm looking at all of you, and you're thinking, that sounds really boring. Don't worry, I'm not going to talk about software development. What I'm actually here to talk about is what's become the prime focus of our business. And I'll have to give you a little bit of a story of why it's become the prime focus. So one of the beauties of running a technology consultancy is that you get to work with loads of businesses, you solve their problems, and you build a product that helps solve it. Sometimes, though, you get to a place where you've got lots of customers with the same problem, and none of them have the wherewithal to build the product or finance the product, but they'll all use it. And that's why I'm here to talk to you, because we have now ended up building a product that will become the mainstream of our company. So what is that product? So that product is a stock exchange, a master exchange for tangible assets. I'm seeing a load of blank faces here. What does that mean, yeah? Okay. So, okay, bit of audience participation. How many of you invest in listed companies, have shares in listed companies? Brilliant, okay. Now keep your hands up, keep your hands up. How many of you understand the ins and outs of these listed companies? Like, so you've got a fraction of a share in this listed company, you know everything about it. Very few hands now. And if I had less financially savvy people here, I'd probably have less hands. The problem here is that, so someone can invest in Vodafone, BP, Shell, etc. They can get a fraction of a share in that company, but do they understand what it is? Probably not, but it's the only place where you can do a short-term investment where you've got liquidity, you can get in and out as and when you want. You may win, you may lose, but there's very few alternatives to that. Now, what we're talking about is an exchange for assets you might understand. So, on this slide, you don't need to look at it, it's quite boring. On this slide, what we're talking about is asset classes that people might like to invest in, but they're just unobtainable. So I'm saying the Mona Lisa, the penny black stamp, a Ferrari Testarossa, a Crater Petrus, a building in Canary Wharf. Like, you'll be able to understand that. It's a lot simpler. But at the moment, there's no way Joe Public or even most high net worths can get in. The price ticket is way too high, and it's illiquid when you're in there. So we have decided that we're going to solve this problem. And the reason why we've had to solve this problem is because of our customers being a software development consultancy. So what are we building? Sorry, I am going to skip some slides because they're all boring. So what are we building? We're building an exchange. This will be a regulated exchange. So why we're raising money is to go and get it regulated. We've built the core of this product already. So the regulated exchange will take any type of investor, be it individuals, Joe Public, be it high net worths, be it funds. We build technology for a living. We build banking systems. We know how to do that bit. That's not the problem. What we're going to do is have a beautiful app, which we've already built for the Joe Public, but we'll also have the APIs so the wealth managers can bring on all their customer bases. And at the other side of this, we've got a whole load of asset funds that want to come and list their assets. So what's been the evolution of our product and why are we here today? So we are solving a problem for two people. One, I've talked about the investor, can't get onto these things, they're not available. Secondly, the asset manager, and they are the beginning of our story. So we have in our customer base investment funds that look after art, look after stamps, look after classic cars, look after property, look after air leasing, look after ship broking. All of them have this same want and desire. They want more assets under management. And the only way to get more assets under management is to get a bigger investor base. So they've asked us to solve that problem, build a system where they can break up their assets into much smaller pieces so that you can get more assets because the price ticket's lower. And so you can fractionalize an asset. But most people still won't invest because it's illiquid. So if you imagine you're going into an art investment fund, you will be stuck there for 5 years or whatever their term is. You're not going to be able to get out when you want your money out. So they've asked us to solve the problem for them. So we started building a SaaS product. We built a SaaS product which has gone live with one customer. It's going live with 2 other customers where they can list their assets, fractionalize them, do their AML, KYC for all of their customers. all of their investors, and there's an exchange on the back of it where they can trade in and out. But they said, this is still problematic. We want you to solve it further. Why it's problematic for them is for two reasons. One is regulation. For them to get to the masses, they need to be able to do financial promotion. That's FCA regulation. And it is a turn-off for most investment funds. They don't want to do that. They just stay with the accredited investor, the high net worth, and they'll stick with their small tickets. The second is liquidity. If you are having only investors in your small universe, you're never going to have a tradable exchange. Exchanges thrive on lots of volume. And if you are only an art investment fund with only your art investors, the secondary market will be pretty much non-existent. So they've said to us, solve that problem, and they have asked us to build a regulated exchange where they can list their assets. And that's where we are today. So why we are here is for us to continue our journey of taking this SaaS product and go and get it regulated. Oops, gone too far now. So where we're here today is we're planning to raise equity. I guess that's what every company that's standing in front of you are trying to do. We're raising 4 million. We're raising 4 million for three principal reasons. One is to go and get regulated. This is an expensive process, and we will have to put in the whole compliance and risk management structure so that we can audit and verify any investor. Secondly, we want to continue the development so we have bulletproof APIs for any investor. We have the right mobile app, we have the right trading interface for the market makers, etc. So we need to build all of the attributes of a proper regulated exchange. We can do this, we've done it for a number of companies, but now we need to do it for ourselves. So we need to invest money. Thirdly, we will need some money for marketing. So when we launch, we will be bringing something like the penny black stamp to everyone. So that is where we are today. That we are going to raise some money to do this. Why is this a great opportunity for all of you here? So the opportunity is you are investing in a growing technology consultancy. So there is a 4 million revenue growing to 5 million this year. It's EBITDA positive. So that is an underlying revenue stream that supports this business. That's how we've managed to invest in building the product to date. Where we're going to take it is we're going to let the consultancy run because it brings us talent and software expertise that we're not going to have otherwise. It also brings us customer base, all of the asset managers that you want to be on this platform. And these are qualified asset managers. These are people who make their money by bringing value to their investors. When we do launch this, we will have certified assets on the platform, ones that we can get Sotheby's to rubber stamp. We can prove that they're real assets, they're not NFTs. So we're going to be putting in place that structure. And we will be building an exchange for Joe Public. We may well launch in the interim to high net worth and accredited investors, but the plan is to go and be a regulated entity which gives real people the chance to invest in things that they can understand, that they like, but they can't get to at the moment. So the opportunity is there. You're already investing in an EBITDA business, EBITDA positive business. We will turn over roughly 5 million this year. We know how to build this stuff, and we're raising money to do the compliance. That's probably all I need to say. I can show you loads of numbers, which I will do. These kind of just show...
We're really sorry, we just got to wrap that up because we do have another panel discussion. So.
Cool. Well, anyway, you don't need to see the numbers because it's obvious how does an exchange make money. It's for listing and transaction fees. That's exactly how it does it. It's not rocket science. Anyway, thank you.
Thank you. We're down to our final company before the panel session later on. So I'd like to welcome Marcus Cheen to the stage, who is the CEO of Meraki Mining, and they're focused on assessing the potential for sustainable and environmentally responsible precious and base metal extraction in the UK.
Good afternoon, everyone. Thanks for hanging out to the end. Got a slightly different pitch for you all. So I'm Marcus Cheen. I am the Managing Director of Meraki Mining. What are we? As it stands, we're currently a mineral exploration business assessing the potential for gold, silver, copper, tin, nickel and cobalt in the UK. Thus far, we've managed to amass over 110,000 acres of exploration rights in the UK. We've identified what we think. We've got two £750 million targets in Cornwall, and we have a £500 million target in the Highlands. And I'll get on to how we've come to those numbers a bit later on. So I'm only 22. I've just graduated. I started this business when I was 18. I went to the Camborne School of Mines in Cornwall, and we're a team of 6, and we've taken quite a unique approach to doing this in the UK. So the idea was, obviously we can't compete with the big companies that have serious manpower and funding in Cornwall, because there has been an explosion of interest in mining in Cornwall because it was such a huge historical mining region. What we've decided to do is, I did a small family and friends funding round, £70,000. We split that in half. Half of that we used to build a mineral rights portfolio that is exclusive for nearly all of it. That stops other competitors treading on our toes. And the other half we spent doing some exploration work, which included drilling and geochemical and geophysical sampling of our targets. What's our unique selling point? Well, we have sufficient evidence to date to prove that we think we can develop England's first gold mine. Now, in Scotland, there's a gold mine. There's a gold mine in Wales and in Northern Ireland. And the stories have all kind of come together the same way. Alluvial gold like this is being found in the rivers, especially where we're looking in Cornwall. And this has happened in Scotland, Wales and Northern Ireland as well. And this alluvial gold you can see here obviously comes from somewhere. It doesn't just end up in a river from nowhere. And so that's what we've done. We've used exploration techniques to define what we think are the sources of this mineralization. And to date, it's estimated there's about 5 tons of placer gold, that's alluvial gold in the river. That's been found since the Bronze Age, 4,000 years ago, but no one's attempted to look for the source of this gold until now. What we want to do next is take our drilling to the next level. So this diagram here, essentially what we're looking at, you can see the historic engine house and the shaft. These old ore bodies have been worked by the old timers to a very shallow depth. So we've got already quite good data on the grades of the metals there and the values of them. But they hardly touched the entire ore body. So we've already drilled holes, and we plan to do holes up to 400 meters deep to really prove how big these ore bodies actually are. I'm not going to read this out to you. All you really need to know from this slide is we're a mining company. We've got people from the Camborne School of Mines, the Royal School of Mines, and the Colorado School of Mines. We're a pretty dynamic team, and the team's worked on every continent. So obviously, when I pull out a number like £750 million for an ore deposit, I've got to be able to validate that somehow. This is what we did with our drilling. We've intercepted these ore bodies. And the best way to think about this is the type of ore bodies we're looking for. Imagine a sandwich. So you've got a ham sandwich, okay? You've got 2 bits of bread. That is the country rock around the small, narrow mineral vein going down the middle. And that little mineral vein is the slice of ham. These veins obviously come from the bottom up. Now this is a vein intersect from a drill hole that we did. That there was sent away for analysis. That contains over 10 grams per ton gold. Gold being around £50 a gram. You can see where the value comes from. We've intersected veins. This is a small example. The average width of the vein is about 1.5 meters. Over a 1 kilometer strike length, which you can see we've identified with geophysical surveys here on the left, if we can prove with our £750,000 funding that these veins extend to 500 meters, which is absolutely possible because they come from the ground up, then that is where the £750 million value comes from. It's a simple volumetric calculation The ore body is just a cuboid, essentially. So this sample here, you can see the quartz with pyrite in it. That is what the ore body is made of. That is what we found on surface, and that is what continues to go underground in a steeply dipping vein. Now the pyrite, you can see on the electron microbe analysis on the right of it, the pyrite, the gold is actually locked within the pyrite. And the story adds up here really, because the gold we find in the river has small bits of quartz still embedded, and that's a key sign that the source is in the vicinity of where we've panned this gold out of the river. And to match with that, the quartz that we found has small flakes of gold in it. This is just some example of soil sampling that we've done to prove where these veins are. Won't go into it too much. You can come and find me to ask questions on the actual technicalities of it. And this is where we currently stand. So we've already done quite a significant amount of exploration. We've taken thousands of soil samples, surface samples. We're currently in the discovery phase because it's a lot more than just a presentation now. We've got I think we've got over 1,800 samples analysed in Ireland. All, as I say, a lot at grades that prove that it's economically viable, 4 or 5 times over the cut-off grade. The next stage is feasibility and more drilling, and that's what we're looking to raise money for. That will take around 18 months, and then we don't expect to actually open a mine until 2025. And here also represents the exit opportunities. We'll either list on the TSX or AIM. We're not entirely sure yet. Both have their pros and cons. The TSX being in Canada, there's a lot of mining finance in Canada, so we might go down that route. But yeah, thank you for listening, and I hope you find it interesting.
So just to kick off, I'll just get you guys to introduce yourselves. Start. Come in. Ooh. Didn't mean to drop my phone as part of that. Okay. And we just need to get one extra chair. Thank you. Okay, so one of my favorite areas to actually talk about is the area of fintech and the disruption that's taking place. And obviously, being one of the sort of world centers when it comes to finance, the UK is the best place to actually have this conversation. So what we've tried to do is to make sure that we cover all areas of fintech in this discussion, from both the founder's perspective, fund manager's perspective, and also the investor's perspective as well. So what I'm going to do to kick off and also the platform perspective, I should go on the Anthony side. So just as to kick off, what I'd love for everyone to do, the panelists, just to give a quick, starting from you, Anthony, just to give a quick introduction to yourselves and a little bit about your company.
So hello, I'm Anthony. I'm founder and CEO at Seed Legals. If you're looking to do a funding round, head over to Seed Legals. We do about 1 in 6 of all early stage funding rounds. You still have to find the investors, but we take care of all the legals behind that. We're about 170 people and actually about 300 meters up the road from here.
Hey guys, I'm Madhur. I used to be a banker. I used to work at JP Morgan, Standard Chartered, and then I left and started my own consulting company about 1.5 years ago. What I do now is scale up tech companies like fintech, regtech, edutech, and insurtech. I'm based in Singapore. I just happened to be in London. I was talking to Rory, and Rory said, "Hey, why don't you come and speak here?" So, here I am.
We literally found him outside and thought, "Come inside." No, I'm kidding.
Hi, I'm Harrison. I am principal at True Altitude. I've had a bit of a plotted history through kind of the financial services landscape. I started off at Australia's first neobank. I then spent a few years at IBM selling to the flip side of financial services. I won't call them boring, but a little different, shall we say. And then about 1.5 years ago, I joined True Altitude. We're actually an Abu Dhabi-based growth fund offices, London, Dubai, Abu Dhabi and Sydney, and we focus across Europe, Middle East, Africa, and Southeast Asia.
Out of curiosity, Harrison, which neobank was it you found in Australia?
Zinja.
Interesting.
Yeah, so there was
Rough
two,
time.
and they've both gone badly. So there's a bit of an interesting model.
What was the second one?
The one that just went under was Volt.
Volt, okay, we know them well.
So Volt and Zinja, we were literally next to each other. Our offices were across the street, and then we had a bit of a competition, and we went first, and they went.
So just take a quick diversion from the intros. In neobanks in Australia, literally what's happened is the most successful neobank actually got acquired by one of the big four banks. 2 have gone under, and there's literally 1 remaining. So
is there still one going?
Pardon?
Is there still one left?
I'm just trying to think which one it is. 86400 acquired, Volt.
Zinja.
Oh no, the business one. They've got their name. They actually listed on the ASX. Was the other one?
It's gone well.
That's terrible. I forgot their name.
Struggling, is it?
How bad is that? There's only 4 of them, and I can't remember the 4th.
Okay. Hi, my name is Katharina. I'm the CEO and founder of Stella One. We do strategy and investment advisory in tech. So our main clients will be investors, financial institutions, but also corporates. And we're active in the UK and continental Europe and in Africa. And I'm also the chairwoman and co-founder of Didon. Didon AI. So we use artificial intelligence for sustainable finance assessments.
Me next. Hi everyone, I'm Sam. I'm one of the founders and the Chief Investment Officer of a company called IMO. IMO is a tech-driven real estate investment management company focused specifically on granular existing residential. So all the apartments and houses that you sort of see around cities that typically institutions can't access because it's very inefficient using traditional manual processes. So using our technology across the value chain, we've sort of removed those inefficiencies as much as possible and unlocked what is the largest asset class in the world for institutions. We've raised about $2.5 billion from various institutions, busy deploying that across Germany, Spain, and starting in UK later this year, and we're probably about 180 people now.
Fantastic. Okay, so first question is, obviously fintech over the last sort of 8 to 10 years has transformed a lot of different areas. So, and especially obviously in traditional finance. So the first question that I'll have is, and I suppose this is really coming for investors, is what segments do you see as ready for disruption and transformation over the next 5 years?
Sure, I'm happy to go first. I must confess I'm not that old, so I probably wasn't around for the start of that period. But these days, I think we're looking a lot at emerging markets, fintech, more so than developed markets. We still think there's probably a lot of opportunities that are ripe for disruption, and it's probably a case now where 1.0 maybe look to disrupt legacy. There's maybe even a point now to be made that 2.0 can disrupt what was meant to disrupt what was previously legacy. Maybe not the neobanks is the perfect example, but Monzo, Revolut, they're all getting pretty big now, and then they will eventually slow down too. So I think in developed markets, there's an argument that you can do what they do even better. In emerging markets, there's everyone knows about the incredible lack of access to financial services, whether that be unbanked. I think there's more a case now post-COVID where there's a big gap in quality of financial services. So anything from SME credit through to actually how do you credit score and underwrite loans in emerging markets has been a big topic we're looking at. I think there's a large thing, a particular focus of ours is embedded finance. Where do you put finance in traditional user journeys, whether that be you're ordering corner stores in emerging markets are getting e-com platforms to order inventory. You then give them inventory finance and then use those corner stores as a distribution network for other financial services. We're seeing a lot in embedded finance in emerging markets, but I think coming back to developed markets, there's a little bit to do in terms of what is the next iteration on doing things differently rather than just doing them digitally as such.
Interesting. Emma?
I think if we take a look at the history of fintech, what it really solved. It solved efficiency, it solved creating cost advantages, it solved speed, it solved a number of things. I don't think that's going to change. That will continue. The real question is, what is the macro, on what I'm seeing currently, what's the macro environment going to be? So in the macro environment, it's pretty clear, right? One, the largest energy producer in the world is at war, 18%. The largest manufacturer of the world, China, has a supply chain issue. And the largest banker in the world is now going through quantitative easing and quantitative tightening, sorry. So that's going to create stresses in the system, right? So if the stresses in the system are going to be hit valuations, and valuations are going to come down, that's going to percolate through the economies. So now let's divide the economies up into two. You've got the developed economies, and you've got all the emerging market economies. In the emerging market economies, like Harrison said, the depth of financial services, the depth of prop tech, whatever else, is not that deep. And so what you find is if there is going to be anything that is going to provide speed in a macro environment that is creating stress, is going to be in demand. There's going to be one hurdle, and that's a massive hurdle, and I've seen that over the past year, I'd say, and that's humans. So the human hurdle is in corporations where there's going to be a loss of jobs. And when you show them a particular efficiency of a platform, either they want to build it themselves, protect their jobs, or what they'll say is, we're not ready for it. So what is going to be ready for disruption over the next 5 years is going to be very, very focused on, are you going to get the speed? Are you going to get the costs? Are you going to get the efficiency? Are you going to last out 5 years? Now, lasting out the 5 years is going to be damn tough, because it's going to be pure cash. In some cases, that's going to help them last the 5 years, depending on country. Now, it's going to be different in Germany, it's going to be different in Indonesia. It is going to be different. A specific company that I've been following and has been successful, if people know it, is out of South America called New Holdings. NU, it's out of Brazil, and they're now in Colombia, and they're now in Mexico. And all they're doing is it's essentially UI UX for lending and credit cards, very simple balance sheet, and they've been able to grow over the past 10 years. So when you go into disruption, the real question is going to be how clean and how efficient is that particular platform which you're going to be, let's say, for an investor investing in or for a founder building, and is that platform going to be scalable? And are humans going to accept that platform, or going to push back and say, no, that's going to be a loss of jobs for me, or a loss of my job, and I really don't want this product to come into my corporation. And so there are lots of balls in the air because of the stresses in the system that are coming through. And eventually what I'm personally saying, cash is going to be king for a lot of these platforms to survive and enable that disruption.
So Murdo, do you see it as the case where you see a lot of, and I'll use the neobanks as an example, where in just generally in fintech, whenever there's sort of breakout success stories, typically the incumbents will try to acquire those companies at some stage.
Yep.
Do you see that taking place?
Yeah, I think there's going to be valuations, Steve, that are going to just drop by a significant amount. And if large projects, so let's say first half of last year, right? Nobody really expected the stresses in the system that could start sometime earlier this year. And the cash was already spoken for. There are going to be certain projects and it's a very general statement. There's going to be certain projects that we're going to be entering into on the tech side, of the build out, on the tech stack, whatever it is. And you really need to carry through those projects, because if you leave a building which, constructed building half done, without an elevator or without a staircase, that's messed up. So they'll have to carry it through. And the real question is going to be, is that cash going to survive? I mean, everybody's probably seen the Sequoia presentation, which has been floating around over the past month or so. And essentially, it's cash. Is it going to survive? So make the hard decision, reduce the projects, reduce the people, and stay alive. I think that's essentially going to be the name of the game, unless you're going to get new cash, like investments coming in, and people are going to be supporting that platform. One of the most successful platforms which I've seen on that side of the world, on the APAC side, is when a very large corporation or two large corporations kind of fund that platform, because they are going to be utilizing the services of that platform. And if you don't have that backing of that large corporation, and you're starting out, let's say, over the last 6 months, that trek up Mount Everest is going to be all the more tougher.
So I'm going to dive deeper into our second question, because that sort of talks about the current environment and capital raising. Anyone else want to answer the sort of first question?
Yeah, maybe if I can add to what my colleagues already said. From a more of a high-level view, in recent years there has been a lot of innovation in the retail banking market, and what I would expect is that there's more innovation in the corporate finance area, which is way less easy to attain when you're a fintech. And when it comes to emerging markets, we're very active on the African continent, and so what we see is financial inclusion indeed is a big topic. But what I would also see upcoming is the insurtech market, because the insurance market is a growing market on the African continent.
Interesting. Go for it.
We've heard from we've heard from my investor colleagues, but I think there's the other angle, which is the founder. So there are thousands, tens of thousands of smart founders out there who've recognized some pain point, and I love the macroeconomic thoughts, but they're not thinking that. So way back, I used to be with Kazaa, the music file sharing company, and my first disruptive play was disrupting CD sales. Instead of going and paying lots of money for a CD, you could have unlimited music online. And then I headed up BBC iPlayer, which was disrupting. You have to be up at 9 p.m. to watch in front of your TV when you can watch anywhere, anytime on your phone. And now with Seed Legals, it's disrupting law firms. And at no point did I think about the macroeconomic piece. We just go, what thing is really bugging me today, and can we change it? And so I think what you'll find, the answer to the question is that from the founder angle, is that there are many, many founders identifying problem spaces. It's really hard to predict. They're mostly the things that bug each of us, which is probably trying to use our Barclays app, buy a property, insure something, and a bunch of others, and of course the legals, and then people do it. Now, the question is, and in the more difficult times now, can you get to profitability, or at least cash flow break even, faster with less money raised? And if you can do that, then you don't have to go cap in hand waiting for investors at lower valuations. And to do that, you may be much better off selling to consumers, B2C instead of B2B, because when I go around law firms in London, they go, love Seed Legals, it's awesome, but I can see your price point, it's much less than ours. That's probably a long play, let's just say. Whereas if I go to a startup founder, in about 30 minutes, they go, great, that's good. So if you're looking to disrupt a market, your best bet might be to find the fastest decision makers, focus on those as your customers, and then deal with the slow ones later. That was the founder's view.
I like how everyone's answering question number 2 before I even ask it. It's fantastic. One more, I've got a question for you. You obviously come from a platform perspective, Anthony. I think what's interesting about your position is that you would see the fintechs that are coming through, let's say the fintechs that are coming through in the last 12 months, they're going to be seen by most people sort of 3, 5, 7 years later. Is there any trend you've observed in the fintechs that have started up over the last 12 months? If you say no, that's going to ruin the question.
I see very, very many companies, but unfortunately I don't really sort of draw a data point on it. What I do like is the number of crypto companies raising an SEIS funding round to get started, and that always amuses me. So.
Okay, so moving on to the next, the one we're talking about, the current environment. Now, look, this space is interesting in that a lot of us do have investments in listed tech companies. I know in Australia specifically, a lot of the high net worth and family offices that typically invest in this space, they also invest in the small cap listed, both in Australia and also in the US. Now, they've obviously been decimated by sort of 70 to 95%. And then that sort of has a ruining of confidence. Then you hear about sort of VCs that are maybe just supporting portfolio companies at the moment, and we've sort of started here some early advice. Is there any, I suppose, any trends that you think investors should be looking at now? Because obviously this is, from a valuation standpoint, this is probably the lowest I've seen it from a multiples in a very, very long time. How are you looking, what's your perspective on the investment environment right now?
I kind of see a world of ultimately have and have-nots. You know, we've seen a bit of compression. I think we've seen challenges more than I've seen compression. I haven't seen too many cases where I've gone, you know, that feels underpriced. That feels like incredibly good value. You know, we should buy this we should invest because this is a value deal. That isn't really what we're there for. You know, we're not really a private equity fund. We're just trying to look at kind of future growth more generally. But I think I still see a world of have and have-nots. The haves are as expensive or not expensive, however you see it, as previously, to be honest. You know, the companies which have a third-time exited founder who's raising their Series A will be the same size at probably the same price as it was before, because the long-term macro outlook of a Series A is you're not looking at that for 5, 7, 10 years. So, you know, you're not too worried about what the state of play looks like today. We're having a discussion just before this about kind of how does Series B and C look. I think that's a little bit different because you've got a shorter time horizon. You're thinking, you probably raise the fund on the proviso that you're going to return it a lot quicker. And you're thinking, you know, when do I need to get out of this investment? If that's the case, that's 3 to 5 years away, you're a little more concerned if this drags on for 3 years, you get into the tail end. And there's always a case of, I think this is not necessarily a bad thing, especially from the investor angle. I think there was a lot of people just chasing the markup, which isn't really a tangible outcome. And I think founders are, were wise to take the money when it was offered, if I'm honest, and take the amount of cash to now hopefully give them enough to turn that position around. If you can get to free cash flow positive, then you've utilized that cash well. If not, you may have to raise again, but hopefully you can look to internals to support that. But I think there's a balance of how I'm seeing the market. It's definitely a world of have and have-nots, and the have-nots are probably going to find it very hard.
I try to simplify it. It's definitely an investor's market. So I would say from your perspective, and maybe you don't want to identify any specific companies, but I'm sure there's been conversations where you've had an opportunity to come in, or on the investor side, had an opportunity to go into companies at a lower valuation than was previously offered sort of 12 months ago.
I think you've seen cases like, Klarna is the best example, right? What's happened there is, I was actually offered secondary at 47 or whatever it was, and I nearly took it.
One of my shareholders went in on secondaries at...
There you go. So, I think quite a few people were offered it in the 30 to 45 range.
It got sold that the Commonwealth Bank was a backer of it, and it was a really good story. Afterpay was up at that time.
So if you bought that, you'd probably sat a little bit going, yeah, I could get it for 6 now, but 6 or 7, whatever it is. But it's kind of a case of, I don't think I've seen too many cases in the early stage where that's been as apparent. I think those that struggle to raise have looked for alternative types of financing. I think at the late stage, if you can hang on, you can probably see a race to the bottom. But then you end up in the challenge of, if you're an investor and someone comes back that was previously raising at 500 is now asking for 300, do I wait for 200, or do you go 300 is reasonable? And then you start a different issue, which is some kind of odd race to the bottom.
And Katarina, how's the supporting process, I suppose, for some of the portfolio companies that you sort of work with? How do you approach that? How do you think about it?
Well, I think from what I see from the advisory side is at the moment it's all about optimization. There's also a lot of investors that come to me and say like, okay, we only do 2 to 3 investments until the end of the year because we need to bridge the other ones that we have. More from a founder's perspective, because the company I'm a chairwoman, we currently raising a Series A. I think to a certain extent what Harrison says is right. It's really, if you still have a good product to market fit, there still will be good valuations, not evaluations. Probably not as good as 6 months ago. But as long as the product is relevant, you still have a lot of arguments in the pocket to get the valuation that you want. But I think that there was a little bit of an adjustment in the market recently. The valuations that were put up in January, February were just skyrocketing.
And Sam, do you want to talk about how you can absolutely nail your timings for capital raising and what you've done for yourself?
So we've got a handy knack of forecasting black swan events. We raised our Series A just before COVID hit, literally like 2 weeks. And we raised our Series B in January, just before Ukraine kicked off.
So the simple guidance for everyone is just keep an eye out for a next round, just for what's coming up down the path. Just kidding.
Okay. Respecting the perfect timing. Like literally.
Just genius timing.
Spot on.
So obviously a lot of fintechs have taken a platform approach to the way they do things, whether it be investment from the retail perspective, financial, property service, and I think you mentioned, Harrison, as far as the sort of retail approach. What have you observed as far as the opportunities at a corporate and institutional level? And I'll give you a simple example. If anyone's gone through the bank guarantee process recently or setting up a fund as an example, it's just an absolute nightmare. So just from your perspective, and maybe it's for different, like what do you see as the opportunities at that sort of corporate and institutional level in the fintech area?
Maybe if I kick off on this one. So we're obviously operating within the real estate investment asset class, and there hasn't been a huge amount of disruption historically. In the US, it's definitely a lot more advanced than Europe. It's definitely slower here. So one of the big issues is that the prop tech market in general isn't particularly involved. There isn't a very well-established, digitization of the value chain within the real estate space. So we've essentially had to build the majority. We've had to tackle the entire value chain and create a platform that is end-to-end for our institutional investors because it just didn't exist. That was the only way we could do it.
And for you onboarding him, how long was it from the time you had your first meetings to the time they actually started investing money? What was the sort of time frame? What was the education process?
Oh, huge education process. So, I mean, we're trying to do new asset class that has never existed before in Europe. We're doing, very low risk, stable income, but it's still low risk. The types of investors you're targeting are very conservative types of LPs and multi-managers. And then we didn't have any track record. So, there was, and we were tech, which was all new. So from an institutional perspective, it was all like red flags everywhere. It was very, very difficult. So we actually started working with family offices to start off with. To begin with, we started raising smaller pots of capital, building up our track record. And then as soon as we had some track record, it really changed the conversations. And COVID was the silver lining of COVID for us was that there was huge increase in allocations towards the residential space. There was not enough opportunities for those institutions to be deploying, so they were being forced to look at alternative strategies. And then combined with the fact that the real estate industry is filled with dinosaurs, if I'm being very honest, who during COVID were forced to adopt technology and consider what technology can actually do in ways that they had never been able to comprehend before. So they were also forced to be more open-minded about what technology could do. So that was a real accelerator for us. We sort of raised $1 billion of commitments from a single multi-manager. And that probably, if I'm honest, came a bit sooner than we were expecting. But it took about 9 months for that process of sort of initial pitching, building the relationship, getting them comfortable, presenting to every single stakeholder at their end to get comfortable doing something quite different, and then all the legal contracting.
I think tech-wise, a good example is just the success of AngelList. I mean, the fact that they've been able to be so successful, and there's now so many copies and versions, and for those who, I think it's public knowledge, I think I can say this, like Vauban just got acquired by Carter in the US, and the success of the low admin fund launching platforms is a prime example of that space is just pure headache. But I think, across the corporate sector, there's a world of opportunity, but the challenge then comes back to what Anthony said, which is in a downturn, they're the longest sales cycles, they take the longest to get through, they're the longest deals to push, and therefore, is your customer the easiest to go after in the current environment when you're conscious of burning runway for a 12, 18-month sales cycle that isn't maybe the greatest time to be going after the hardest customers. So there's a flip to both sides.
I think what you find is various countries are going through a series of regulations, especially in the financial sector. And what you find is regulation is evolving so quickly, the internal tech team in the large bank or the large insurer is unable to keep up with that speed of regulation to manage the efficiency and the processes. I'll give you a very clear example, which I've seen in front of my eyes. In Australia, the banks went through a royal commission. There were fines. It was all about conduct. For a tech company that can help conduct monitoring, not compliance monitoring, conduct monitoring on how retail salespeople sell the product to retail investors and retail clients of the bank, that'll be in demand in such a country like that. But if at all there's a regulation that is, let's call it an enhancing regulation, so there are like 3 stages or the regulation's been in effect for 10 years and the regulator changes 2 or 3 things, they won't import something from the outside. They'll just create internally, and the tech team will say, I've got the tech stack, I'll create it. So you won't need an external tech company to manage that. So one is regulatory changes. And if a founder jumps on the regulatory changes, has a product to sell, that'll do well. It'll scale very quickly in a stressful environment. But as long as, Anthony mentioned about cash flow break-even, and cash flow break-even is super, super important right now. And that will survive. The second thing which I've seen is let's stick with financial institutions. Financial institutions create or hire tech people that are very, very focused on the financial institution and the platform of the financial institution. So it could be AML compliance, it could be anything or product of the financial institution. But what they won't do is like an edutech e-learning platform which they will need to import. So So those platforms will always be important. And e-learnings are so important because the regulator wants e-learnings to take place of those regulated people in that particular financial institution. So those are kinds of, I would say, gems that one really needs to seek. But if at all it's another KYC platform and there are a dime a dozen, that really will need to run a Usain Bolt in order to win the race. Otherwise, they'll be right at the back of the stack.
But I think you bring up an important point, right? Because obviously with fintech, there's another element to it where it comes regulation, right? And we've seen this with the likes of Airbnb and Uber, where they've pretty much just thrown caution to the wind, grown, expanded, basically not really counter regulation in the sort of starting point, but then it's sort of come back to it. However, that's not really what you can do with fintech, and obviously, there's been different elements where they've tried sandboxes and so forth. So my question to the panel is, how do you see RegTech playing a role in helping this, I suppose, new technology, either platforms or companies coming through to, I suppose, expand faster or be adopted faster?
It depends on I think it depends upon that platform. So a wealth tech platform, let's say, is in country A. So let's say wealth tech platform is in Brazil and wants to go to Colombia and wants to expand out. That wealth tech platform will obviously contract a RegTech platform in order to take the KYC or the KYB facilities straight out. So in order for that wealth tech platform to expand, they'll have a number of providers that they can do Control-C, Control-V, and then just expand in another country. So that kind of works. But for traditional finance, it's very, very difficult and to embrace, because there is always that human hurdle, which I've seen.
And Sam, I was going to ask Sam, how do you approach this from your own business perspective? Because I imagine regulation played a role in sort of, throughout the sort of early stages. Is there anything innovative you had to do for the building of your platform?
So we haven't created regulated structures for our fundraising piece. We did consider that, but we've gone more down the seg mandate route. So we haven't had to create regulated vehicles. What we have had to do is more from a real estate regulatory perspective is get our heads really up to speed on a lot of the, like whether it's rent control topics or things like that in some of the countries that we operate. And that's been really painful because it's literally every single city across Germany will have its own separate rent control system that's on a PDF and a completely random website that you have to unearth. And then anyway, so having to try to digitize and again, we've had to build that all ourselves because there isn't anyone who's kind of brought that all together already. So yeah, we're having to do a lot of it ourselves. But I'm from what I speak to in terms of from the financial services perspective, the regulation requirements are so high, and so the stakes are so high for the institutions. I always sort of struggle to really understand necessarily how startups within the reg tech space are really going to be winning some of these big clients, and sort of unless they're sort of partnering with someone who's already got the trust and credibility of those banks, because
back to cash runway, that what we were talking about.
Yeah,
before,
exactly. You have to build that track record to be able to build up your trust and credibility rating with the institution. Because if you screw it up, you've really, they're not going to contract with you if you're just a tiny little startup and the stakes are high.
Yeah, so we're on the other side of the fence, right? So we help we are a RegTech, so we help financial institutions actually implement a very stringent regulation around the EU taxonomy, which is part of the sustainable finance efforts of the European Commission. And the reason why we are getting a foot into the door is that we're really solving a pain point, and it's a huge pain point that really is going to hurt. But that's really the only reason. The market is a given because the EU taxonomy is a very stringent regulation.
Anthony, the king of legal tech. So, for you, was there any challenges you face as far as, because your area is effectively a nightmare when you think about it, all the things you have to face. And I imagine, do you know what I was thinking about when you mentioned about the lawyers that you meet with? I'm sure they're worried that they're going to meet with you and then you're going to be writing lines of code when you get home to actually compete with what they just shared with you. But how have you navigated that as an area?
Well, so it was a fascinating discussion because for a startup, my angle, you're usually designing your business to work within and around the regulations. And sometimes you need to get FCA regulated or you need to do some major hurdle. You know, right now FCA regulation or applying seems to be like 12 to 18 months. It's insanely long and you don't even know if you're going to get it at the end. So those who are on the other side have a sort of a natural moat. But for us, we don't claim to provide legal services, but actually in the UK, thanks to a fantastic framework, we can actually provide legal advice. We can't say we're a law firm, but we can ply our trade happily. But in France it's different, and in Singapore it's different, in the US it's different. So on the other hand, we can happily do all the legal services, but we can't do investor matchmaking because that's an FCA area. So what you're trying to do as a startup, I think, is figure out, where the water can flow downhill through the various rocks efficiently so you can get a product to market quickly, even if it's not your dream product. And then when you've got customers and you've got revenue, you can now work out, okay, great. I built something in 6 months. I've got my first MVP. I've got some customers. Now, can I play a long game that's going to take 3 years to get my FCA license and do these kind of things in these countries? And there is the challenge. And perhaps once you've covered some of those, then you're naturally much more acquirable because anyone else wanting to get into the space, they don't want the 3-year thing. They wanted the shortcut.
So I asked my team how much longer do we have left, and I got a big 0. So on that note, I'm going to ask one more question. The area of AI sort of comes up in this area, especially at fintech, whether you're dealing with retail investors or whether you're dealing with... What are some of the interesting applications that you've seen as far as AI in the areas of fintech? And that could be emerging investment opportunities over the next sort of 3 to 5 years.
If I may answer that, because our platform.
I'm not going to stop you.
Yeah, it's our platform is built on AI, so I think that the RegTech sector is a huge opportunity for artificial intelligence. There's so much to do. It hurts the customers so much that AI is really the right tool to use that. I think that AI is also very useful in the PropTech area, which is similarly very complex processes as of now. And AI can be very useful to facilitate those processes.
I want to see a little bit more in AI in credit underwriting and credit scoring and how you kind of use what is not traditional data, not that you pay back a loan, your spending habits and how you turn them into like the reality, ability to underwrite. We talked about emerging markets and the challenges. You can't credit score someone today that's never had a loan before to give them a new one because what you judge them against. So I think the ability to use other activities, human traits, whatever you'd like to call them, to underwrite better credit in somewhere like that, I think would bridge a large gap to what is a huge credit gap in a lot of emerging markets.
I'd say anything that reduces processes and significantly. I'll give you an example. There's one of the founders out here is a bond portfolio optimization platform, and they can optimize a bond portfolio in 5 minutes, where bond portfolio managers could take, let's call it 30 days. So it's that speed that matters, and AI can deliver that speed. And so really from an investor standpoint or a founder standpoint starting out, the real question is going to be, other than pain point and cash and all, are you really solving it in a very, very quick?
And the best part is, that 5 minutes today will become 1 minute, in the next
Sure.
sort of 1 to 2 years.
Yeah, well, 5 minutes to 1 minute may not be the greatest thing, or it may not increase the valuation from 10 to 30, but it is obviously going to help ancillary processes. That reduction from 5 to 1 helps other processes which come along in the same ecological system.
So I look at it in 2 parts. Number one, are you really using AI? And number 2, when you have it in your pitch deck, is it a positive or is it a negative? So, I'll start with a joke. You call it AI, I call it another if statement. So often AI is simply a simple set of logic that goes, if this, then do that. And at Sea Legals, we don't use AI, we use human intelligence. We code what lawyers have been doing for ages, and our team helps you with the things that, hey, this investor wants X, should I give it to them? Well, we know that investor's terms, don't give that one or push back or whatever it might be. So many systems, the founders talk about using AI, but it's actually much simpler than that. And now the question is, one of the important things of AI is, should you say in your slide deck, we do AI? And here I think investors are deeply skeptical. They know, if it's DeepMind or something significant, it's fantastic and hugely valuable. But most times you put in your slide deck, you're likely to get grilled by investors. Some say they will refuse to look at a slide deck that says AI because they know anyone who puts AI isn't really doing AI, it's machine learning or something. Others will tell you that they've only invested if you've got at least one PhD on your team with AI experience. So be prepared that if you are going to put AI in your deck, it might be genuinely doing a lot and it's awesome and hugely valuable. But if you just sprinkle it, it may come and haunt.
Perfect. Well, that concludes our session. I'd like to thank all the panelists for being involved. Really appreciate time and being involved in venture and capital. Can we please give everyone a round of applause?
You're talking about
Okay. So just as a final, now look, I'm going to hold everyone back from the, but I just want to say, I was actually going to give a bit of a presentation, but I won't do that just given that we're right on the end of time. But just want to give a final sort of summary of today. Everything we've thought about is we want to help people understand what this vision of the next sort of 3, 5, 10 years could look like. And from a WI perspective, what we're passionate about is bringing together growth companies or startups with high net worth investors. Everything we think about is that, and effectively the 4 ways we think about it is from how can we utilize software to save time, save money, and improve efficiency. And then the other part is from the capital markets perspective, we think that the biggest problem with this whole space is capital raising is frustrating, right? And if you think about it, in 13 years, I have met one person that says, I love the capital raising process. So if you think about that from how many companies have actually presented their opportunities today, it's a fascinating thing. You all know they don't enjoy the process. So everything we think about as a company is how we can make it more efficient. Now, obviously, you will realize that we're obviously an Australian company that's recently set up an office in the UK, but we've actually been coming here since 2014. And in fact, the area that we love is as we see that there's equity crowdfunding and then we see that there's VCs on this side. We think there's a massive opportunity with the high net worth and the family office to engage, build an ecosystem and have a connection with actual companies and also with each other. So what you will see from us and what we look at doing that from, obviously there's an in-person aspect to what we do, but actually we've invested a lot into the software aspect as what we do as well. So when you actually go onto Crisp, you can see that we've actually thought about all the logic, the UI, the UX, to actually streamline the process from an investor's perspective, as well as to streamline the process from a company's perspective as well. So as a final statement, I'd love to say, as a company, over the next sort of 6 to 12 months, we would love to have a chat with people that it can either be potential partners for us for accessing additional investor ecosystems and company ecosystems. And also, we'd love to work with some capital partners from our perspective as well as a company as we expand what we do in the UK. So on that note, I'd like to say thank you very much for joining us for Venture and Capital. And let's see this. 7 minutes late. We finished 7 minutes behind, but we were so close. So thank you very much for joining us for today. I hope you enjoyed. And just as a final, it's big thank you to the WI team. We're very lucky. We've got a really incredible, it's worth. I was clapping the mic. If you guys knew how much work goes into doing something like this, how many invitations we sent, how many, the work in coordinating the companies, the presentations, working with the founders on their presentations, the logistical part of this, I said, people will never quite understand. It's nice when you get to sit down and see everything come off really nicely. I said, but there's a lot of hard work that goes behind the scenes. So if you see a WI team member, today, or sort of during the drinks, just thank them for today, I said, because everyone's contributed a lot. And especially a big shout out to, and I can see Callum and Hugo from our team have done some incredible work across all sorts of areas in helping. So a big special shout out to those guys. That's it from me. Enjoy the drinks. It'll be over on that side. Thank you.